All right, let's hit the movers board. Markets desk wants the weird volume first. SPY's flat, QQQ's green by 0.25%, IWM's red, so this is not some clean small cap risk on party. These names are moving on their own tape. Top of the board, IPST, up about 268%, 44 million shares, relative volume 875. That is just ridiculous. IVF right behind it, up 148%, 54 million shares, tiny float. Then EYPT is the ugly one, down almost 70%, healthcare biotech getting smoked. TRUG, MYZ, SLE all green with big relative volume, and look at UCL down the list. Only 93 cents, but relative volume over 3,500. Oof, that one's getting a full look later. But first, we start at the top.
All right, top of the hour. It's 9:01 a.m. here on the macro desk. So quick market minute for anybody just walking in with coffee in one hand and emotional damage in the other. The tape is mixed but not panicky. SPY basically flat at 776.4. QQQ up about 0.23% at 732.7. Russell's the laggard, with IWM down 0.38% at 303.9, and VIX is sitting 19.34, barely lower. So the story is pretty clear. Big cap growth still has the bid. Small caps are not invited to the party yet, and volatility is just loitering below 20, like it's waiting for a reason to make trouble. Cross asset. It's not one giant risk-on parade. It's more like a cautious rotation with a clipboard. Bonds are a little heavy. TLT down 0.41%, IEF down 0.13%, so rates are not exactly handing stocks a love letter this morning. But the dollar proxy is softer at 28.05, down 0.21%, which takes a little pressure off the Nasdaq. Gold's green at 402.49, oil's up 0.73% at 127.53, and crypto proxies are firm too. BTO up 0.82%, NSTR up 0.76%, coin up 0.36%. So what I'm watching, VIX near 20, IWM around that 304 line, and whether QQQ can keep holding the 732 area while rates stay sticky. Calendar-wise, Empire State hits at 12:30, housing at 2, then TIC flows tonight. Coming up, we've got Mega Cap Watch first, then the movers board.
All right, let's pull up ARGX, because this biotech is blowing through a really clean daily box. Big picture first. The daily had been basing, not a straight line trend, more sideways to slightly up, with that 837 area underneath and 878 acting like the roof. That matters because the live print is up near 955 now. So yeah, this is not just a little green candle. That's a gap over the whole recent range, and it's happening while SPY is basically flat. QQQ is only up a quarter point. IWM is red. Relative strength is screaming here. For the markets desk, the first level is simple. 878 was the prior ceiling. Above that, the daily breakout stays interesting. Back below it, the quality of the gap changes fast. Here's the catalyst. Positive Phase 3 Alkivia top-line data for efgartigimod and autoimmune myositis. Primary endpoint hit, p-value 0.0011, and they're calling the improvement clinically meaningful. That's the type of biotech headline that can re-rate a chart in one shot, because the market isn't just trading revenue today, it's trading pipeline probability. Also note the timing. The release had an 8:30 a.m. Eastern call attached to it, so this pre-market move is trading around fresh data and that management commentary window. That's why the tape is so jumpy up here. Now let's drop down to the 1 minute. Oof, look at that structure. Early on, this thing wasn't clean at all. Opened around 849, slipped into that 846 to 848 pocket, basically built a little base, while the sellers tried to lean on it. Then the character changed. Once it got back through 850, volume actually confirmed it. We had volume spikes on the push through 851, then again as it started lifting into the 940s and 950s. That's the piece I care about. A breakout without volume is noise. This one had buyers show up at the spot they needed to. Right now it's parked near 955, which is the current high in this read, but the latest candles are lighter. So I'm not chasing the candle emotionally here. I'm watching whether 955 becomes a real acceptance level or just the top wick everyone sells into. So the scorecard on ARGX is pretty clear. Daily base roof at 878, now a major gap above it. Intraday, base around 846 to 848, breakout through 850, volume confirmation, and now a pause right at 955. The clean momentum tail is above 955. If it clears and holds up there, buyers are still in control of the tape. If it starts rejecting and sliding back toward the old daily roof, that's where the market tells you the gap got too extended. Biotech names can move nasty after clinical data, so levels matter more than opinions here. Coming up, we've still got the mover scan and then that UCL deep dive on deck. All right, let's pull up Apple, Mega Cap Watch, chart first. Daily view here, and this is not a clean leadership chart yet. Big rally from the 250s into the 340s, then oof, that round trip fade got aggressive. Now it's trying to stabilize around 305, 306. For the markets desk, the big daily line underneath is 300. If that starts cracking, the whole little base changes character fast. Here's the thing with Apple. QQQ is green, Nasdaq's trying to lead a mixed tape, and Apple's only up about 15 basis points. So it's participating, but it's not exactly dragging the market higher. The daily candles tell you why. It's below the short and medium moving averages. Momentum is neutral, and the recent heavy volume sell day still matters. I'm not treating this like a fresh breakout until it can actually reclaim that 316 zone on the daily. That's the top of the recent range. Below it, this is still repair work. Okay, let's drop down to the 1 minute. This is super tight. Apple's basically boxed between 306.32 and 307.60. That's it. Open was around 307.15, and most of the action is underneath that open, which gives the sellers a slight edge on this little snapshot. Look at those pushes into 307.40, 307.50. Volume shows up, and then the bid just can't keep it. Wick, fade, back to 306s. So for the intraday tape, 307.60 is the clean high side reclaim. Below 306.32, that's the range low giving way. Until one of those breaks with real volume, it's chop. Tight, annoying, very Apple. Quick catalyst check on Apple, because the chart is only half the story. The big recent company print was July earnings. Revenue, $109.4 billion, up 16% year over year. EPS, 2.02, up 29%. And gross margin, just over 50%, with some tariff refund help in there. The daily plan also had Apple getting an upgrade tied to the foldable iPhone Outlook, so there is some sentiment support around the name. But back on the tape, price is still saying, prove it. Reclaim 307.60 intraday, then we can talk about buyers waking up. Lose 306.32, and it's back to range low pressure. Coming up, we'll flip back to the movers board. Then UCL gets its own deep dive. All right, back to the movers board. Market's basically mixed, so I want the weird stuff with actual tape. QQQ's a little green, IWM's still lagging. And that matters because small caps need their own fuel right now. Top of the board is still wild. IPST is sitting around 810 after that monster move. And remember, that $8 trap line is still on our scorecard. IVF and EYPT we've already hit, so I'm not going to waste your time there. The fresh focus for the markets desk now, Trug, MYSZ, SLE, UCL, and then we've got IMCC on the downside. And oof, IMCC is under 10 cents, so that one gets handled very differently. Let's start with Trug, because that's the cleaner next volume story on the board. Okay, TRUG on the 1 minute. This is true golf, not a sleepy move at all. Price around $1.59, up about 64%. 21.8 million shares already, and relative volume at 67 times normal. That's the whole story. Tiny float, huge volume, fast tape. Float is just over 1 million shares. Market cap under 2 million. So yeah, this can move violently both ways. The level I care about first is 160. If this thing can actually build above 160 instead of just wicking through it, then buyers are still leaning on it. If it starts losing 150 and living under there, that's when this turns from momentum into a possible fade. Also, dilution risk shows medium here, so I'm not treating this like some clean institutional breakout. It's a low-float pre-market runner. Respect the levels, respect the rug risk. My SZ next. This is my size, and yeah, the whole chart is basically orbiting that $4 magnet right now. Price is sitting just under it, about $3.98, up 34%. But the reason it's on the board is the volume. About 6 million shares already, 40 times normal volume. So this is not a quiet float rotation. But here's the catch. The board has dilution risk marked high. So on these small software names, I'm always asking, is 4 actually getting reclaimed, or is it just where sellers reload? If the candles keep stuffing into 4 and backing off, that's rejection. If it starts holding above 4 and building higher lows, then at least the tape is saying buyers are trying to take control. Now, SLE, Super League Enterprise. This one's cleaner in terms of the line because $3 is the number everybody can see. Stock's around $2.95, up basically 30%, with about 13 million shares traded, 20 times relative volume, and the float is tiny, about 1.6 million, so that can move fast both ways. What I want to see on this one is whether the bid is actually holding under 3, or whether it's getting top-heavy every time it pokes toward that level. If the dips stay shallow, fine, there's still interest. If the candles start widening down and it can't get back to 3, then that's the board runner warning sign. Volume is there, but the control is shifting.
Thanks, Markets Desk. Breaking software headline right now. ProTerminal's newsroom is tracking Silver Lake in advanced talks to acquire Workday, and WDAY is surging about 25% on the headline. What we know, this is advanced discussion around a potential take private of a major enterprise software name. What we do not know yet, final deal terms, whether it's signed, financing details, timing, or regulatory path. So the market read is pretty clean. This is deal probability repricing. Not suddenly every SaaS multiple gets a magic wand. With QQQ around 733, up about 0.25%, and SPY basically flat near 776, WDAY is the lightning bolt here, not the whole weather system. Next one on the wire. Databricks raises $5 billion at a $190 billion valuation. Private company, no public ticker here, but the signal matters. Enterprise AI infrastructure is still attracting massive capital, even with the rate-sensitive side of the market looking a little grumpy. TLT down about 0.4 today. That tells you investors are still paying up for the AI plumbing layer. Very macro desk sentence, I know, but plumbing is apparently worth $190 billion now. And staying in private AI, OpenAI's revenue run rate has topped $40 billion. That's the headline, and the why it matters is simple. The AI story is not just lab demos and conference keynotes anymore. There's real monetization showing up at scale. The catch, because there's always a catch and it usually invoices monthly, is expectations. When private AI valuations are this high and software take-private chatter is this loud, public tech trades against a pretty demanding ruler. QQQ holding near 733 keeps the risk tone constructive, but VIX still sitting near 19 keeps the macro desk from doing cartwheels. Coming up, we'll kick it back into the movers board and see who's actually reacting on the tape.
Thanks, Macro Desk. Let's pull UCL up and actually grade this tape. We flagged that dollar area earlier, but look where this thing is now. 93.94 cents, below the 122 open and way under that 128 high. Oof, look at that wick. This was not a clean rip and hold. This was an early shove, heavy selling, then a base trying to form near the lows. And with the tape mixed, SPY flat, QQQ a little green, IWM red, small cap momentum is selective. UCL is still green on the board, yeah, but the intraday structure is bruised. Here's the market's desk read. The support line is tight, 92 cents. That's the base it's trying to defend right now. If that breaks, the earlier low around 86 cents is the next ugly reference point. On the upside, I don't love this until it can start clearing 1.10 with real volume. Not a tiny little wick, actual bids holding above it. The volume story matters here. The biggest spikes came on the sell-off, over 1.5 million shares on those dump candles, and the bounce volume was mixed. So right now, this is stabilization, not confirmed momentum. There's a difference. Base, yes. Breakout, not yet. Now the catalyst. Fresh headline this morning. uCloudlink announced a $2 million share repurchase program. For a company around a $35 million market cap, that can absolutely catch momentum scanners. It's the kind of headline that says, okay, management may be trying to support the stock. But the tape gets the final vote, and the tape's first vote was a fade from the 1.20s back under $1. Quick company context. This is a Hong Kong-based mobile data and cloud SIM connectivity name. Roaming Man, GlocalMe, portable Wi-Fi, that whole telecom services lane. The headline explains why traders found it. The chart tells you sellers still showed up. One more thing, and this is why the markets desk doesn't fall in love with sub-dollar runners. Dilution risk is real here. ProTerminal has UCL marked high risk, with active shelves and an active equity line, plus 9 active shelf registrations. That doesn't mean something happens today. It does mean overhead supply is part of the trade's DNA. Now flip me back to the 1 minute. The scoreboard is simple. Above 110, it starts to repair. Below 92 cents, that base is failing. In between, it's chop, and chop under $1 can get nasty fast. Coming up, we'll jump back to the movers scan and see what else is actually holding a bid. All right, back to the movers board. Markets desk wants the live heat map, not the theory. SPY's basically flat, QQQ's a little green, IWM's still lagging. So when these small caps are up 30, 70, 200%, that's its own tape. IPST still parked at the top. Wild move, but we already kept score on that $8 flush. IVF's still massive. Trug is still the cleaner momentum name near the top. And then you've got the other squeeze names, MYSC, SLE, UCL, all sitting right in that small cap danger zone. Red side matters too. EYPT still ugly after that big gap lower. And GRNQ's down there, but with lighter volume. So the play here is simple. Board first, chart second. IPST first. Oof, this is exactly why the markets desk doesn't just stare at percent gainers. It's still up huge, around 749 right now, but that $8 level already failed and got tagged on our scoreboard. So now, I'm not treating this like fresh breakout energy. I'm treating it like, can buyers rebuild? Or is this just the backside of the squeeze? First line for me is 750. If it can actually reclaim and hold above 750, okay, maybe the dip buyers are still in the building. But if it keeps rejecting there and starts leaning towards $7, that changes the tone fast. Also, tiny market cap, high dilution risk on the data, so don't get hypnotized by the candle size. These are not normal mega cap candles. These can go vertical, then rug, just as fast. TRUG next. This was the one where that $1.60 line mattered, and yeah, this is still sitting above it with the last board print around 169, up about 74%. So for me, that changes the read a little bit. If 160 keeps acting like support, the Momo crowd still has something to lean on. If it rolls back into 160 and starts rejecting from underneath, then it flips from momentum line into overhead supply real fast. Tiny float here, just over 1 million. 24 million shares already traded. So the move is real, but it can also air pocket like crazy. I'm watching 160 as the tell, not chasing the middle of the candle. Now IVF, and this one's a different animal. Healthcare name, tiny float, roughly 1.8 million shares in the float, and the board's showing 55 million shares traded. That's the float turning over again and again, so the chart can look super strong until suddenly every dip buyer disappears. Price is around 237, up 140+%. But I want to see the 1 minute volume still expanding when it pushes. If the push toward 250 comes on lighter bars, that's where these can get trappy. If it holds the 220s and volume stays there, fine, structure's still alive. But with high dilution risk on the board, I'm not treating this like a clean large cap breakout. This is pure small cap tape reading. MySZ now. This is the $4 spot again, and I'm not going to rehash the whole setup, but that line still matters. Board prints around 390, so it's living just under the round number, up about 31% on 6+ million shares. Relative volume is heavy, around 40 times normal, so the attention is real. But the question is whether 4 turns into a clean reclaim or just another liquidity magnet where sellers hit it. With a 4 million-ish float and high dilution risk showing, I don't want to fall in love with the percent move. For me, $4 is the tell. Clean hold above it, totally different tape. Keep wicking into it and failing, and that's the market saying supply's still parked there. SLE next, and yeah, this one's basically the $3 test. Last board price is $294, up just under 30%, and it's done 13 million shares versus normal volume around 630,000. So there's definitely crowd energy here. Tiny float too, about 1.6 million. So squeezes can get stupid fast. But that's also exactly where the top-heavy candles show up if the bid stops chasing. I'm watching the quality around 3. Are dips getting bought right back up, or is every push into 3 getting sold? That's the difference between a squeeze that still has structure and one that's just late buyers pressing into the obvious round number. High dilution risk on the board as well, so keep the risk lens on this thing. X-Pawn now. Battery name, industrials, and honestly, this is a little cleaner than some of the circus runners we've been looking at. It's up about 26%, trading around 458. Volume's just over 4 million shares. Relative volume basically 4 times normal. So it's active, but it's not IPST 900 times normal active, right? That matters. On the 1 minute, I'm watching whether these pushes are coming with real candles and follow-through, or if it's just one spike and a bleed. For me, 450 is the little pivot on the tape here. If it keeps accepting above that, it's acting better. If it loses that and starts chopping under it, then it's just another small cap pop that got crowded late. And now the other side of the board, EYPT. This is the downside check and it's ugly. Biotech name around 447, down almost 70% on the board. Volume close to 4.8 million, about 3.3 times normal. So while the small cap gainers are getting all the noise, this is relative weakness with the market basically mixed. SPY flat, QQQ green, IWM red, and EYPT is just living on the loser board. The only thing I care about near term is that 450 area. Below 450, sellers are still leaning on it. If it reclaims 450 and actually holds, then okay, maybe the tape stabilizes a bit. But until then, that level is pressure, not support. All right, that's the fast movers pass. We've got the runners, we've got the fade names. Now let's flip forward and see where the next real setup is coming from.
Thanks, Markets Desk. Quick pro-terminal news brief, starting with Apple. Headline here, Apple gets upgraded to buy with a $400 analyst target, tied to optimism around the coming foldable iPhone and a possible shift in the AI strategy. Why it matters, Apple's been a relative mood ring for mega-cap tech. And with QQQ sitting around 732.9, the market is still willing to reward a product cycle story. The caveat, because there's always a caveat at the macro desk. Foldables are exciting, but execution is where the bill shows up. Same ticker, different flavor. Apple is also changing app data consent rules after Germany's competition authority wrapped a multi-year investigation. The fact pattern is pretty simple. Developers get modified rules around using personal data for targeted ads on iPhones and iPads. Why it matters? This is not a flashy earnings headline, but it touches the App Store toll road. Europe keeps tightening the screws on platform control, and Apple's monetization machine has to keep adapting without making the developer base throw furniture. All right, opening bell countdown with the macro desk. Let's set the chessboard before the cash market starts throwing pieces around. We're 6-ish minutes from 9:30, and the headline on the tape is not panic, it's rotation. SPY is basically flat at 776.4, up a whisker. QQQ is green at 732.8, up about 0.25%. But the Russell is the sore thumb here. IWM 304, down 0.35%. So large cap growth has the coffee, small caps are still looking for the mug. VIX is sitting 1934, barely lower. So the risk thermostat is not screaming, but it's also not exactly beach weather. Under the hood, bonds are softer. TLT 81.77, down 0.33%. IEF 92.92, down 0.13%. That matters. If duration keeps bleeding into the open, it explains why the market can love mega-cap tech and still punish the smaller, rate-sensitive stuff. That's the little macro joke of the morning. The Nasdaq gets the velvet rope, the Russell gets asked for ID. Now, the cross-asset story into the bell. Dollar's a touch softer at 28.08. Yen is basically flat to firmer at 57.60. Gold is holding a modest bid at 402.13. Oil is up 0.3% at 126.98. And crypto has a little risk-on pulse. BITO up 0.82%, MSTR up about 0.5%. Coin barely green. So this isn't one big screaming dollar-driven move. It's more like a cautious risk bid with rates still tapping the market on the shoulder saying, "Remember me?" Even if you only trade US stocks, watch that rates channel. If TLT starts losing 81.75 decisively, that's the bond market saying yields are still leaning higher, and that can cap how much breadth improves. On the equity side, the open watch list is pretty clear. AAPL has the upgrade and China chip approval headline in the marquee. Amazon has the Prime Day AI angle. Verizon has Spectrum headlines. And then the small cap board still has IPST, IVF, and TRUG as the chaos basket for the first 10 minutes. Here at the macro desk, my opening bell levels are simple. QQQ 732.50 on the downside, 734.30 on the upside, VIX 20 as the risk line, TLT 81.75 for the rates pulse, and oil at 127. No big 8:30 data bomb today. First macro print is Empire State at 12:30, then housing at 2. So the bell gets to tell us what traders actually believe.
Thanks, macro desk. All right, let's hit the movers board and see what the tape is actually rewarding. We're sitting in a weird backdrop. SPY basically flat, QQQ up a little, IWM red. So the indexes are not screaming risk on. But this board, oof, totally different story. IPST still sitting on top, up about 263%, 47.5 million shares traded, relative volume around 940. That's a silly number. IVF right behind it, up 140%, almost 56 million shares. Then you've got EYPT on the ugly side, down 70%. Biotech getting smoked. TRUG still hanging in that momentum bucket too, up about 62. This is why we go board first here at the markets desk. Quiet index tape, chaotic single name tape. Let's pull IPST first, because if a name is doing 47 million shares before the open, I want the 1-minute tape on screen. Current prints right around 798, so basically living just under that big round number area. Craft Spirit's name, tiny market cap around 5.8 million, float a little over 10 million shares, and volume has already turned that float multiple times. Fun? Sure. Clean? Not automatically. That's where the wicks can get nasty. The key for me isn't the headline anymore, it's bid quality after the first squeeze. QQQ's only up 0.25%, and this thing's up more than 260. That's not market beta, that's event flow and trader flow. If buyers keep absorbing near the high area, it stays on the front page. If the bid vanishes, these tiny cap squeezes can turn into an air pocket real fast. Now IVF, this is the next one that has my attention because it's not just up a little bit, it's up about 140%, and the volume is already almost 56 million shares. That's a monster tape for a name with a float under 2 million. So yeah, it can move fast both ways. Current board price is around 233, so I'm watching that low $2 zone like a lie detector. If this thing keeps accepting above $2, fine. The momentum crowd still has something to work with. But if it starts losing that area and the pops get sold immediately, that's where the continuation trade can turn into a trap really quickly. Also note, the dilution risk is marked high here. So this is exactly the kind of small cap runner where the chart matters, but the risk box matters too. Flip it over to EYPT, because this is the other side of the board. Big biotech gap down about 70%, and that is a totally different read than chasing a tiny float runner. Price on the board is about 434, volume a little over 5 million, so there is real trading here. But the question is simple. Can it reclaim 450, or are sellers still leaning on every bounce? Right now, with the last print under that level, I'm treating 450 as the line that needs to be proven. If it can't get back above and hold, then rallies are just relief candles inside a broken gap down. If it does reclaim, then at least you can say the selling pressure is cooling for the moment. But on a biotech down 70, you don't assume anything. TRUG next. This is the little momentum reset candidate. You've got True Golf around a buck 57, up about 62%, 25.7 million shares traded, and the relative volume is almost 79 times normal. Float is tiny, just over 1 million shares. So this is one of those charts where it can look perfect for 2 minutes and then completely air pocket. The buck 60 area is the scorecard for me. That level already got tagged, so now it's simple. Are buyers building under it, or was that just the breakout wick? If it can reclaim 160 and actually hold above it with real volume, that's strength. If every push into 160 gets stuffed, then it's more of a lower high fade than a clean momentum continuation. Now, MYSZ, different type of move but same small cap rules. My size is around 388, up about 31%, 6.2 million shares, 41 times relative volume. Float's a little over 4 million, so yeah, this can move, but it can also fake out hard. $4 is the level everybody can see. I don't love chasing a candle directly into 4 on a name like this because round numbers invite that push through, slap, and pullback. What matters is the reaction after the first test. If 4 starts acting like support instead of supply, okay, the tape has changed. If it rejects there and can't reclaim, then you respect that and don't pretend the spike is still clean momentum. Alright, Markets Desk is back on the movers board. Cash open is basically on deck, and this board is not subtle. IPST is still the headline, up about 260%, 48 million shares, almost 953 times relative volume. That is ridiculous. Right under it, IVF up 135%, but totally different structure. Tiny float, huge share count turned over, and that one can get whippy fast. Then the ugly side, EYPT down 72%. Biotech damage, still heavy. TRUG is hanging around that 160 area with 80 times relative volume. UCL, SLE, MYSZ, all green, all high-risk small-cap type tapes. And then WETO down the board is actually interesting. Only up 24%, but relative volume over 50. So yeah, broad tape is mixed. Tech slightly green, small-cap soft, but these individual runners are doing their own thing. Select violence. That's the phrase. Let's pull IPST first, because this is the scoreboard name. Quick score check too. That earlier 750 reclaim did trigger, and now the tape has moved the fight up to the big round 8. Price is sitting around 793, up 260%, and the volume is the whole story. 48 million shares versus an average day around 50,000. Oof, that's not a normal gap, that's a full crowd event. Now here's how the Markets Desk is treating it. $8 is the fresh line. If this can actually build above 8 instead of just wick through it, that tells you buyers are still absorbing supply. If it keeps rejecting at 8, then the chase crowd is probably late and the candles can start getting nasty. Also, don't ignore the risk box here. Small market cap, high dilution risk flagged, and this is not a clean large cap trend. It's a momentum name. Fast in, fast out, and the chart has to prove it every minute. IVF is the next one. And this is the classic tiny float, huge volume momentum check. Stocks at 229, up about 135%, but the float is only about 1.8 million shares, and it's already done 56 million shares. So yeah, that tape can move fast both ways. That's more than 30 turns of the float on paper. The part I care about now is super simple. Does the low $2 area keep catching bids, or does this thing start trapping the late chase? High dilution risk is on the board too, so I'm not treating this like some clean institutional breakout. This is a day trader liquidity event. If IVF keeps holding above roughly 210, fine. Momentum still has a pulse. If it loses that low 2 shelf, that's where these can go from runner to oh wow, where'd the bid go?
Thanks, Markets Desk. All right, cash market is live, bell is rung, and the opening read is not risk on everywhere. It's NASDAQ gets the nice shirt, Russell got coffee spilled on it. SPY's basically flat at 776.3. QQQ's up about 0.29% around 733.2. IWM's down 0.43% at 303.8. And VIX is 19.36, barely green. So the first 2 minutes are a split tape. Mega cap growth is still carrying the index. Small caps are being asked for ID at the door. Breadth is mixed, which is exactly what this looks like. Not a broad stampede, more controlled rotation. Out of the gate, the crazy board is still IPST, up almost 300%. IVF up roughly 132%. Trug up about 60%, SLE up 36%. Other side, EYPT is still the warning label at minus 70. Here at the macro desk, the translation is simple. The fun money is moving, but the index money is picky. QQQ already flushed off that 734.3 area from the countdown and towards 732.1. So 732 is the first line where this wobble starts to matter. And on IWM, 303.5 is the underbelly if small cap weakness starts leaking into the broader tape. Now zoom out, because this is where the cross-asset tape starts tattling on the equity tape. Bonds are not exactly rolling out the red carpet. TLT is 81.77, down 0.33%. IEF down 0.09%. So duration is a little soft right as cash opens. TLT is basically sitting on that 81.75 line we flagged. Below that, duration selling gets louder. Dollar proxy is a touch weaker at 28.07. Yen proxy basically flat at 57.60. So FX is not the fire alarm right now. But oil. Oil's the one tapping us on the shoulder. USO is 127.35, up 0.59%, and that's already above the 127 line the macro desk flagged before the bell. If oil stays firm, it keeps the inflation-sensitive part of the tape awake and makes small cap underperformance make more sense. Gold's green too, 402.45, up 0.24%, so there's still a hedge bid. Then crypto's got a little risk pulse. BITO up 0.94%, coin up 0.79%, MSTR up 2.24%. So the story is not panic, not clean euphoria. It's selective risk appetite, with rates and oil acting like the two bouncers at the club. All right, quick macro check. The tiny float fireworks are fun, but the grown-ups in bonds are still standing by the door. Here at the macro desk, the portal is giving you a pretty clean message. SPYs at 775.68, down 0.09%. QQQ 732.71. Up 0.22%. Russell proxy IWM is 304.05, down 0.34%, and VIX is basically asleep at 19.35. So this is not some roaring broad market risk party. It's more like a selective guest list. Large cap growth is getting the benefit of the doubt. Small caps are not. And that lines up with what the markets desk was just seeing in the trenches. A lot of momentum, but not a lot of macro forgiveness. The reason is bonds. TLT's 81.77, down 0.33%. IEF's 92.96, down 0.09%. We don't have the live 2-year and 10-year yield prints on this portal, so the bond ETF proxies are the tell. Duration is still soft, which means rate pressure is still tapping the market on the shoulder like an annoying waiter with the check. Now the outside screens matter, even if you only trade US stocks. Dollar proxy is 28.07, down 0.14%. The yen proxy is 57.60, basically flat and up 0.03%. Gold's 402.45, up 0.24%. And oil's 127.35, up 0.59%. That combo is not random. Softer dollar usually helps risk assets breathe a little, but gold and oil both green says there's still insurance demand in the tape. Geopolitical premium, inflation premium, or both. The daily setup already had the US-Iran strike headlines and the oil spike in the background. So crude here is not just a commodity quote, it's a margin tax with a ticker symbol. If oil stays firm while bonds stay heavy, that's the part of the macro stew that can bother smaller companies, transports, and anything rate sensitive. Then crypto's got a little bid too. BITO 8.58, up 0.94%. Coin 149.65, up 0.79%. MSTR 95.12, up 2.24%. Decent risk pulse, yes, but crypto is still highly volatile and unregulated. And those equity proxies can turn a speed bump into a pothole real fast. Okay, calendar from here is not crazy, but it actually matters. NY Empire hits at 12:30. NAHB housing at 2 o'clock, then tick flows way later at 8 o'clock. Empire is your manufacturing pulse. Fine, but housing is the one I care about for the rate-sensitive trade. Builders, REITs, regional banks, and yeah, small caps. Because when financing costs bite, IWM usually feels it before the mega cap generals do. Tick flows after the close are capital flow stuff. Who's buying U.S. assets? What does foreign demand for treasuries look like? Does the dollar get any backup? That feeds right back into rates. So levels into the next stretch. TLT is sitting 81.77-ish, down 1/3%. I'm watching 82 above as the bond relief line, and 81.50 below if sellers keep leaning on duration. Oil's firm at 127.35, so 128 above is the pressure point. If it backs under 126.50, that cools the inflation impulse a bit. VIX is sleepy at 19.35, but 20 is still the line where people start paying attention. And on QQQ, same thing we saw on the tape. 733.30 is the reclaim. 732.10 is the spot you don't really want to see give way if you're long tech momentum. Bread is mixed, not a clean risk-on day, so respect relative strength when you find it. All right, macro map is set. Let's kick it back to the movers board and see where the real intraday heat is hiding.
Thanks, Macro Desk. Quick paper book check here at the Stock Whisperer. This is the show's simulated paper trading portfolio, and the new line is TSLA, short 30 shares, entry 338.75. Basically flat right now, with price around 338.80, down $1 and change. The setup is pretty simple. Guidance cut headline, stock dips, and I'm treating it as a company-specific catalyst, not a broad market short. Because QQQ is still slightly green on the tape, my defined risk is above the morning reclaim zone. Stop is working at 346.50. If TSLA loses 334 cleanly, that's the continuation level I'm watching. Cover target order is sitting down at 322. So thesis, level, bracket. Rest of the book is steady. F long 600 from 13.85, trading 14.35, up about $302. That one's still working, with the stop already above entry at 13.95. PYPL long 150 from 59.62, now 61.29, up about 251. SPGI short 20 from 424.16, trading 418.60, up about 111. GS short 10 is basically a scratch winner, up $5. The weak one is WDAY, long 50 from 196.51, now 193.99, down about 126, and I'm watching 190 there for support. On the watch list, NVDA above 228, only if QQQ stays firm. TSLA below 334 for follow-through. Calm book, defined exits. Coming up after this, we've got a quick pro terminal look. Thanks, Stock Whisperer. All right, Markets Desk is back on the movers board, and this is still not a clean risk on tape, right? SPY is a touch red, QQQ barely green, IWM down 0.5%, VIX parked near 19. So when you've got IPST up 267% on the board, that is not the market lifting everything. That is pure single name chaos. IPST still number one. IVF still hanging around up 150 plus. EYPT is the ugly one, down 70%. And then the fresh pocket I want to hit is NNNN, Wedo, CBRG. Those weren't the main story 10 minutes ago, but they're creeping up the board. Here at the Markets Desk, we're not chasing green candles blindly. We're checking volume, VWAP behavior, and whether the move is still clean after the first flush. Let's pull IPST first, because the scoreboard matters. That $8 level the Markets Desk flagged earlier, hit. Clean hit. Now the only question is, does 8 become support, or was that just the squeeze topping out into supply? This thing has done 55 million shares already against about a 10 million share listed float. So yeah, volume is ridiculous. But it's also a microcap distiller with high dilution risk showing on the board. So I'm treating every pop like it can snap back fast. Watch 8 now. Above it, bulls can argue they're defending the breakout. Below 8, oof, that turns into failed reclaim tape real quick. No hero stuff on names like this, just levels and volume. IVF next, and yeah, this one is still the classic tiny float squeeze profile. You're looking at about a 1.8 million share float, Nearly 70 million shares traded. Stocks around $2.46, up 150+%. So the question is super simple on the 1 minute. Is it still respecting VWAP, or is this turning into that slow bleed where every pop gets sold? Because with high dilution risk on the board, I don't want to treat green candles here like they're automatically clean demand. If it's above VWAP and volume keeps reloading, fine, the squeeze is still alive. If it loses VWAP and can't reclaim it quickly, that's where these little names can go from fun to nasty in like 3 candles. Now flip the board. EYPT is the pain trade. Biotech gap down, 70% off, and it's doing real volume too. 12 million shares, over 8 times normal. This is where I'm not chasing the first bounce just because it's green for 5 minutes. On these biotech reactions, the bounce quality matters. Are candles actually building higher lows, or is it just a reflex rip into lower highs under that morning breakdown area? Right now, the read is sellers still have the benefit of the doubt until the 1 minute stops rejecting those prior breakdown zones. If it can't get back over where it cracked earlier, every bounce is suspect. That's the difference between a washout bounce and a stock that's still being distributed. NNN is a different kind of gainer than the first two. This isn't the 70 million share chaos tape. This is much lighter volume, about 158,000 shares, but still up roughly 50% and sitting around 13.15. And that matters because small caps are not exactly getting a free ride right now. IWM's off about 0.5%. So when a diagnostics name is holding green like this, you at least respect the relative strength. The company is in vitro diagnostics, rapid testing type products globally, so healthcare instruments, not a pure biotech binary like EYPT. On the chart, I'm treating 13 as the line in the sand. Above 13, buyers are still defending the move. If it starts accepting below 13, with volume this light, that can get slippery fast. Now, WETO. This one has a much louder tape. Webus, software application, mobility services name out of China. And the board number jumps out. 62 times relative volume, almost 2.8 million shares traded. Stock up about 39%, around 11.46. So compared with NNNN, this is way more active intraday. The fight here is super clean. $11 underneath, $12 overhead. That's the whole round number battle. If buyers keep soaking dips above 11, momentum traders are going to keep staring at 12. But if it stuffs near 12 and then loses 11, that's where these low float style movers can turn from clean breakout to trap really quickly. So I'm not chasing the headline percent move. I'm watching whether the tape can actually build above 11 and make a real attempt through 12. Last pass on this board, and then we'll hand it off. STFS first, because this is the quieter green name. It's up about 36%, sitting around 530, but look at the volume profile. 400,000 shares, sub 1 relative volume. So this is not the same kind of crowd as IPST or IVF. Tiny float, yeah, about 1.1 million, and dilution risk shows high. So the move can still get jumpy. But the tape is thinner, spreads matter, and I'd treat that as a different animal than the big volume runners. Now, CBRG is the contrast. This is a shell company, SPAC type name, just under $6. Up about 30%, but the relative volume is massive. Almost 400 times average on 5.3 million shares versus a tiny average volume base. That's the kind of move where the headline may not even be obvious on the board, but liquidity suddenly shows up and the chart can get very mechanical around whole dollar levels. And then quick downside check on GIPR. This is the sub $1 REIT loser, 36 cents, down 26%, almost a million shares, a little over 2 times relative volume. The key thing there is, are sellers still pressing the bid, or does it finally start holding a base? Under $1, liquidity risk is real, spreads can get ugly, and if it can't reclaim those prior intraday breakdown spots, it stays in penalty box mode. All right, that's the movers rotation. IPST was the scoreboard hit, IVF was the squeeze, EYPT the pain trade, and the lower board is giving us the liquidity contrast. Coming up, we'll flip away from the board and get into the next tape read.
All right, quick pit stop. This is the actual toolkit the markets desk is using on air all morning. Pro Terminal. First thing, dilution center. Oof, this matters on these small cap runners. Shelf filings, ATMs, offerings, That's the stuff that can turn a clean-looking squeeze into a rug pull real fast. It's not a buy button, it's risk context. Now back to the board. This is where we've been living during the open. Top gainers, top losers, relative volume, price, market cap when it's there. Look at IPST still sitting up there. Monster percent move, monster relative volume, and IVF right behind it. But again, the board is a scanner. It tells us where the action is. It does not tell anybody what to do. Big difference. Here's the part I like for staying out of trouble. Click into a name and go straight to the filings and insider tabs. I'll use UCL as the example, because this was one of the opening drive momentum names. We're not redoing the trade read here. We already hit that tape. This is the research layer. Recent filings can show financing risk, registered shares, weird corporate actions. Insider pages can show who's been transacting. Sometimes there's a lot. Sometimes there's not much. Either way, you want the source documents close, not 3 tabs buried somewhere else. And then, when the news and filings make sense, we come back to the chart. 1-minute terminal chart. Tape, candles, volume. That's the live read. The key is combining it. Movers board for discovery, filings and dilution for risk. Chart for timing context. Data can be incomplete or delayed, so keep your brain turned on. But yeah, if you want the same dashboard we're using here at the markets desk, go to proterminal.io. That's proterminal.io.
Thanks, Markets Desk. Breaking news first. iPoint just said its experimental wet AMD eye drug missed the main goal in a late-stage trial, and the stock is getting absolutely reset on that. ProTerminal's newsroom is tracking EYPT down about 71%, around $4.21 on more than 10 times relative volume. So this isn't a polite disagreement. It's a pipeline repricing. What we know? The primary endpoint was missed in a late-stage study for wet AMD. Why it matters? In biotech, late-stage data isn't one input. It's the steering wheel. Commercialization path, regulatory timing, and valuation all lean on that endpoint. What we don't know yet from this headline is the next development plan, whether secondary data changes the discussion or how management frames timelines from here. With SPY basically flat and QQQ green, this is very company-specific pressure. Biotech can be macro in miniature, one data line and suddenly duration risk has a lab coat. Next up, Microsoft has the cleanest two-sided AI story on the board this morning. First headline, Microsoft's AI plans may be limited by advanced chip shortages. ProTerminal's newsroom is tracking reporting that points to a gap between the scale of Microsoft's AI ambitions and the actual chip capacity available to run those services. Why that matters is pretty simple. AI demand can be massive, but if the compute bottleneck is real, cloud deployment can only move as fast as the hardware stack allows. And now flip the card, because the other Microsoft headline is still bullish cloud demand. The stock jumped 18% over the past week, after Azure annual revenue topped $100 billion for the first time. So the macro desk read is not, quote, AI is broken. It's more like demand is the gas pedal, chips are the toll booth, and CapEx is the guy asking for exact change. With QQQ up about 0.25%, Microsoft remains a big index swing factor here. Quick small cap wire sweep now. WeTour Robotics announced a share consolidation and a warehouse robotics cooperation agreement, with management estimating a full rollout could generate about $5 million in project-level gross profit. That matters because the market is trying to decide whether this is a real commercial pathway or just another robotics headline in a hot tape. Profusa is next, 1-for-4 reverse split, plus an option agreement to acquire commercial stage diagnostics company G3 Vision Labs. Reverse splits are capital structure housekeeping, not magic, but the acquisition option tells you they're trying to reposition the platform. TrueGolf has a different flavor. Investors face a September 28 deadline in a securities fraud class action, covering purchases from September 2025 to May 2026. That's legal overhang, and legal overhang can sit on a stock even when the intraday chart is noisy. Last one, IP Strategy published a monthly validator update and highlighted the move to the Data Foundation, tied to a Treasury Reserve policy around the Data token. Niche blockchain treasury angle there. Coming up, the deal beat, where the spreadsheets put on a helmet.
All right, let's hit the movers board and reset the scoreboard fast. IPST still sitting on top. IVF right behind it. Wedo has moved up the board hard. And then you've got EYPT on the ugly side, down 70+%, while the tape itself is only mixed. That matters. This isn't broad euphoria. QQQ's green, IWM's still red, VIX is basically parked near 19 and change. So if a small cap is ripping here, it's stock-specific flow. Here at the markets desk, I'm not chasing the headline percent. I want the 1 minute. Does it hold the breakout level, or does it rug after the first liquidity burst? That's the whole game on this board. First one up. IPST. And oof, this is the exact reason we keep score on levels. This thing already gave the big hero move earlier. It cleared that $8 zone. But now the current print is back around 710. So the question is not, is it up a lot? We know it is. The question is, can it stop bleeding under that failed 8 reclaim and build again? Volume is still insane on the day. Tens of millions of shares through this thing. But after a move like that, volume can be both fuel and exit liquidity. Watch $7 now. If 7 snaps, that's where the earlier breakout starts looking like a full failed reclaim tape instead of just a pullback. And with high dilution risk on the name, I'm keeping this clean. Chart first, level first. No love stories. Now, IVF. This is the low $2 squeeze we were talking about. The earlier $2 level already mattered, right? So now the tape has migrated up into that 240, 250 area, and this is where it gets jumpy. Price is around 243, up about 150%, and the volume is massive, 73 million shares on a stock with roughly a 1.8 million float. So yeah, that's tiny float behavior. It can levitate fast, but it can also air pocket just as fast. For me, 250 is the pressure zone. If it keeps stuffing there, that tells you supply is showing up. If it actually accepts above 250, different conversation, but the danger line is still $2. Lose 2, and the whole squeeze starts looking like it's rolling back into the prior breakout instead of building higher. And don't ignore the high dilution tag on this one. That doesn't mean it has to fail right now, but it absolutely explains why these can be nasty if the momentum dries up. Flip Wedo now. Because this one's a totally different personality. Not the $2 penny squeeze. This is a mid-teens expansion move. And the big thing is it already cleared that $12 area and then kept stretching. Current print's around 1488, up 81%, and relative volume is ridiculous, about 94 times normal volume. So the market is paying attention. But look where it's pressing, $15. Round number, obvious magnet, obvious rejection spot too. If it keeps wicking through 15 and snapping back, that's not cleaned. What I'd rather see just from a tape quality standpoint is 14 start acting like support instead of a trap shelf. If 14 holds on pullbacks, okay, buyers are still defending the expansion. If 14 cracks and it can't reclaim, then this mid-teen chase gets a lot more suspect. Still active tape, but you've got to respect how fast these post-breakout names can reverse. Now, hit EYPT on the other side of the board, because this is the ugly one. Biggest loser, biotech. Down a little over 71% at about 423. And this is where the read is totally different from the squeezes. I'm not asking, can it keep ripping? I'm asking, is the bounce real? Or is every bounce just getting sold into another lower high? Volume's not fake here. 15.2 million shares, about 10 times normal. So there are real hands in it. But with a biotech gap down like this, we've got to separate a dead cat bounce from actual repair. $4 is the big danger line underneath, just because it's clean and psychological. Above, I'd want to see it reclaim that 450 area and actually hold a pullback, not just wick into it and fail. If it keeps making lower highs below that, sellers are still driving the bus. All right, flip TRUG again. This is that tiny float tech mover, and this one can move fast both ways. Price is sitting around $1.57, up roughly 62%. With 33 million shares traded versus a float just over a million. So yeah, the squeeze mechanics are obvious. The whole battle is that 150 to 160 band. If buyers are defending in that zone and VWAP is being respected on the 1 minute, then the tape is still active. But if 150 starts slipping and the bids stop refreshing, that's when these tiny float names can go from controlled pullback to air pocket real quick. I don't love chasing when it's already stretched. I'd rather see whether that band keeps acting like support or turns into resistance on the next pop. Last one on the chart tour, pull up PFSA. This is up about 45%. Healthcare name, but totally different read than IPST or IVF. Look at the volume line here. Only about 75,000 shares showing right now. And yes, the board has relative volume at 0. I would not overread that as nobody cares. A 0 there can just be a timing or session volume thing. The bigger point is liquidity. Tiny float, around 600,000 shares, high dilution risk on the board, and current volume is light. So this is the kind of name where the spread and the liquidity matter more than the headline percent move. It can print green on the board and still be a brutal trade if the tape isn't actually active. Now back to the board for the cleanup. CDTG is still a real mover, up around 37% with about 465,000 shares and nearly 7 times relative volume. That's more believable activity. STFS has the cleaner share count story on the tape today, about 1.4 million shares and up 35%, but it's still a small float, high dilution risk name, so don't get lazy there. NNNN up 29%, 328,000 shares, roughly 7 times relative volume. Decent scoreboard, but that one can drift if the bid disappears. So the takeaway from this whole board, IPST, IVF, WITO, TRUG, had the loud tape. CDTG and STFS still deserve a glance. PFSA and NNNN, I'd be way more picky about liquidity. All right, coming up next, we'll flip off the pure movers board and hit the next story set. All right, markets desk, let's reset the movers board. QQQ is still a little green. IWM still lagging. Breadth is mixed, so I'm not treating every green small cap like clean risk on. Top of the board, IPST still up 228%, but now back near 722 after that earlier $8 hit. That's the scoreboard change. IVF still huge, up about 150%. WETO holding an 89% move. Then you've got EYPT, the absolute rug pull loser, down 71%, and TRUG up 55%. Fast board, ugly spreads, big volume pockets. We're going chart by chart now, no wasted board staring. Let's pull IPST first, because this is still the loudest thing on the board. 58.5 million shares already, versus about 50,000 average volume. That's ridiculous relative volume. Over 1,100 times normal. Price is $7.22 right now. And here's the thing. The markets desk already scored that $8 break earlier, but if it can't reclaim 8 now, this starts looking more like failed breakout tape than clean continuation.
Oof, look at how jumpy this thing is. I want volume confirming any push, not just one candle poking its head up. Also, high dilution risk is tagged on IPST, so if the bid thins, these can air pocket fast. For me, 8 above is the reclaim line, and 7 below is where sellers can start leaning on it again. IVF next. And this is the one where I want everybody to separate the headline percentage from the actual tape. Stock's around 240, up basically $1.50%, but look at the share count dynamic here. Tiny float, about 1.8 million, 75 million shares traded. So yeah, there's activity, but at that size that can turn into churn really fast. High dilution risk on the profile too, so this is not a clean, oh it's up big, therefore it's strong read. For the 1 minute, I'm watching whether buyers keep reclaiming that 240 area and then actually accept above 250, or if every push just gets slammed back into VWAP. If it's just candles whipping through the same zone on monster volume, that's not clean momentum. That's supply meeting demand in real time. Now, WITO, different personality here. This one's not a $2 microcap, it's sitting in the 15 handle, up almost 90%, 5.3 million shares, and the relative volume is huge versus what it normally does. The question on this chart is control. When a name extends into a fresh handle like this, I don't care that it's green. I care if the bid is walking it higher in a controlled way, or if we're getting those nasty air pockets candle to candle. $15 is the line that matters psychologically now. If it keeps holding above 15 and dips get bought quickly, okay, that's still controlled momentum. If it loses 15 and starts snapping around under VWAP, that's when the character changes from trend to whippy chase zone. EYP team now. And yeah, totally different read,
because this is the big red name on the board. Down about 71%, trading around 428 with 17 million shares already through it. So this is not some quiet drift lower. The only thing I care about on this one right now is bounce quality. After a drop that nasty, the first green candle is not automatically strength. I want to see, does it reclaim and hold the 430 area? Do dips get bought? And does volume actually expand on the push instead of just dying out? If it keeps rejecting into 450, that's usually telling you the bounce is just supply getting sold into. So for EYPT, clean read. Under 430, it's still damaged tape. Above 450, at least the bounce has a little structure. TRUG next. This is the one that can get spicy fast, but also trap people fast. Stocks right around $1.50, up about 55%, and look at the volume, 34.7 million shares, against a float listed around 1.07 million. That means the float has turned over a ton already, and relative volume is 106 times normal. Great for liquidity on the way up, but it also means if buyers step away, there may be no gentle exit. Medium dilution risk on the board. Tiny market cap, tiny float. So halt risk, rug pull risk, all of that has to stay front and center. For the tape, I'm treating 150 as the pivot. Holding above it keeps the momentum crowd interested. Losing it and failing to reclaim is where this starts looking more like a squeeze pop that's running out of oxygen. SLE, now, this is the clean little line in the sand for the lower board. Stocks around 309, up 36%, about 16.9 million shares, and the relative volume is legit at 26 times normal. So I'm not calling this dead tape yet, but the prior $3 push has to matter. Above 3, okay, buyers are still trying to defend the breakout area. If this starts living back under 3, that's when it turns into a failed momentum pop instead of continuation. And remember, tiny float here, about 1.6 million, plus high dilution risk, so this can whip both ways fast. Now CDTG, this is a quieter chart, around 270, up 29%, 900,000 shares, but the relative volume's actually better than WOK at 13 times normal. That's the kind of thing I care about more than just the percent green. WOK's also up 29%, trading around 287, almost 2 million shares, but only about 3 times relative volume, so that feels more like lower board participation than a true leader unless the tape starts expanding. So quick grade, SLE is the one with the actual $3 battle. CDTG has the cleaner relative volume argument. WOK needs more proof. Alright, movers board is reset. We've got the names, we've got the levels. Let's flip forward and hit the next tape check.
Thanks, Markets Desk. Quick macro check, because the small cap circus only makes sense if we know what the ringmaster is doing. The macro line on the board is NY Empire Manufacturing, 20.6 versus an 11 estimate. That's a real beat. Now, it does not mean we all get to cosplay as the Fed chair from a folding chair, but it does tell you the growth impulse is further than expected. And the market reaction is very specific. SPY is sitting around 775.43, down 0.12%. QQQ is green at 733.02, up 0.27%. IWM is the weak kid in the group at 303.80, down 0.42%. And VIX is basically asleep, 19.31, down a hair. So this is not broad risk on. This is selective risk on. Big growth gets a pass, small caps do not, which is usually the market saying, nice data, but what does that do to rates? And the cross-asset tape backs that up. Bonds are a little heavy. TLT at 81.81, down 0.28%. IEF at 92.99, down 0.06%. That's the rates complex leaning tighter, not screaming, but leaning. Dollar proxy is actually softer. UUP at 28.08, down 0.12%, and the yen proxy FXY is basically flat at 57.59. So if you only trade US stocks, keep one eye on bonds and FX here. They're the plumbing, and nobody notices plumbing until the basement floods. Gold is bid. GLD 403.54, up 0.51%, and oil is still firm. USO 127.07, up 0.37%. That 127 oil area we flagged earlier got tagged, and we're still hanging around it. Crypto risk sleeves are also bid. BITO up 1.06%, Coin up 1.23%, NSTR up almost 3%. Volatile corner? Absolutely. But as a mood gauge, it's saying risk appetite is not dead. It's just being picky.
Thanks, MacroDesk. Let's go right to the simulated paper book and clean up risk before we do anything new. This is the Stock Whisperer desk, simulated 100K account for the broadcast. And the rule is simple. Thesis, level, defined risk. The tape's mixed. QQQ barely green, IWM lagging. So this is not where I want to get loose. Quick scan of what we're carrying. Ford is working. Long 600 shares from 1385, trading 14,165, up about $189. PYPL is also green. Long 150 from just under 59.62, now 60.765, up about 172. SPGI is the cleanest one on the board right now. Short 20 from 424.155, last 414.025, up about $200. So we've got some winners doing their job. No need to touch those just because the screen is moving. Now, the cleanup item is GS. This is the one I care about most. We're short 10 shares from 1038.24. It's trading around 1050.22, so it's against us by about $120. Not terrible, but the problem is not the P&L. The problem is the risk line. The last protection attempt didn't stick, and I'm not going to leave a 4-digit stock short without a visible stop. The thesis is still the same. If GS stays under the morning reclaim zone, the short can keep working. If it reclaims and squeezes above 1062.50, the idea is wrong in this book. So I'm not adding size here. This is important. I'm selecting the existing GS short and attaching the bracket. Stop loss at 1062.50. Take profit sitting down at 988. That gives the trade a defined ceiling if buyers take control, while leaving the original downside target intact if financials keep rolling over. Calm execution. No chasing, no averaging, just fixing the risk box. All right, that's the one I wanted. GS is now the defined risk short again. Stop above 1062.50. Profit order at 988. If it stops, it stops. We take the hit and move on. If it fades, we already know where the cover order lives. That's the whole point of doing this live. The Stock Whisperer isn't trying to be right on every trade. I'm trying to make sure the wrong trades don't get unlimited room. Now I'll check the two that are actually demanding patience. TSLA is the new short from earlier, 30 shares short at 338.75. Last 339.54, down about $24. That one doesn't need a panic click. The level I care about is still 336 underneath. Below 336, the short starts proving itself. WDAY is the week long, 50 shares from 196.51, last 194.11, down about 120. I'm not adding to that just because it's red. If the thesis improves, it'll show up in the tape first. If it doesn't, we respect the bracket and stop arguing with price. Last thing on the watch list, MSFT is still a headline name, but I'm only interested in the reaction bands. Below 482 if pressure follows through, above 488 if buyers absorb it. NVDA is still 228 to the upside, but only if QQQ stays firm. So the action here was risk hygiene, not a new bet. Coming up, we've got the M&A desk taking the deal beat. Thanks, Stock Whisperer. Let's swing over to the company desk and clean up this Apple headline. This is coming through the company news lane. But important distinction, this is not an M&A deal. No cash terms, no stock swap, no ARB spread to calculate. It's a street re-rating story. Rothschild & Co. Redburn taking Apple to buy from neutral with a $400 price target tied to the foldable iPhone idea and a possible AI strategy shift. Okay, so what does this actually change? The bull case they're leaning into is not just Apple makes another phone. It's the possibility that a foldable device creates a new premium replacement cycle. Higher-end hardware, higher average selling price, maybe a reason for people sitting on older iPhones to finally upgrade. That's the story. But here's the company desk skepticism. A planned launch is not the same thing as shipped volume. Apple still has to prove the form factor, the battery life, the durability, and whether consumers see it as must-have or just expensive and interesting. Now, flip it to the tape, because Apple matters beyond Apple. We've got QQQ green, while SPY is basically flat to red, and breadth is mixed, so mega cap leadership still matters this morning. If Apple catches a bid on a headline like this, it can help the index tape even when small caps are lagging. I don't have a fresh structured candle read in this packet, so I'm not going to invent intraday levels. But the thing I care about on the live chart is simple. Does the market treat this as a real product cycle catalyst? Or does it fade as just another analyst note? Big difference. And the AI part is the other piece. Apple's AI story has been judged pretty harshly versus the rest of big tech. So a shift there, if it turns into actual features that drive upgrades or services engagement, would matter. But again, that's the if. For now, this is an analyst's view, not a confirmed business inflection. So for AAPL today, I'd frame it as narrative support for the mega cap tape. Not a deal spread, not a done deal, and not a reason to chase a headline blindly. Coming up, we'll kick it back toward the movers board and see where the real volume is still hitting.
Thanks, company desk. All right, markets desk, let's hit the movers board. This board is loud again. SPY basically flat, QQQ a little green, IWM red, so this is not some clean everything rips morning. These are single name momentum pockets. Top of the board, IPST still ridiculous, up about 206%. IVF up 150. WETO still holding a monster move, up about 105. Then the ugly one on the other side, EYPT down 71%. Oof, that is a totally different tape. Not momentum, that's repricing. So here's how we're doing it. Board first, then 1-minute charts. No wasted words. Volume, levels, who's holding, who's fading. Okay, pull up IPST first. This is Heritage Distilling, tiny market cap name, craft spirits. But today, nobody's trading the whiskey story. They're trading the tape. Price is around $673, up over 200%, with about 62 million shares done, and relative volume over 1,200 times normal. That is insane activity for a name with a roughly 10 million share float. Here at the markets desk, I'm watching this like a pure momentum vehicle, not a fundamentals debate. The live line for me is 650-ish. If it starts living below 650, that tells you the late momentum crowd is losing control. If buyers can keep reclaiming the upper sixes, call it 690, then shorts and trap sellers stay under pressure. But this has high dilution risk data on the platform, so yeah, respect the speed both directions. Now, IVF, this is the one where the volume number is just insane versus the actual float. IMVO Fertility, $2.40-ish stock, up about 150%, and it's traded over 83 million shares against a float listed under 1.8 million. So that is not just active. That's the float turning over again and again and again. That can create real squeeze tape, but it also creates trap tape, because once the bid disappears, these can vacuum down fast. And yeah, dilution risk is marked high here, so I'm not treating this like some clean institutional breakout story. For the 1 minute, I want to see whether it's building above that 240 area or if every push into 250 just gets sold right back into. If buyers keep defending 240, fine, that's momentum still alive. If it loses that and can't reclaim, that starts looking more like distribution after the burst. WETO, next. Totally different price zone, but same idea. Was this just the earlier squeeze, or is it still holding bid? Webis is around 1680, up a little over 100%. And the relative volume is wild, 200 times normal volume on just over 9 million shares traded. Float's about 5.7 million, so this is active enough to matter, but not the same microscopic float setup as IVF. On the 1 minute, I'm watching whether 16 holds as the line in the sand. If it's holding above 16 and reclaiming 17 on volume, the squeeze is still alive. If it starts making lower highs under 17 and volume dries up, that's usually the distribution look. Big move already happened. Late buyers get chopped and the tape stops rewarding breakouts. Flip to EYPT because this is the other side of the movers board. iPoint's not a momentum chase today. This is a biotech getting absolutely repriced after the trial failure headline. Price is around 421, down about 71%, and the volume is huge, 20 million plus shares, roughly 14 times normal. So the bounce attempts here are important, but they're not the same as strength in IPST or IVF. This is damage control tape. On the 1 minute, I'm watching how every lift gets treated. Are buyers actually building higher lows, or is supply just smacking it back down into the prior flush zone? $4 is the obvious psychological line underneath. If that starts leaking, that tells you sellers are still in control. If it can stop making lower highs first, then maybe it stabilizes. But right now, selling pressure is still the story. Now, TRUG. This is True Golf, and this is back into low-dollar momentum land, around 158, up 63%, but look at the setup. Roughly 37 million shares traded, against a float a little over 1 million. That's why this thing can whip around like crazy. Relative volume is over 113 times normal, so the crowd is here. The question is whether buyers are actually defending this breakout area, or if it's just a quick squeeze that rolls. For me, 150 is the clean line to watch underneath. If dips keep getting bought above that, the bid is still alive. Above 160, you want to see volume actually expand, not just a little wick and fade. And because it's tiny float, low market cap, medium dilution risk, you've got to respect the rug pull side of it.
Thanks, Markets Desk. Breaking here from ProTerminal's newsroom. Microsoft stock jumps after Azure revenue tops $100 billion. What happened is pretty clean. Azure's annual revenue has crossed that $100 billion mark for the first time, and the stock is reacting sharply because that reinforces the cloud and AI growth story. What we don't know yet from this headline is the part the macro desk always wants: margins, capex intensity, and how much of that growth is durable versus pulled forward by AI demand. Market read: QQQ is green, around 731.9, while SPY is slightly red, around 775.3. So this is not some broad everything rally. This is megacap cloud doing the heavy lifting. The cloud, apparently, is still a very expensive landlord. Staying with Microsoft. Second headline: the desk is tracking questions around whether Microsoft's AI plans are being held back by a shortage of advanced chips. That matters because the Azure milestone says demand is real, but the chip story asks whether supply can keep up with that demand. For investors, that's the whole AI infrastructure debate in one sentence. Software revenue wants to scale like a cloud chart, but the physical world still needs GPUs, power, data centers, and time. With TLT down at about 81.78, the market is not exactly handing out free patience to long-duration capex stories. AI may be magic on the demo screen, but the servers still need actual silicon for breakfast. And then, the counterweight in megacap land. Apple's red flags are back in focus, with the analysis flagging valuation concern around Apple at $305.93 despite the recent optimism. The important bit here isn't just Apple by itself, it's leadership quality. If Microsoft is carrying the cloud side and Apple is getting questioned on valuation, then the tape can look stable at the index level, while underneath it gets more selective. That's the macro desk read. Not panic, not euphoria. Just a market choosing its favorites with a clipboard and a bad attitude. Coming up, we'll kick it back toward the movers board and see who's actually getting paid on the tape.
Thanks, macro desk. Quick NXGL hit because this chart is ugly but active. We're on the 1 minute. Board has it around 38 cents, down about a third, while IWM is red too, so small cap tape is not helping. It opened near 50 cents, chopped tight, then oof, look at that breakdown. From about 48 cents into 30.7 cents, and that came on real volume, not ghost prints. Now it's bouncing off the low, pushing through that 35.5 cent shelf into the high 30s. I don't have a clean VWAP print in this feed, so here at the markets desk, I'm using structure. Above 35.5 keeps the bounce alive. Lose that, and this starts looking like a lower high fade again. Now hit the risk side for a second. NXGL is a 3-ish million market cap healthcare microcap, float around 7 million. Volume already about 800K against a 76K average, so the tape is loud. But the dilution page is loud too. High overall risk, active shelves, active equity line, about 18.3 million raised over the last 12 months, and runway under 2 months in the data. So yeah, the bounce is real, but this is not the clean happy runner type. Low dollar names can halt, wick, dilute, and pump and dump trap both sides. Back to the chart. 30.7 cents is the must-hold low for the scoreboard. If that cracks, the bounce story is gone. Quick hit, done. Coming up, we roll right back into the movers scan. All right, let's hit the movers board. Markets desk wants the tape, not the storytelling. SPY is a little red, QQQ barely green, IWM lagging, so this board is its own universe right now. IPST still top of the stack, up over 200%. Weto's still huge, up about 139. IVF, Trug, PFSA, all still sitting on the gainer side. And then EYPT, oof, that's the damage name, down basically 70% with real volume. So this is not one clean risk on board. It's squeezes, repricings, and low float chaos. First one up, IPST. Look at the participation here, 63 million shares already, against an average volume around 50,000. That's not elevated, that's totally detached from normal tape. Relative volume over 1,200 times. Price is sitting around 685, still up more than 200%. And this is exactly where the markets desk starts separating momentum from late chase noise. I'm not going to rehash the same earlier lines, but right here, $7 is the clean psychological spot. If this thing can chew through 7 with actual volume behind it, that tells you the squeeze is still being defended. If it keeps rejecting just under there, then you can get those nasty small cap wicks where the late buyers get trapped fast. Also remember the structure. Tiny market cap, high dilution risk showing in the data. Small cap spirit name, this can move violently both ways. We're reading the tape, not worshiping the percentage gain. Now Weto, this is the cleaner squeeze name on the board after IPST. We're at about 1962, up 138%. And the crazy part is the volume. 11 million shares versus a normal day around 45,000. That's 246 times relative volume. So yeah, the tape found this thing. Float's about 5.7 million, so it does not take a ton to move it. But at this price, you also get those nasty $2 candles if the bid disappears. For me, simple read. $20 is the obvious magnet/test. If it keeps absorbing under 20 and doesn't instantly reject, that's still squeeze behavior. If it loses 19 and starts printing lower highs, then that's where the earlier momentum crowd can get trapped. IVF next. And this one is more dangerous, but it's also where the share turnover is just absurd. 220 on the print, up 126%, 86.7 million shares traded, and the float listed here is only about 1.8 million. So you're talking many rotations of the float already. That can mean real momentum, but it can also mean distribution into strength, especially with high dilution risk showing on the board. So I'm not treating this like some clean blue chip breakout. I'm watching the $2 area first. If $2 keeps holding on pullbacks, the crowd still respects it. If it breaks 2 and can't reclaim, that's usually when these low float healthcare runners start feeling heavy. Above 250 would be the next place I'd want to see actual volume confirmation, not just one wick and a rug pull. Trug now. This is that low dollar momentum lane. And this is where I'm really watching continuation versus wick fade. It's $1.76, up about 81%, but the important part is the tape. 41 million shares on a name that normally does roughly 325,000. That's 126 times relative volume. So yeah, people found it. Float's tiny too, just over 1 million, which is why these candles can look clean for 30 seconds and then just rug. For me, the tell is simple. Does it keep accepting above that 175 area, or do we start seeing candles pop, wick, and fail right back under it? If Trug can build above 180 with volume still hitting, that's real momentum. If it loses 170 and volume dries up, that's where the chase starts looking tired. Flip to the other side of the board. EYPT is the ugly one. Biotech repricing, and it's not a little haircut. 443, down basically 70%, with 22 million shares traded against about 1.4 million average. That's heavy downside participation, not just one random print. So the question here isn't, is it cheap, The question is, are sellers still controlling every bounce? I'm watching that 440 area like a floor test. If it keeps basing there and the candles stop making lower lows, maybe the tape starts to calm down. But if 430, 425 starts leaking, that tells you the floor is still not real yet. On these biotech gap downs, the first bounce can look tempting, but the sellers usually have to prove they're done before the chart matters again. SLE next. This is the mid-board one I actually want to respect a little more, just because the participation is real. 324-ish, up 43%, 18.5 million shares, almost 30 times relative volume. That's not sleepy, but it's also a tiny float name, about 1.6 million in the float, and the dilution tag is high. So yeah, chart first, trust nothing long-term. What I'm looking for here is whether this is still stair-stepping, or if it's just recycling volume under the morning highs. If SLE keeps holding above that $3 area, momentum traders are still paying attention. If it starts living below there, that's usually when the bid gets a lot thinner. STFS is the cleaner percentage move but less explosive. 516, up 32%, 4.5 million shares, about 10 times relative volume. Same general bucket. Small float, China-linked marketing name, high dilution risk on the board, so I'm not falling in love with it. For STFS, $5 is the obvious line on the tape. Above it, it still looks orderly. Below it, it can get slippery fast, because these lower float names don't always give you graceful exits. Quick cleanup down here. PFSA is up 88%, but the volume profile is thinner compared with the top names, so liquidity sensitivity is the story. And XPON, 29% higher, 5.6 million shares, more of a lower board follow-through name than the main event. So reset the board. IPST was the monster volume leader, Wedo the cleaner squeeze, IVF and Trug the dangerous turnover names, EYPT the blow up on the downside. Alright, movers board is set. Coming up, let's flip into the next beat and see what's driving the broader tape.
Alright, quick pit stop. Everything the markets desk is using on this tape is ProTerminal. This movers board right here is where we keep score. Biggest gainers, biggest losers, price, relative volume. The stuff that tells you where attention is actually going. It's not a buy button. It's a research starting line. Then when something is cooking, boom! We jump straight to the 1-minute chart. IPST's been the board leader today. So this is the workflow. Board first, chart second, volume and levels right away. You're not guessing off the headline. You're looking at the actual candles, the wicks, the volume bursts, the feigns. Oof, that's why I like having the chart one click away. And here's the part that matters on the small cap side. Dilution. If you trade runners and you don't check shelves, ATMs, offerings, warrants, you're flying blind. ProTerminal's Dilution Center is where we check that risk fast. Same idea with SEC filings and insider activity. What did the company actually file? Who's selling? Who's buying? What's real versus just noise on the tape? Data can be incomplete or delayed sometimes, so you still think for yourself. But having it all in one place saves a ton of time. So yeah, movers, charts, dilution, filings, insider trades, all the stuff we're flipping through live on the show. It's for self-directed research, educational only. And risk is still risk, especially in these fast small cap names. If you want the same setup on your screen, sign up at proterminal.io. Coming up, we're right back to the movers board.
Alright, markets desk back on the movers board. Quick speed check, because the tape is mixed, but this board is not quiet. SPY's a touch red, QQQ's green, IWM's heavy, VIX pinned around 19. So when you've got names like IPST, WETO, IVF, TRUG still flashing up here, that's not broad market beta. That's pure small cap flow. Look at the split too. Monster green on the top side, but EYPT and ZTG are absolutely wrecked on the downside. So this is not just chase the green. We're checking who's still holding bid, who's just wicking, and where the fades are getting paid. Let's pull IPST first. This is still the volume king on the board. $7.60, up about 245%. And yeah, the earlier $6.90 line already got tagged. Scoreboard got that one. Now the question is different. Can it actually build above the mid-sevens? Or is this where the bid starts turning into exit liquidity? I'm watching $7.50 right here as the quick line. If it keeps reclaiming that area after dips,
momentum traders stay interested. If it starts losing $7.50 and can't pop back through, oof, that's where these low float runners can get slippery fast. Above it, the obvious magnet is $8. Not a prediction, just the next clean round number everyone can see on the ladder.
Now, Weto. This is the follow-through name from that earlier $17 flag. And yeah, that one got tagged clean. We're sitting right near $20 now, up about 140%. 11+ million shares traded, and the float's only about 5.7 million. So this is exactly where the candles can get nasty. The whole game here is 20. If it reclaims 20 and actually holds it with volume, okay, momentum is still alive. But if this starts poking over 20 and leaving those big upper wicks, that's blow-off behavior. That's the crowd arriving late into a whole number wall. I'd also keep an eye on 1950 underneath. Lose that, and the tape can get slippery fast on a name this extended. IVF next, and this one is still wild. 227 last print on the board, up about 134%, but look at the volume. 87, almost 88 million shares on a stock with under 2 million in the float. That's why the $2 level mattered so much earlier. If 2 keeps defending, the bulls are still in the fight. If 2 breaks, this can turn from momentum to unwind really quickly. Upside, 250 is still the clean line, not because it's magic, just because that's where a lot of trap chaser psychology shows up. Through 250 with real volume, continuity gets more believable. Stuffing under it, especially with high dilution risk on the profile, and it's just a scalp pop tape. So IVF is active, no doubt, but it's also one of the more dangerous names on this board. TRUG's next, because that 170 line is still the tell.
TRUG now. This is the one I want to slow down on for a second, because it's not as extended price-wise as IPST or WETO, but the volume is nuts for the float. Board showing 171, up about 76%, 45 million shares traded, and only about a 1 million share float. So yeah, this can whip. The level is still 170. If 170 keeps defending on these 1-minute pulls, that's the line where dip buyers are still showing up. But 180 is the real test for continuation. I don't want to see a little wick through 180 and then no follow-through. That's just a scalp pop. Real continuation needs volume to expand as it clears 180 and actually hold above it for more than one candle. Flip to EYPT on the downside. Totally different tape. This is the biotech gap down name. Last print around 447, down basically 70%, and it's doing over 23 million shares, so it's liquid, but it's heavy. The first thing I'm checking is whether 440 is actually stabilizing or if it's just pausing, because the first wave of selling cooled off. If 440 keeps getting reclaimed and held, okay, maybe the panic is finding a shelf. But if 425 starts acting like the seller control line again, meaning pops into that area fail, or it loses it clean, then the downside tape is still in charge. With these biotech gap downs, I'm way more interested in structure than trying to guess the news bottom. ZTG, now on the 1 minute, and this is the clean downside check. Board has it at 360, down 63%. But unlike EYPT, the volume is not monster. Only about 106,000 shares, roughly 1.4 relative volume. So this is exactly where I don't want to overstate liquidity. The area I'm watching is that 350-ish shelf. If 350 keeps catching bids, fine, maybe the flush is taking a breath. But if 350 starts cracking below, that's where these thin names can air pocket again. Spreads widen, bids disappear, and suddenly the chart looks worse than the headline move. All right, last cleanup on the board and then we'll pivot. SLE's still active, 320-ish, up 42%, 18 million shares, high dilution risk, so the volume is real, but you still treat the structure with respect. CDTG, 280, up 34%, almost 50 times relative volume. Same deal, nice activity, but high dilution tag, don't get too chasing late candles. NXGL is the weaker one, 38 cents, down 33%, heavy relative volume, and high dilution risk. So that's a broken penny style tape more than a clean momentum story. And PFSA, $6, up 67%, tiny float, but relative volume is basically not confirming on this board print. So I'm not putting it in the same bucket as IPST, IVF, TRUG. That's the movers board. Plenty of action, but the common thread is liquidity first, level second, hype never. Let's kick it out from here and go check the broader tape. All right,
Let's pull up BTAI for a straight candle read, and oof, this is not a pretty tape. Markets mixed, QQQ green, small cap soft, but BTAI is its own problem right now. This thing opened around $1.04, same area as the day high, and it's been walking down all morning. No clean flag, no clean reclaim, just lower highs, lower lows, and sellers leaning on every little bounce.
Here's the key part. The first real damage shows up as price slips from about 103 through 101, and volume actually confirms it. That's what the markets desk cares about, not just red candles with participation. Then it accelerates again to 98, 95, and into that 88-cent zone. You can see these little attempts to base, right? Around 95 cents, failed. Around 88 cents, failed again. That tells you buyers are trying, but they're not getting paid yet. The current fight is basically 86.5 to 87 cents. That's the day low pocket. If BTAI loses 0.865 cleanly, that's the line where the breakdown can get sloppy again. If it wants to repair, first it has to stop making lower highs. And honestly, I'd want to see it reclaim 88 cents with volume before calling this anything more than a bounce attempt.
Thanks, Markets Desk. Breaking from the ProTerminal newsroom. Saudi Arabia's oil giant Aramco has boosted its dividend for the second quarter in a row. What we know? The company is signaling strong cash flow, even with global growth questions still hanging over the energy tape. What we don't have yet on this card is the precise size of the bump versus the prior payout. So we're not going to decorate the Christmas tree before we've got the ornaments. Market read, oil's firm, but not exploding, sitting around 126.93, up about 0.25%. For the energy complex, that says the cash return story is supportive. But the crude tape is still waiting for demand and geopolitics to give it a cleaner direction. Next wire, Fed officials are largely pushing back on the market's recent rate cut speculation. The fact pattern here is simple. The desk is seeing officials keep a cautious policy tone rather than validating the idea of imminent easing. Why it matters. If traders were leaning on easier credit as the cushion under equities, that cushion just got a little thinner. TLT is down about 0.35% near 81.76. IEF is basically flat lower near 92.99, and the dollar's softer around 28.06. So it's not a full risk-off tantrum. It's more like the bond market saying, yeah, we heard you, but we're not throwing a parade. And the third headline, U.S. bank stocks are getting hit by fresh concerns around private credit exposure. This is the macro desk's favorite kind of story. Everyone loved private credit when it was quietly making returns in the corner, and now the market is checking whether the corner has a trap door. The issue is possible spillover risk from non-bank lending back into bank balance sheets and credit conditions. That matters for JPN, BAC, and Citi, but also for the broader tape because tighter credit tends to show up with a lag. SPY is only off about 0.15% near 775. QQQ is still green near 732, and VIX is barely higher at 19.40. So for now, this is a watch item, not a market-wide alarm bell. Coming up, we'll swing back into small cap momentum and see where the tape is actually paying attention.
Thanks. Macro desk.
All right, markets desk is going straight to the movers board. This tape is not broad risk on. SPY red a touch, QQQ green a touch, IWM off almost 0.4. VIX basically flat. So if a small cap name is up triple digits here, it has to earn it. Top row still IPST, up about 220%. Monster relative volume, just ridiculous turnover. IVF right behind it, up 135. Actually bigger raw volume. Wedo still on the board, but oof, look at that. It already gave us that downside hit earlier. EYPT is the ugly one, down 70%. That's repricing action, not a normal dip. TRUG still green big, but the 170 area already got tested and lost earlier. So no board poetry here. We're going chart by chart. Who's still bid? Who's just bouncing into supply? First up, IPST. 1 minute chart. Still king of the board, around $7, up about 220%. 67.5 million shares traded, versus a normal day around 50,000. That is insane activity. But structure matters now. This is not fresh open momentum anymore. This is the second fight. The tape is trying to hold the $7 handle, and that's the live pivot for me here at the markets desk. If 7 gets lost, and it can't reclaim, that squeeze can get slippery fast. We already had the scoreboard hit through 690 and 7 earlier, so now we keep score honestly. Great move, but now it has to prove it. The old 750 and 8 areas are still the upside repair zones, but below 7, that starts to look like late chaser trap risk. Tiny float, high dilution risk, wild spreads. IVF next, and this one is wild on raw participation. You're looking at roughly 89 million shares already, on a float under 2 million. So yeah, this is exactly the kind of small float tape where the chart can look amazing for 10 minutes and then just air pocket. Price is sitting right around 229, 230, up about 135%. For me, the whole read is this 230 area. If candles keep accepting above it, you've still got dip buyers defending the move. If it keeps tagging 230 and rolling back under, that's the first sign the chase is getting tired. And don't ignore the risk box here. Dilution risk is marked high. So even though the volume is huge, I'm not treating this like a clean institutional trend. This is low float momentum, and the tape has to keep proving itself candle by candle. Now Weedo, totally different animal, because this already gave us that downside hit earlier. And now the question is whether it's squeezing back into supply or just bouncing into sellers. Current print is around 1918, still up 130+%, but the key zone is the same, 19 to 1950. I don't need to rehash the whole move, just watch how it behaves into that shelf. If 19 holds and candles keep pressing back toward 1950, okay, shorts are still uncomfortable. But if it can't clear 1950, and especially if 19 starts failing again, that's when the bounce starts looking more like a lower high fade than a fresh leg. Volume is real, 12.8 million shares versus basically nothing average. But after a move like this, volume alone doesn't save it. EYPT now, and flip the mindset here, because this is the big red one on the board. I points around 436, down about 70%. 24 million shares traded, so this is not just some random little fade. This is a repricing event. Biotech name, big damage. And now the whole question on the 1 minute is, are buyers actually defending the mid-4s, or is every bounce just getting stuffed? For me, 435 to 450 is the shelf to watch. If it keeps accepting trades there and stops printing fresh lows, okay, that's stabilization. But if that shelf cracks and it can't reclaim it quickly, sellers still own this tape. Totally different setup than the runners. This is damage control, not momentum. TRUG next. Low float, medium dilution risk, and this one's still active. You've got roughly 47 million shares traded on about a 1.1 million float. So yeah, the rotation is real, but that also means it can get nasty both ways. Price is sitting around 164, up almost 70%, and the recent failure near 170 matters. That's the line where momentum tried to extend and got rejected. So, on this 1 minute, I'm watching whether it can build a real base under that area, or whether it keeps printing lower highs and bleeding back toward VWAP. Above 170 and holding, tone improves. Under that, it's still a low float chop box with trap risk. Quick, lower board hits to finish this thing off. OSRH first. This is a 46-cent stock, up about 45%. 37.5 million shares. But it's a healthcare blank check style name with high dilution risk. So I don't want anyone treating this like some clean large cap breakout. For me, the whole read is simple. Can it reclaim 50 cents and actually hold it? Or is this just volume cycling under a round number? Under 50, every push can get faded pretty quick. WFF now. Industrial machinery, $2 stock. Up about 41%. Small float, about 1.6 million. But only around 587,000 shares traded. So yeah, it's moving, but it's not the same raw participation as IVF, TRUG, or SLE. $2 is the line I'd keep on the screen. Reclaim and hold above 2. Okay, the tape stays interested. Lose that, and this can get thin fast. Board reset into the close here. ZTG, I'm not calling momentum. Down 63% on barely 100,000 shares. That's more caution tape than opportunity tape. PFSA is green 46. Tiny float, high dilution risk. But the relative volume read is ugly versus its normal flow, so that's trap risk for me. SLE is the cleaner lower board name. 315, up about 39%. Almost 19 million shares. 30 times relative volume. Still high dilution risk, but at least the participation is real. So lower row ranking. Cleanest participation is SLE. Most reclaim dependent are OSRH and WFF. Biggest traps are PFSA and ZTG. Alright, WFF just lit up the small cap board. So let's go straight to the 1 minute. This is the market's desk kind of chart. IWM's red, breadth is mixed, and this thing is trying to go vertical. Tiny float name though. Fast tape. Respect the speed. Oof, look at that ramp. WFF opened down around 1.41, did basically nothing early, then the tape changed once it got through 1.50 and especially through 1.60. That's the first real shelf. Then the big volume shows up. 1.68, 1.80, into that 1.95 pocket, and from there it's not grinding, it's launching. Straight shot into 2.94, day high, with volume confirming the move. So the level map is simple. Above 2.94, that's the high of day squeeze line. Below 1.95, you're losing the top of the launch zone. And if this ever gives back 1.60, that's no longer clean momentum. That's a failed spike. Right now, it's extended. Not broken. Extended. Now, quick risk check. Because this is where people get smoked in small caps. WFF is not some giant liquid industrial. It's a Malaysia-based fiberglass products company. Roughly a $5.3 million market cap. And the float shown here is about 1.6 million shares. That is squeeze fuel, but it's also air pocket fuel. Dilution center is flashing high risk. Active shelf, active equity line, 8 total offerings listed. Then on the news side, the recent stack includes that April 1 for 5 reverse split and investor investigation headlines. So yeah, the chart is hot, but this is exactly the kind of name where halts, sharp fades, dilution overhang, and pump and dump style action have to stay front and center. Back to the chart. Here's the scorecard. Volume confirmed parabolic spike. Current high around 2.94. Real relative strength versus a soft small cap tape. But stretched. Very stretched. VWAP is the referee here, and I'm not going to fake a print. The hard levels we've got are 2.94 up top, 1.95 as the launch zone check, and 1.60 as the real support from the build. If the bid keeps defending the upper range, fine. Momentum stays alive. If it starts accepting under that launch zone, that's how these turn from ripper to trap. Coming up, we'll kick it back to the movers board. Alright, markets desk back on the movers board. We're going fast, top to bottom, levels only. Tapes mixed here. QQQ barely green, IWM red, VIX basically sitting there. So when you see these tiny names up triple digits, that's idiosyncratic heat, not broad market beta. IPST is still the headline, plus 238, 68.8 million shares, relative volume over 1,300 times. Absurd. IVF actually has the heavier raw print, 90 million shares, plus 130, tiny float, high dilution risk on the sheet. So yeah, spicy tape. Weedo's still holding a monster board spot, plus 126, around 1857. Then WFF doubled. TRUG is still green, but slipping around that prior pressure area. And EYPT is the ugly one, down 71%, 25 million shares. So ranking this by liquidity and clarity, IPST first, IVF second, Weedo third, then we hit the downside read in EYPT. Pulling IPST on the 1 minute now. This is the scorecard name. We already scored that earlier loss of 750, so now the reset is clean. Price is sitting around 743. Can it reclaim 750 and hold? Or does every bounce get stuffed? Look, 68 million shares against roughly a 10.2 million float means this float has turned over multiple times. That's electric, but it's also slippery. High dilution risk on the sheet too, so this is pure tape read territory. For me, 750 is the upside repair line. Above that, the squeeze still has buyers willing to pay up. If it starts losing the 7 handle again, the thing gets sketchy fast. No hero call here. Make the 1-minute candles prove it with volume. IVF up next, and this is actually the raw volume monster on the board. We're talking about 90 million shares already, stock sitting around 224, up about 130%, and the float is tiny, under 2 million. So yeah, it can move, but this is also high dilution risk. So don't treat this like some clean institutional breakout. For me, the reset is super simple. 230 is the reclaim. If IVF can get back above 230 and actually hold it, then the tape has a chance to tighten back up. But if it keeps rejecting under that and starts losing 220, that's your failure zone. That's where these little low float runners can go from resetting to air pocket really fast. Now, WETO, totally different feel. Price is up in the upper teens, around 1850. And the relative volume is crazy, 300 times normal volume. That's the squeeze check. The question is not, is it up a lot? Obviously it is. The question is whether this reclaim is real, or if it's just building another lower high after the first big push. I'd mark 1850 to 19 as the battle zone here. If it can live above 1850 and buyers keep stepping in, okay, still firm. But if it pops, stalls, and slips back under 18, that's the lower high look, and you'll usually see the momentum crowd back away pretty quickly. WFF on deck now, and this is the clean round number test. Stocks basically doubled, sitting just under $3, about 294 on the board, but the volume is only 840,000 shares, so it's not the same monster liquidity as IVF or TRUG. Float's thin, about 1.6 million, and that's why $3 matters so much here. If this thing is really going to keep squeezing, you want to see volume expand through 3, not just a quick wick and reject. If it keeps tapping 3 and the candles get smaller, that's where these low float names can trap late chasers fast. So WFF, 3 is the line on the screen. Now, TRUG, this one's way more liquid today, 47 million shares, relative volume almost 147 times normal, and it's still up about 71%, but the important part is the failed 170 break. It's sitting around 166 now, so you've got that classic post-break retest. Broke the level, couldn't hold it, and now the question is whether buyers defend underneath or whether this rolls into lower highs. For me, 170 is the judge. Back above 170 with actual volume, okay, the tape gets interesting again. Staying below it and fading into the mid-160s, that's more of a failed breakout look than fresh momentum. EYPT now. And yeah, this is the ugly one on the board. We're not talking about a little fade, this is a major biotech repricing. Down about 71%, 25 million shares traded, so there's real liquidity in the flush. The level I'm updating here is that 435 shelf. If it's living under 435, the tape still feels heavy. If buyers want to calm this thing down, 450 is the first spot I'd want to see reclaimed and actually held. Not just a 1-minute wick, but candles staying above it. This isn't a squeeze read for me. It's more, did the panic selling exhaust, or is every bounce still getting sold into? Quick cleanup before we hand it off. ZTG is the downside liquidity name, but be careful calling it a momentum short or anything like that. Down 63%, yes, but only about 106,000 shares, so the liquidity is thin compared with the rest of this board. OSRH is the sub-dollar tape, around 45 cents, 55 million shares, high dilution risk on the profile, so that one can move, but it can also get really sloppy fast. SLE is cleaner on the upside as long as it's staying above that $3 line. 1.6 million float, 19 million shares. That's the type of small cap tape where 3 becomes the battleground. And then HAO is the fresher, lower board gainer. 540 area, up 36%, relative volume almost 17 times, but lighter raw volume. So I'd treat that as a thinner chase unless the candles keep confirming. All right, that's the movers board reload. Coming up next, we'll flip from the runners into the next tape check and see what's actually sticking.
Thanks, Markets Desk. Quick macro news brief, because the big story today is jobs going the wrong way. ProTerminal's newsroom is tracking U.S. employers shedding 23,000 jobs in July. And that's a real curveball, because the market was looking for job growth, not an outright drop. Why it matters: labor is the consumer's paycheck, And the consumer is still the engine under this market. If hiring cools, spending can cool with it. The tricky part is the tape isn't screaming panic. The SPY's only off about 0.17%. QQQ's still green. So this is more growth scare amber light than full siren. Next one, the Fed report is leaning against quick rate cut enthusiasm. The desk is seeing policymakers still focused on persistent inflation and geopolitical uncertainty. So the message is basically, yeah, growth is softening, but inflation hasn't left the building. Bonds are telling you that tension. TLT's at 81.85, down about 0.24%, while IEF is basically flat. That's not a clean recession bid in duration. It's the market saying, cooler jobs, sure. But show me inflation actually behaving. Macro, as usual, has chosen the most annoying answer possible. All right, top of the hour, quick market minute reset for everybody just jumping in. It's 11 a.m. Eastern, and the tape is mixed, not broken. SPY's sitting around 775.15, down 0.15%. QQQ is the relative strength spot at 733.46, up 0.33%. Russell's the soft spot. IWM 303.95, down 0.37%. So yeah, the market's basically saying, I like the big shiny tech stuff, but please don't make me finance the whole small cap universe today. VIX is barely moving at 19.41, up about 0.25%. So this is not a panic tape. It's a selective tape. The macro story underneath it is pretty clean. Rate cut hope got a little haircut. Bonds aren't giving stocks a big cushion, and that keeps the market split. TLT is 81.79, down 0.31%, while IEF is basically flat at 93.03. So the bond side is not screaming relief. Dollar's a little softer at 28.08, down 0.11%. Gold is catching a bid at 405.20, up 0.93%, which tells you there's still some caution in the room. Oil is basically flat at 126.59, despite the Iran-US tension headline, so the energy panic premium is not really expanding right here. Crypto's firm. BITO up 1.29%, Coin up 0.76%, MSTR up 4.09%. But that corner is always the espresso machine with wheels, so volatility cuts both ways. Here at the macro desk, I'm watching QQQ 733.50, IWM 304, VIX 20, and the 2 p.m. NAHB housing number with the estimate at 33. Coming up, we rotate back into the movers board, then small cap momentum.
Thanks, Macro Desk. All right, let's hit the movers board fast. Tape is mixed, right? SPY slightly red, QQQ green, IWM red, VIX barely moving. So when this board is doing plus 200, plus 100, plus 90, that's not the market carrying it. That's pure small cap flow. Look at IPST still sitting near 868, almost plus 295%. WFF is not dead either, 3.59 now, plus 149%. IVF is the huge volume name, but it already gave us that downside hit through 220. WETO, oof, that 18 break mattered. Now it's down around 1612, even though it's still green on the day. And EYPT is the ugly one, minus 71%, sitting near 424. Quick scoreboard here at the markets desk. IPST 750 hit. WFF hit 2 and 2.94, but IVF and WTO both gave us failure signals. So now we stop staring at percentages. We go 1 minute, one name at a time. Start with IPST on the 1 minute. This thing is ridiculous, but clean ridiculous so far. Price near 8.68, up almost 295%. And the volume is the whole story. 72.9 million shares against an average around 50,000. That's 1,444 times relative volume. That is not normal interest. That's a full tape event. Float is listed around 10.25 million, market cap barely over 5 million. Dilution risk marked high, so I'm not treating this like some pretty long-term story. This is momentum, liquidity, and who's trapped where. The key hit already happened. 750 got taken, now I'm watching acceptance. If it keeps holding above 8.50, buyers are still in control of this current shelf. If it snaps back under 8, that's where the late chase can get nasty fast. No hero stuff here, just respect the candles. Above 8.50, control stays with the bid. Below 8, first real momentum crack. WFF next. And this is the one where I'd be really careful calling it clean, just because it's green. We're up around 359, up basically 150%, but the difference versus IPST is the participation is smaller, about 3.3 million shares. Still big versus normal, about 30 times relative volume, but not that insane 70 million share type of tape. Float is tiny, about 1.6 million, so when this clears prior squeeze spots, it can look amazing for 2 candles, and then get ruggy fast. For me, the tell is acceptance over that 350, 360 shelf. If it keeps holding above there with dips bought, okay, momentum is still in control. If it starts printing big upper wicks through 360 and snapping back under, that's parabolic and fragile. Now IVF, totally different feel because this one has monster raw volume. 91 million shares already, price around 212, up 118%. But look, the tape is having that post-squeeze argument around the 220s. You get the push, it can't really stick over 220, then it comes back to see if buyers actually defend the reclaim area instead of just chasing the first rip. So I'm not overstating this bounce. Above 220 with volume, that's where the chart starts proving there are still buyers. Under roughly $2, it gets a lot more questionable, because then the move is just lower high, lower low behavior after the failure. Tiny float again, under 1.8 million, high dilution risk on the board, so this is not a sleepy healthcare name. Weedo now. This is the spot where I care way less about the headline percentage and way more about the reclaim quality. It's still up about 96%. Price right around 1612. And the volume is absolutely real. 14.5 million shares, 300 plus relative volume. So yeah, people are in this. But the move back under 18 matters. That was the momentum shelf. And once it loses that, now the question is, does 16 actually stabilize? Or is every bounce just building another lower high? If 16 keeps getting defended and it starts basing instead of knifing, okay, that's participation. But if it pops into 17-ish and sellers smack it right back down, that's not strength. That's a fade trying to look pretty for 30 seconds. And flip it to the red side, EYPT. This is the ugly one on the board. Biotech repricing, down about 71%, trading near 425, with 26 million shares done. So this isn't some sleepy drift lower. This is institutions, fast money, everyone remarking the name at the same time. The line I'm watching is 435. If it keeps failing under 435, sellers are still in control, plain and simple. What you don't want to confuse here is a tiny bounce after a 70% wipeout with actual demand. For me, the tape has to stop making lower pushes first. If 435 becomes resistance, that's still pressure. If it reclaims and holds above it, then at least you've got a level to measure against. Trug and SLE are the compare for me here. Trug first. This is not just a random green print. It's around $1.63, up almost 69%, 49 million shares, and the relative volume is 150 times normal on a float barely over a million. That is real participation. But yeah, that's also why it can snap your face off. For Trug, I'm watching that 160 area as the intraday pivot. Above it, buyers are still defending the move. Below it, this starts looking way more like a trap than a clean continuation. Now SLE, same small float flavor, but different strength profile. It's around 309, up 36%, 19 million shares, relative volume about 30 times, float about 1.6 million. So it's active, just not Trug active, and dilution risk is high here, so I don't love sloppy failed reclaims. $3 is the clean line on this one. If it keeps accepting above 3, okay, it's still in the game. If it keeps losing 3 and popping back into it, that's Chop City. Quick lower board cleanup. OSRH, big raw volume, 69 million shares. But it's a 46-cent name with high dilution risk, so I'm treating that as high-risk penny stock tape, not a clean leader. ZTG, totally different. Down 63%, but only about 106,000 shares and 1.4 relative volume. That's not the same kind of real sell-side participation we saw in EYPT. Thin tape, widespread danger. And MYSC, this one actually has some juice. About 7.4 million shares, nearly 50 times relative volume, price sitting right under 4. For MYSC, $4 is the obvious reclaim check. If 4 stays a lid, don't overcomplicate it. That's lower board resistance. So reset the board. TRUG as the strongest smaller name participation in this last rotation. SLE and MYSC have volume but need clean reclaims. OSRH is high-risk penny tape. And ZTG just does not have the liquidity profile I want to see. Alright, movers board is set. Let's flip forward from the small cap chaos and hit the next screen. Alright, quick small cap momentum check. Pull up BZAI. Oof, this is not the fun kind of momentum. BZAI is a sub-dollar AI edge compute semiconductor name. Overview had it down about 16%, and the 1-minute read has the latest candle sitting around 44.45 cents, after opening near 56. Small cap tape isn't exactly getting help either. IWM's red, but this is its own breakdown. Day high around 0.565, day low 0.424, and right now it's trying to breathe near 0.44. Here's the structure. Lower highs, lower lows. And the ugly part is where the volume came in. The heavier volume hit on the breaks, especially through 50 cents and then again into that 45-44 cent pocket. That's sellers pressing, not just a sleepy drift lower. Volume is already around 6.8 million against average volume near 2.36 million, so the tape is active. But this is not a classic tiny float squeeze. Float shown around 107 million shares. Here at the markets desk, the scoreboard is simple. Watch 50 above as the reclaim line. If it can't get back over 50 cents with cleaner green volume, bounces are just lower high tracks. Watch 44 below as the support shelf. If 44 cracks, you're looking right back toward that 424 panic low area.
Thanks, Markets Desk. Breaking from the Pro Terminal newsroom, Microsoft is in focus here. The headline is that expanding Microsoft 365 seat counts, stronger premium E7 adoption, and Copilot gaining traction across enterprise workflows can fuel the revenue growth story. What we know? Enterprise demand is still showing up in the cloud and AI stack, and that matters because recurring software seats are the nice, boring part of tech. Boring in macro is usually where the cash flow lives. What we don't know yet, we don't have fresh company-provided seat numbers in this brief. We don't know the exact Copilot conversion pace, and chip supply constraints plus competition still sit in the background. Market read, with QQQ up about 0.4, while SPY is slightly red. This is exactly the kind of mega-cap software story that can keep the NASDAQ bid even when the broader tape is mixed. Next wire, WF Holding shares are surging after announcing a standby equity purchase agreement with an institutional investor. That's the catalyst the desk is tracking. Why it matters. For a smaller company, access to capital can buy runway, fund operations, or support growth plans. But here at the macro desk, we always read the second line too. Equity-linked capital can also mean dilution pressure if shares are issued into the market. So the stock can rip on the liquidity headline, while traders still need to respect the financing math. Free money, sadly, remains one of Wall Street's more persistent myths. And one more. INVO Fertility reported second quarter 2026 results, highlighting revenue growth and improved profitability in its fertility clinic platform. The market angle is pretty straightforward. This is a niche healthcare services story, but improved operating performance can change how traders view the durability of the model. It matters because small-cap healthcare names often move on either clinical risk, financing risk, or execution risk. This one today is more about execution and whether the clinic platform is showing real traction. The broader tape is still not giving everything a green light. IWM is off about 0.4, and VIX is holding near 19.5. So small cap strength still has to prove itself name by name. Coming up, we've got a quick Pro Terminal tour on deck.
Thanks, Macro Desk. Alright, Markets Desk is jumping straight into the movers board. Tape is mixed. QQQ green, IWM red, VIX not crazy, so when a name is up triple digits today, that is single stock violence, not broad market beta. Top of the board is still IPST, basically parked around $8, up 260 plus with 1,500 times relative volume. That is just ridiculous participation. WFF right behind it, still up over 200%.
WETO has that wild $17 area back on screen, and IVF is hovering right at $2, which matters because we already flagged that $2 line a minute ago. Then the flip side, ZTG and EYPT are the bodies, down 70-ish%. So this is not a clean bullish board. This is a volatility board. We're going chart by chart. First one, IPST. Okay, IPST on the 1 minute. This is Heritage Distilling, craft spirit's name. And the numbers are nuts. Around $7.99, up about 263%. 76 million shares traded versus about 50,000 average. Relative volume over 1,500. Oof, that is not normal liquidity. That's a full tape event. But here's the catch. Float is about 10 million. Market cap is only around 6 million. And dilution risk is marked high. So the chart can rip? Yeah, but it can also rug hard. The line here is super obvious. $8. If IPST can actually accept above 8, not just wick through it and slam back under, that's the momentum quality check. If it keeps failing at the whole number, that tells you sellers are sitting right there. I'm not chasing the candle. I'm watching whether 8 becomes support or stays resistance. Now, WFF, this one's got the same kind of tiny float craziness, but a different tape. We're sitting around 477, up over 230%, and the float on the board is only about 1.6 million. So yeah, that $5 line is the obvious magnet everybody's staring at. But here's the catch. High dilution risk on this name, and when these low-flow parabolics start losing the bid near a whole number, they can go from clean squeeze to elevator down really fast. For me, 5 is the clean upside control line. Above that, momentum traders notice it. Under VWAP or a failed 5 test, that's where the fade risk starts getting real. WETO next. And this is the one where I still care about those 2 lines we flagged. 16 for stabilization, 18 for the reclaim. Price is around 17.13, so it's living right in the decision zone. The good, volume is huge, 15 million plus, roughly 340 times normal volume. So this is not some sleepy move. The question is whether the 17s are absorbing supply or just rolling over under 18. If dips keep holding above 16, that says buyers are still defending the prior breakout area. But until it gets back through 18 and actually holds it, I don't want to call that momentum fully back in control. This is a range fight now. 16 below, 18 above, and the middle is just chop city. IVF now. And this is a totally different kind of squeeze because we're parked basically right on that $2 magnet. Price is around $1.99, up about 106%, and the volume is huge, 93 million shares. But remember, the float here is tiny, under 2 million, and the dilution profile is marked high. So yeah, it's an earnings-driven bounce. But this is exactly where traders get chopped if the reclaim doesn't actually stick. $2 is the battle line for me on this one. Hold above it, the tape can keep breathing, keep rejecting it, and you'll usually see the fast money crowd start hitting dids. I'm not chasing a low-float medical device name just because it's green. I want to see whether buyers can actually build above 2, not just spike through it for 1 candle. Now, flip it to the red side. EYPT, iPoint Pharma, down almost 70%. This is the biotech repricing tape, and the difference from the gappers is obvious. Bigger float, 81 million shares, real volume at 27 million, and it's not some microfloat vacuum. Around 447 right now. I'm watching that 435 to 450 zone like a control area. If it's below 450 and every bounce gets sold, that's still seller control. That's not strength. That's a dead cat bounce trying to find oxygen. If it can reclaim 450 and actually sit there for a few minutes, then at least the downside pressure pauses. But until then, this is a broken biotech chart trying to stabilize, not a clean momentum long setup. Alright, quick quality check on Trug first. This one's around 156, up about 61%, and the participation is actually pretty serious. 50 million shares, 155 times relative volume on basically a 1 million share float. So the line is super obvious, 160. If Trug can reclaim 160 and hold it, that's where the tape starts looking cleaner. If it keeps stalling under it, then it's just chop under resistance. Now flip SLE, different flavor. SLE's at about 321, up 41%, 19 million shares, 30 times relative volume. Still active, but compared with Trug, the participation's not as explosive. The big line there is $3. It's above it right now, so for me, the quality check is simple. Does 3 become support, or was that just a fast pop through a round number? Last cleanup.
OSRH, then CBRG, and then we'll rotate the board. OSRH is 43 cents, up 36%. Huge share volume at 77 million. But this is still a sub-dollar biotech / blank check style name with high dilution risk showing. So yeah, it's moving, but the liquidity can get nasty fast if the bid disappears. Now CBRG, this is Chainbridge, Shell Company category, $6, up 30%, and the relative volume number jumps off the page, over 1,000 times normal. But remember, the average volume base is tiny, about 13,000 shares, so that relative volume print looks wild because the normal tape is basically asleep. That's the key cleanup point. IPST and WFF were the real insanity. TRUG has the cleaner participation check, SLE has the cleaner $3 line, and OSRH/CBRG are where you respect liquidity risk. Alright, coming up, we're going to flip from the movers board into the next live rotation and see where the tape is actually holding strength.
Alright, quick tool check. This whole desk is running through ProTerminal. First thing I care about on these wild small cap names, dilution. Oof, seriously. Before I get seduced by a green candle, I want to know, is there a shelf, an ATM, an offering risk sitting in the background? That's what this dilution center is for. It's research context. Not a buy button, not a magic signal. Just the stuff you want on screen before the tape gets loud. Now, flip back to the movers board. This is the heartbeat of the show. IPST up around 279%. WFF up 230 plus. WEDO still over a double on the day. That's the kind of board where the market's mixed. SPY slightly red. QQQ green. And these things are just doing their own circus. Here at the markets desk, we use this board to find the action fast. Percent move, relative volume, float, market cap, sector. Starting point for research. And then when a name is moving like IPST, I don't want vibes, I want documents. Pull the profile, hit filings, and now we're checking the actual paper trail. Recent offerings, shelf registrations, 8Ks, whatever's there. Or if it's not there, cool, we don't invent it. Same thing with insider trades. If there's buying, selling, weird timing, you want to see it in one place. That's the whole point. Price action on one side, company paperwork on the other. Risk and uncertainty don't disappear because a candle is green.
Thanks, Markets Desk. Quick check here at the Stock Whisperer. I just put on the simulated paper short in EYPT, 1,000 shares, average 451.1. Stock right now 451-ish, so basically flat, down about $3 on the mark. The setup is simple. Failed late-stage eye drug trial, high-impact catalyst, and in biotech when a primary endpoint misses, that first weak bounce can still get sold if buyers don't step in. Defined risk is already bracketed. Buy stop at 515 if this squeezes past where I'm wrong. Take profit limit at 355 if continuation expands. The live trigger I'm watching is 440 below. If sellers can't push it through there, I'm not going to pretend the short is working. Around it, the simulated book is mixed but controlled. F-long is working. 600 shares from 1385, now 1425, up about 243. PYPL long is up about 201. SPGI short is the cleanest worker, up about 254, with the bracket sitting at 405 target and 418.80 stop. GS short is red about 78. TSLA short red about 44. Manageable, but not earning more size. Open orders are the discipline here. EYPT 355 and 515. SPGI 405 and 418.80. GS 988 and 1062.50. PYPL 6450 and 5885. Also, still watching MSFT 488 versus 482 and NVDA 228, only if QQQ stays firm. Coming up, analyst rating beat. We'll see if the call actually matches the tape.
Thanks, Stock Whisperer. All right, Markets Desk, we're back on the movers board, and yeah, this board is still wild. SPY is basically flat red, QQQ's green, IWM's down almost 0.5%. So when you see WFF up 268, IPST up 253, WETO up 124, IVF up 110, that's special situation tape, not broad small cap risk on. Look at the volume too. WFF 17.7 million shares, IPST 78 million shares,
Wheato's still 350 plus relative volume. Oof. This is where the board can look beautiful and still be mean. We're going chart by chart now. Who's holding the reclaim and who's just giving you the low float rug? First one, WFF. This is still the pace setter. Price was $5.30 on the board, up 268%, and that $5 level we flagged is not theory anymore. It's live. Above 5, buyers are trying to defend the new floor. If WFF loses 5 from above, character changes fast, because this is a tiny float name with high dilution risk tagged on the data page. Not me dunking on the chart. That's just how these things trade when 17 million shares hit something that normally does about 110,000. On this 1 minute, I want to see actual acceptance, not just wicks. Clean holds keep it in leadership. Failed pops and snapbacks, that's the stall warning. Now, IPST. This is the other absolutely ridiculous one. Heritage Distilling, board print, 777, up 253%. And look at the volume number, 78.7 million shares. This thing normally does about 50,000. So that relative volume, 1,500 plus times normal, yeah, that's not a typo. On the 1 minute, the whole read is the mid-sevens. If it's still holding 750-ish after that squeeze, then buyers are defending the meat of the move. If it starts living below 750 and the bounces can't reclaim 8, that's where momentum can turn into ugly chop really fast. And just remember the setup. Tiny market cap, high dilution risk, not deep blue chip liquidity. Exciting tape, but it can be unforgiving. Wheato next, and this one's a different flavor. Higher priced runner, upper teens, not a $2 penny style squeeze. Board has it around 1842, up 124%, with 15.9 million shares traded, versus a normal day around 45,000. So the participation is real. The question is 18 building into support, or are we just seeing exhaustion wicks into 19 and 20? For me, 18 is a line. Above 18, dips getting bought, that's constructive. But if it keeps poking higher and snapping right back, that's supply showing up. Also, recent filings are flagged here, and dilution status is unknown, so I'm not treating one green candle like a clean all clear. I want to see bid support, not just 1 minute air pockets. IVF now, and this is the $2 fight, plain and simple. Board had it around 204, up about 110%, so yeah, still a huge healthcare move, but it's not the same kind of vertical insanity as WFF or IPST. What I care about here is the quality of the hold. 94 million shares traded is real activity, relative volume just under 20 times, and with a float under 2 million, this can still whip around fast. If the 1 minute candles keep reclaiming 2 and building above it, fine, buyers are still participating. If $2 starts acting like resistance instead of support, that earlier earnings style bounce can turn into a fade really quickly. Also, dilution risk is marked high here, so I'm not treating every green candle like it's clean. I want to see bid support, not just random spikes. Now, flip to the ugly side for a second, because the loser board matters too. EYPT first. This is biotech repricing pressure, not some tiny no-volume drift. Down about 69%, trading around 456, and volume is almost 20 times normal. So institutions, funds, trapped holders, everybody's probably involved in that reset. On a chart like this, I'm not trying to be a hero calling the bottom. I'm asking whether 450 can actually base or if every bounce gets sold into. And then ZTG, much smaller liquidity profile, around 227, down 77%, only about 500,000 shares traded but still 7 times normal. That's a breakdown liquidity check. If it can't hold the low twos and the spread gets jumpy, that's where these names get nasty. Totally different from the gainer board. Here we're watching whether there's real absorption or just dead cat candles. All right, quick cleanup on the middle of the board, then we'll hand it forward. Trog first, True Golf, board price about 155, up basically 60%. And the reason it's still on the radar is participation. 50 million shares, 156 times relative volume on a roughly 1 million share float. That's the kind of float where the chart can look clean for 10 minutes and then get nasty fast. So for me, the line is 150. If it's above 150, buyers are still at least showing up. Below that, this can turn into just another small cap fade. Now SLE, this is the cleaner level check. Board has it 318, up 40%. So yes, the $3 hit is holding on the quote right now. But same deal, tiny float, high dilution risk, and these metaverse/gaming content names can move on air. $3 is the whole battle. Above it, it still has a bid. Lose 3 and the move starts looking way more suspect. Now OSRH and NXGL, both sub-dollar healthcare type names, both high risk. OSRH is 44 cents, up about 40%, 85 million shares traded, so there's real liquidity there, but it's still a 40-cent stock with high dilution risk. So, I'm not treating noise as strength unless it keeps holding the 40-cent area. NXGL is the opposite side, 40 cents, down 29%. Volume is elevated at 18 times normal, but that's selling pressure, not momentum. If NXGL can't reclaim 40, there's no reason to pretend the bid is healthy. So yeah, board is still super active, but the theme is pretty clear. Massive volume and tiny floats, and the levels matter more than the headline percent move. Coming up, let's get off the raw movers board and hit the next tape read.
Thanks, Markets Desk. Let's switch to Apple, because this is a very different kind of move than those small cap runners. Here at the company desk, the headline is constructive. Apple getting an upgrade to buy tied to foldable iPhone optimism. And the question is simple. What does that actually change? It changes the product cycle story more than today's numbers. The analyst is basically saying, look, if Apple can create a new premium iPhone category, maybe the upgrade cycle gets a little more interesting. But on our ratings feed, the recent track tone is not all bullish. Jefferies downgraded Apple to underperform on August 10th. China Renaissance cut it from buy to hold on August 4th. Then Goldman, Morgan Stanley, Wells Fargo, and others mostly maintained after earnings. So this is not a clean Wall Street pile-on. Now pull the chart up, because the tape is giving us a pretty honest reaction. QQQ is green, up about 0.4, and Apple is still down about 0.6 near 304. That matters. If mega-cap tech is catching a bid and Apple is lagging, the market is not just blindly buying the analyst optimism. The 1-minute structure is pretty clear. Opened around 305.45, pushed up toward 305.90, then sellers walked it down into about 303.75 with real volume on that drop. Since then, it's been trying to build a base around 304.30 to 304.50, but the bounce is lighter volume. So for the live read, 305 is the first spot I'd watch on the upside. If buyers can actually reclaim that, then maybe the rating headline has some bite. Below 304.30, and this looks more like a failed bounce inside a mild intraday downtrend.
Thanks, Markets Desk. Breaking now from ProTerminal's newsroom. Amazon is lifting its annual capital expenditure plan after beating cloud sales expectations. So the headline is pretty clean. Cloud came in better than expected, and Amazon is responding by planning to spend more, basically doubling down on infrastructure, AI capacity, data centers, all the expensive plumbing behind the magic trick. What we know, the CapEx plan is going higher, and the driver is stronger cloud demand. What we don't know yet from this card, the exact incremental dollar cadence, the supplier split, and how much margin pressure management is willing to absorb to chase that demand. Market read, QQQ is green around 734.3, while SPY is basically flat to red around 775.7. So mega cap growth still has a bid. But here at the macro desk, the joke is the cloud is not actually in the cloud. It's on a very large electricity bill. Staying in that same lane, Microsoft's Azure annual revenue has topped $100 billion for the first time, and the stock has jumped 18% over the week. That matters because this is not just one company saying, hey, we feel good. Amazon raising spend and Microsoft showing that kind of Azure scale both point to the same macro trade. Cloud demand is real, AI capacity is scarce, and the market is rewarding the platforms that can fund the build-out. The caution is also the same. More capacity means more CapEx, and CapEx is wonderful right up until investors start asking when the cash register rings. That spread between QQQ up about 0.43% and IWM down about 0.48% tells you exactly who's getting the benefit of the doubt right now. The giants, not the little guys. Now, the other side of the board. Gold is ticking higher as the US dollar slips, with Middle East tension and Fed uncertainty keeping a little hedge bid alive. GLD is around 405.44, up just under 1%, while the dollar proxy is down about 0.05%. Oil is barely green, around 126.78, and VIX is sitting near 19.41. So this is not a full panic trade. It's more like the market keeping an umbrella in the car because the sky looks weird. Why it matters. If investors are buying cloud capex and gold on the same morning, that's a mixtape, not a simple risk-on party. Coming up, Earnings Spotlight gets the next swing at who's actually converting these big themes into numbers.
Thanks, Macro Desk. All right, here at the company desk, we're going from the cloud giants to a tiny earnings name on today's unscheduled sheet. NCPLW. And right away, big caution flag. This is basically a 2.5-cent stock, last around 2.46 cents. Anything under 10 cents can get delisted at any moment, and it's not something I'd recommend, especially for day trading. We can still read the tape though. The 1-minute chart had that pop from about 1.01 cents up toward 2.5 cents. Volume did confirm the push, but now it's stalling just under the high. So for me, the clean line is simple. 2.5 cents is the upside test, and 1.76 cents is the base you don't want to see fall apart if this earnings setup is going to matter at all. Now the business story. Net Capital is a fintech capital markets name, funding portal, private company fundraising, advisory services, valuation work. The calendar has NCPLW on the earnings list today, with an EPS estimate of negative 26 cents. And I do not see a fresh results press release in the feed yet. So this is a preview, not a reaction. The last financials we've got here are not big company numbers. Q3 revenue was about $94,000. Net loss about $1.81 million. EPS negative 32 cents. So the question is not, did they beat by a penny? The real question is, does the print show the revenue base is getting more durable? Or are we just looking at a smaller loss while the business still burns cash? That's the difference between an earnings headline and something that actually changes the story. And this is where I get skeptical, because the capital structure matters more than the headline. On the dilution page, ProTerminal has NCPLW marked high risk, active shelf, active equity line, pending S1, 2 active shelves, and 34 total offerings in the history. Cash on the latest balance sheet was roughly $715,000, with recent operating cash flow still negative. The runway estimate is basically about a month. That's not a small detail, that's the story. If earnings come out and the company still needs capital quickly, traders may care less about the EPS line and more about potential overhead supply. And if we flip over to filings, you can see the filing stack has had 8Ks, a 424B3, and effect filing. So yeah, with a sub-dime name like this, the filings are not background noise. So back to the chart, and let's keep this grounded. The broader tape is mixed. QQQ is green, IWM is red, so this is not some clean small cap risk-on blanket. NCPLW needs its own catalyst. If it can clear 2.5 cents and actually hold above that, okay, that tells you buyers are at least reacting. If it loses 1.76 cents, then the earnings setup probably isn't changing the pressure. Simple as that. Coming up, we'll shift back up the food chain with Mega Cap Watch, because that's where the cleaner institutional tape is today.
Thanks, company desk. Let's pull up Google and check whether this mega cap is actually helping QQQ or just hiding under the hood. QQQ's green by about 1/3%. SPY's a touch red, IWM's weaker, and Google is down about 0.8. So right away, this is a relative weakness check. Daily chart first. Oof, this is not a clean leadership look. Alphabet had the big run, roughly 316 up into the high 380s, but since that peak near 386, the structure has shifted. Lower highs, lower lows. Now it's sitting in this mid-340s base. Current price around 343, latest daily support showing up near 342, and that's the line the markets desk is watching first. If 342 starts breaking with conviction, this base stops looking constructive and starts looking like continuation lower. On the upside, 346 to 347 is the first reclaim zone, basically where today opened and where the short-term moving average pressure is hanging around. Then, you've got the bigger daily supply up near 360. Not a target, just the next obvious shelf. The important part? Earlier upside volume confirmed the run, but the recent pullback has been more controlled than panic selling. So this is a base, but it's a damaged base. Alright, let's drop down to the 1 minute. Here's the live tape. Opened around 344.60, pushed to about 345.16, and then sellers hit it. That first loss of 344 had real volume behind it, around 74,000 shares on that minute. And then the move pressed all the way down to 342.21. Look at that wick near the low. That second volume pop, about 68,000, is where buyers finally tried to defend. Since then, choppy repair, not a rip. It's hanging around 343.80, 343.90, but it keeps stalling before 344. So the intraday map is pretty simple. Above 344, buyers are at least trying to stabilize. Above 345.16, they actually reclaim the morning breakdown. Under 342.21, the base fails. Quick catalyst check, because I don't want to over-narrate a chart if there's a real headline behind it. The latest press feed here is mostly law firm investor alert type stuff from the last week. I'm not seeing a clean operating catalyst in the releases driving this specific midday move. So for Google, the chart is the story. Mixed tape, QQQ green, VIX still near 19.5, and this thing is red. That matters. Scoreboard for me, 345.16 above is the repair line, 342.21 below is the failure line. Coming up, we've got the M&A deal beat, so keep that tape up.
Thanks. Markets Desk. Okay, quick company desk deal check. And the first thing I want to do is clean up the headline tape. We've got Apple on screen, and this is important. The fresh item here is not an acquisition, not a merger, not a cash versus stock transaction. It's an analyst upgrade story tied to the foldable iPhone and Apple's AI path. Different animal. For a real M&A beat, I'd be looking for buyer, seller, consideration, premium, close timing, regulatory risk. None of that is in this Apple headline. So the market can absolutely trade the sentiment, but we don't have deal math here. Now let's pull Amazon into this, because this is where the story gets a little more interesting. The tape is mixed. SPY slightly red, QQQ green, so mega cap tech still has a bid underneath parts of it. And that matters. But again, the headline we have is a broad large cap tech commentary piece, not a transaction. No takeout price, no spread, no ARB gap. Here at the company desk, that's the line I'm drawing. Commentary can't explain why money is rotating back into trillion-dollar tech, but it doesn't change control of the business. For Amazon, the actual question remains, does the cloud and AI spend narrative eventually turn into supplier deals, partnerships, or acquisitions? Maybe. But this feed right now does not give us a side deal to analyze. Same idea with Microsoft. If this were a real M&A story, this is where we'd slow way down and do the math. Is the buyer paying cash, issuing stock, using debt? How big is the premium to the unaffected price? And what does the market implied spread say about deal risk? But with Microsoft in this current headline set, we're still in theme land. AI infrastructure, cloud durability, mega cap defensiveness. Not a merger ARB setup. That's not me dismissing it. It just means the catalyst is narrative and positioning, not a contract with a close date. So, the deal beat takeaway is pretty simple. The M&A tape is quiet in the data we have right now. Apple, Amazon, Microsoft. These are sentiment and strategy headlines, not takeover headlines. If a real transaction hits, we'll come back and break down the premium, the payment mix, the spread, and the regulatory path. For now, don't confuse a bullish narrative with signed deal terms. Coming up, we've got a quick Pro Terminal promo, and that workflow is exactly how we keep these headlines straight in real time. Thanks, Company Desk. Quick Pro Terminal lap, because this is the stuff we're using live, every segment, to stay synced with the tape. First stop, Dilution Center. This is where the markets desk checks the ugly stuff fast. Shelves, ATMs, offerings, the kind of paper that can hit a small cap chart right when everyone's staring at the green candle. It's not a buy signal. It's not a sell signal. It's risk context. Huge difference. Now jump back to the movers board. This is the heartbeat. Mixed tape today. SPY a little red, QQQ green, small cap soft. So when something's up 200% or down 60%, you want to know immediately. Price, percent move, relative volume, float if it's there, market cap, sector. Look at this board. IPST still planted up top. WFF right there. IVF, WETO, EYPT on the red side. Oof. This is how you separate actual liquidity from just a random headline pop. Then I want the receipts. Pull up the profile, hit filings, hit insider trades, hit news. That's the workflow. If a name is ripping, I don't want vibes. I want to know what just filed, whether there's financing risk, whether insiders show anything relevant, and whether the newsfeed is a clean catalyst or just noise. Data can be incomplete or delayed, yeah, but this keeps the research tight. Fast chart, fast filings, no wasted clicks. And then, boom, straight to the 1-minute terminal chart. This is where we read the tape. Candles, volume bursts, wicks, failed breakouts, VWAP fights, all of it. Everything you're seeing here, movers, charts, dilution data, filings, insider trades, that's ProTerminal. If you want to follow along with the same tools we're using on stream, go to proterminal.io. Coming up, we're back to the movers board.
All right, let's hit the movers board. This is where the tape is actually loud right now. QQQ's green by 1/4 point. SPY's slightly red. IWM's redder. So small cap squeeze stuff has to earn it. Top of the board. IPST up basically 280%. Oof. 81 million shares, 1,600 times relative volume. That is not a typo. Then WFF, up 240%, 27 million shares, tiny float. IVF still doubled. WETO doubled. And then EYPT is the disaster move on the downside, down almost 70%. So we've got both sides of the casino open here. Here at the markets desk, first question is simple. Which of these is still building? And which one already did the move and is now just trapping late buyers? Okay, first chart up, IPST. This is Heritage Distilling, craft spirit's name. And yeah, the headline number is wild. Stocks around 8.36, up about 280%, with 81.9 million shares traded versus an average of basically 50,000. That's the kind of relative volume shock where you stop asking if people noticed. They noticed. But look, this is also a roughly 10 million share float with high dilution risk showing in the data, so the move can be violent both directions. On this one, I'm using $8 as the quick sanity line. If buyers keep accepting above 8, the squeeze is still alive on the screen. If it loses 8 and can't reclaim, that's where these names can rug pull fast. No hero stuff, just peep score candle by candle. Now WFF. This one's sneaky violent. Tiny float, about 1.6 million shares. Stock sitting around 4.90, up 240%. And it's already done 27.5 million shares. That's 249 times normal volume. So yeah, the crowd found it. But look, the whole read here is $5. That round number is the fight. If it accepts above 5 and starts building candles there, that tells you the squeeze still has participation. If it keeps tagging 5 and getting smacked right back under, that's usually where these tiny float names start getting messy. And I don't want to gloss over it. Dilution risk is flagged high on this one, so chasing strength blindly in a low-float industrial runner can turn ugly fast. Next is IVF, and this is the one where we've got to be honest about the earlier level. We talked about $2 before. That level did get hit, and now the question is whether 2 becomes actual support or just a trap door. Stocks around 2.04, up about 110%, but the volume is the real headline. 96 million shares traded. Relative volume's about 20 times normal. Floats under 1.8 million, and dilution risk is also high, so this is not a clean, slow institutional tape. For me, the read is simple. Above 2, buyers are at least defending the prior trigger zone. If it loses too cleanly and can't reclaim it, that's your failure line. And this can go from momentum to bag holder chart real quick. Now, Wedo, this is the cleaner dollar price runner on the gainer side. Webus International software/mobility services. Stocks are on 16.97, up about 106%, and the volume read is the thing. 16.7 million shares versus basically a tiny average, so you're looking at 372 times relative volume. That's real attention, but at $17, the question is different from IPST or IVF. This isn't a $2 grinder, this is already a bigger price move. So I'm watching whether 17 is actually building as support, or whether every pop through 17 is just supply. If it can't hold that area, this can still be a monster mover and be late at the same time. Flip side of the board now, EYPT, and this is the nasty one. I-points down basically 70%, sitting around 4.48, and it's traded over 30 million shares. So this isn't some quiet drift lower. This is a biotech break with real volume behind it. On these, the dead cat bounce can look amazing for 5 minutes, and then it just rolls right back over, because the overhead supply is massive. That 450 area is the magnet for me right now. If rallies keep stalling under 450, that tells you sellers are still in control. If it can reclaim and actually hold above it, then okay, maybe the bounce has some room. But chasing the first green candle on a down 70% biotech is how people get chopped up.
Thanks, Markets Desk. Breaking right now, Microsoft is the lead story. ProTerminal's newsroom is tracking a sharp Microsoft stock jump after Azure topped $100 billion in annual revenue for the first time. What we know, the move is being tied to enterprise cloud adoption and AI integration. Basically, the corporate AI spend everyone keeps talking about is showing up in the cloud line, not just in conference room slide decks. What we don't know yet, the exact margin trade-off, the capacity constraints, and how much chip supply limits the next leg of AI infrastructure growth. Market read, this is why QQQ can be green around 733, while the broader tape is mixed and SPY is slightly red. Mega Cap Cloud is still getting paid when the story is revenue-backed. Dry macro desk translation. If AI is the party, Azure just showed the receipts. Now the market wants to know who's paying for the electricity bill. Next headline. OSR Health CEO is out with a shareholder letter reaffirming confidence and highlighting subsidiary business development, along with the company's NASDAQ listing status. Why it matters. OSRH is already on the high volatility small cap radar today, so any management communication gets magnified fast. The real investor question is not just the letter, it's whether those subsidiaries turn into measurable operating progress, and whether the listing status language calms the market or just keeps traders watching the next update. Small cap headline tape can move like a shopping cart with one bad wheel, so clean follow-through matters more than the headline pop. And third, IP Strategy published its monthly validator update, plus details around Story Foundation's transition to the Data Foundation and the Data Network launch. This is a more niche story, but it matters because IPST has been one of the louder movers on the board. Traders are trying to connect the blockchain data infrastructure narrative with actual adoption. The headline gives the bulls a storyline, but here at the macro desk, we still want the boring stuff. Usage, monetization, and whether volume sticks after the first wave of momentum. Coming up, we've got candle chart analysis on CRGO, so we'll go from the newswire right back into the candles.
Thanks, Macro Desk. Let's hit Bally, because this is nasty downside momentum. Pulling the 1 minute up now. Stocks around 1033, down about 24.6%, and oof, look at the slope. Open near 1391, poked 1410, then lower high, lower low, lower high, lower low. IWM's red about 4/10, so small cap risk is already soft, and this one is getting punished way harder than the tape. Here's the fight. The breakdown confirmed on volume around that 1240 to 11 zone. That's the candle set that matters. Not just a slow leak. Sellers hit it, then the bounce attempts got smaller. I don't have a clean VWAP print on this feed, but structurally, price is buried under the major breakdown bands, so VWAP is overhead, not support. Day low is 10.06. Current base attempt is basically 1020 to 1030. So the market's desk scorecard is simple. Above 1030 and holding, okay, maybe the panic cools. Below 10.06, that's fresh low of day pressure, and this thing can get slippery again. Bigger overhead reset is 1250, but honestly, that's not close yet. Quick catalyst check. This isn't just some random red candle on a dead board. Bally's reported Q2 after the close Friday. The release says consolidated revenue was $792.2 million, up 20.5% year over year. But the stock is still down hard today, so the market's clearly not rewarding the headline revenue number. And this is where these smaller casino names get tricky. Real assets, real operations, Chicago project milestones, interactive gaming. But the equity can still trade like a balance sheet stress test. Float is about 10.25 million shares, so when holders lean out, the tape can thin out fast. Back on the 1 minute. Oof, look at that wick work near 1020. That's indecision, not a clean reversal. For a real repair, I'd want to see candles hold above 1030. Red bar volume stop expanding, and the stock start building away from the low. If it loses 1006, the base failed. That's the whole read. Not an upside breakout, not a clean bottom yet. It's a downside momentum name trying to stabilize. Coming up, we've got CRGO candle chart analysis, so we'll keep the chart lat moving. All right, let's pull up CRGO and read the 1 minute candles clean. Okay, so right away, this was not messy early. It sat tight around 144, 145, basically coiling. Then boom, volume wakes up, price starts lifting off 146, and the first real expansion candle pushes into 148. That's the tell. Not a slow drift, actual bid showing up. Now here's the part the market's desk cares about. The breakout actually had confirmation. Price walks up from that 146 area through 158 through 1.60 and then starts tagging the high 160s. You've got higher highs, higher lows, and the volume isn't hiding. Multiple bars are way bigger than the early session chop. That's what separates a real intraday breakout from some random wick. Day low is down near 1.43, day high is 1.73, so yeah, that's a pretty wide 20-cent range for a sub $2 name. Current area is around 1.69, watch 1.70 here, not because it's magic, but because that's where this thing started hesitating after the push. If buyers can't keep it accepted over 1.70, the breakout can still be strong, but the chase starts getting sketchy. Right now, it's pause mode. Smaller bodies, lighter volume, sitting roughly 1.67 to 1.69 after that high near 1.73. Oof, look at that stall. That's not bearish by itself, but it is the market saying, prove it again. For me, 1.60 is the sanity line underneath. If this breakout is still healthy, you don't really want to see it lose 1.60 and fail to reclaim, because then the move starts looking like exhaustion instead of consolidation. But above 1.70, especially if volume comes back, that's where the chart gets interesting again. Coming up, we've got Mega Cap Watch, so we'll flip from this small name tape back to the big leaders in a minute. Alright, let's pull Meta, because QQQ's green and this thing is red. So yeah, that matters. Okay, daily chart first. Meta sitting around 573, down almost 2.8% on the day, while QQQ is still up about 1/3%. That is clean relative weakness. Bigger picture, this was a high 600s name recently, peak area near 690. And now the daily structure has lower highs, lower lows, and that heavy volume flush under 600 changed the tone. The market's desk scoreboard is pretty simple here. 570 is the daily support area. If Meta starts losing 570, that's not a little wiggle. That's the base cracking. On the upside, 600 is the reclaim level. Not a magic number, not a call, just the line where the daily chart stops looking so heavy. Right now, still below it. Now, let's drop down to the 1 minute, because oof, this intraday tape is not pretty. Meta opened around 578.7, basically tagged 578.8, and then sellers hit it right away. The fast move was from the 578 area down through 575, with a real volume pop around 574.87, over 100,000 shares on that minute. That's not random drift, that's sell pressure. Since then, no real snapback, just lower highs, lower lows, grinding toward the low at 573.12. Watch 573.12 below. If that breaks clean, that's fresh low of day pressure. On the other side, 578.70 above is the intraday repair line. Until it can reclaim that morning breakdown zone, every bounce is suspect. Quick catalyst context on Meta. The recent company feed is mostly the Q2 results from late July, the BlackRock data center venture in El Paso, and the wearables push with the AI glasses lineup. So the story is still AI infrastructure, apps, reality labs, CapEx, all the big mega cap stuff. But the chart today is saying sellers don't care about the story yet. $1 trillion market cap, still trading like a laggard on a mixtape. Coming up, we'll hit the news intermission and see what else is moving the board.
Time for a quick news check. No fresh headlines loaded right now, so we'll keep it tight and get right back to the movers.
Thanks. Macro Desk. Quick reset on the tool we're using under the hood. This whole board right here is Pro Terminal. Top gainers, top losers, relative volume, price, the stuff that tells the markets desk where the tape is actually moving. And in a mixed market, SPY a little red, QQQ barely green, IWM soft, this matters. Movers are not buy signals. They're a starting line. You see the heat first, then you go verify the story.
All right, top of the hour, 12:01 Eastern, macro desk reset for anyone just jumping in. The tape is mixed, and that's the story. SPY sitting around 775.1, down 0.15%. QQQ green at 733.2, up 0.29%. Russell weaker at 303.9, down 0.39%. And VIX still awake at 19.45. So this is not a broad party. This is more like tech brought snacks. Small caps forgot the invite, and volatility is standing by the door checking IDs. The cross-asset map explains why the market feels choppy. Long bonds are heavy. TLT down about 0.47% to 81.655. IEF slightly red, so rates are not exactly giving equities a free pass. Dollars a touch softer. Gold is up 1.13% to 406. Oil's up 0.76% to 127.56. And crypto risk proxies are catching a bid. BITO up 1.94%, Coin up 2.18%, MSTR up 5.39%. Crypto's still the unregulated roller coaster in the corner, but as a risk thermometer, it's warm. Main drivers here, mega cap tech still carrying the Nasdaq after that Microsoft Cloud AI story and the Apple analyst upgrade, while the broader market is more cautious with bonds slipping and VIX near 20. On deck, Empire State Manufacturing at 12:30 and NAHB Housing at 2. Coming up, quick pro terminal hit, then we're back to the movers board.
All right, markets desk back on the movers board. Let's see who's actually got volume at midday. Mixed tape behind us. QQQ green, IWM red, VIX still sitting up near 19.5. So this is not some easy everything rips tape. This board is small cap chaos. WFF is still the boss on percentage move, up about 469% at 820. IPST still has the monster volume profile, 85 million shares. IVF's got almost 97 million shares traded. WITO is holding the higher dollar move around 16. Then on the ugly side, EYPT and ZTG are both still down almost 70%. So here at the markets desk, I'm not reading headlines first. I'm checking liquidity, float, and whether the 1-minute chart is still paying traders, or just trapping late chasers. Okay, WFF on the 1 minute. This is the name at the top of the board. 820, up 469%, 34 million shares traded, against an average volume around 110,000. That's not normal. That's a full-on liquidity event. Float is about 1.6 million shares too. So yeah, the float has churned a bunch of times already. Oof, that's exactly why this can look amazing and still be dangerous. High dilution risk is showing on the board. Tiny float, huge range, midday momentum. My scorecard is simple here. $8 is the first sanity line. If it's above 8, bidders are at least still defending the move. If it loses 8 and can't snap back, that's when the chase gets ugly. Above 850, I'd want to see fresh volume come in, not just one lonely green candle poking its head up. Big move, big liquidity, big risk. IPST now. This is the craft spirit's name. And yeah, this one's still wild. You've got 85 million shares traded, relative volume over 1,600 times normal, so it's not a quiet grind. It's a full-on volume event. Price is sitting around 769 after tagging that 8 area earlier. So for me, the read is pretty simple. Can it reclaim 8 with real volume behind it, or are we just printing lower highs underneath that level? If it keeps wicking into 8 and failing, that's supply showing up. If it actually holds above 8, instead of just popping through and rejecting, that's a different tape. Also, high dilution risk on the profile. So with these tiny market cap runners, don't romanticize the move. Levels matter more than the story. IVF next, and this one's the volume monster on the board. 97 million shares, trading right around 207, up about 113%. Different feel than IPST because the price is lower and the float is tiny, under 2 million shares, so every push can get exaggerated both ways. What I'm watching here is whether $2 keeps acting like the magnet and support area, or whether the volume is starting to roll off while price sits heavy above it. A clean runner keeps absorbing dips and pushing back through the prior 1-minute highs. A trap starts giving you pops that can't extend. Then it loses 2, and suddenly everyone who chased the late move is underwater. So $2 is the big line on this one right now. WITO now, and this is a different flavor than the $2 and sub-$2 stuff we just hit. 1625-ish, up almost 98%, 17 million shares, relative volume 378. So yeah, this is absolutely on everyone's scanner, but the price tag matters. A higher priced runner like this can give you cleaner candles when it's behaving, because every 10, 20, 50 cents actually means something. The big line for me is 16. If it keeps accepting above 16, that's a cleaner momentum look than some of those tiny float whip machines. If it loses 16 and starts reclaim failing underneath it, then this can turn into the same trap, just with wider candles. 5.7 million float, software app name, recent filings are on the board, dilution risk marked unknown, so I'm treating the chart as the boss here. Flip side, EYPT, loser check. This is the biotech flush on the board. 456 down 69%, 32 million shares. And this is where I don't care that the market's mixed. When a biotech is down this much on 22 times relative volume, the intraday question is super simple. Do bounce attempts keep running into sellers, or does it finally build a base? For me, $5 is the obvious supply check above, just because it's the clean round number after a gap like this. Underneath, 450 is the line where if it keeps leaning on that and can't lift, you can get that slow bleed feeling. Not calling a bottom, that's how people get smoked in biotech flushes, just reading whether buyers can actually absorb shares instead of one green candle getting sold immediately. Trug now. This is the low float gaming name True Golf. 151, up about 56%. 52.8 million shares traded, and the relative volume is 162 times normal. The float is tiny, basically 1.07 million. So this thing has churned the float a ridiculous number of times already. That's why it can look amazing for 3 candles and then just vanish on you. The breakout or trap read here is pretty simple. If it keeps accepting above 150 and the dips are shallow, Okay, buyers are still defending the move. But if 150 starts breaking and every push toward 160 gets sold into, that's when I stop calling it momentum and start calling it a liquidity trap. Microcap, market cap under 2 million, medium dilution flag. So yeah, fun tape, but don't marry it. All right, quick cleanup on the lower board before we widen back out. OSRH first, 51 cents, up 62%, and the wild number is 140 million shares traded. High dilution risk on this one, sub-dollar biotech / blank check style name, so for me the $0.50 area matters. Above 50 cents, it can keep grinding. Below 50, that can turn into straight churn really fast. CDTG next, 290-ish, up 39%, relative volume 65 times normal. Not as cartoonish as WFF or IPST, but if this one can hold near $3 without giving it all back, that's probably the cleaner lower board tape. And then SLE, 310, up 36%, almost 20 million shares, tiny float, high dilution risk. That one can move, but it's also the kind of chart where wicks get nasty. So my cleanup ranking, CDTG for cleaner structure, TRUG if 150 holds. OSRH is pure volume, SLE is speed with trap risk. Good movers board. Now let's pull the camera back and hit the market overview, because the indexes are still mixed, and small caps are not exactly giving us a free pass here. All right, Markets Desk is back on the movers board. Mixed tape. So the weird stuff with real volume is where the action is. SPY, slightly red. IWM, red. QQQ, barely green. VIX, still hanging near 19.5. So when WFF is sitting up 469% at 820, that is not a normal Green Day move. That's its own tape. 34 million shares traded, 309 times relative volume, float listed around 1.6 million. That is tiny. IPST, still second row, up 250%, and that relative volume number is absurd, over 1,600 times average volume. Then you've got IVF up 115, WEDO basically doubled, OSRH sub-dollar still up 75. So the job here is simple. Separate real follow-through from late-day trap candles. No victory laps.
Thanks, Markets Desk. Breaking out of Asia, ProTerminal's newsroom is tracking a chip-led bounce. Asian stocks climbed, and the semiconductor group is doing the heavy lifting, with names like Samsung and TSMC leading the move. What happened is clean enough. After recent pressure, chips caught a bid, and Asia used that as the permission slip to bounce. What we don't know yet is the important part. Is this real risk appetite coming back, or just a relief move after a bruising tape? The market read, U.S. tech is green, but not exactly champagne green. QQQ is around 732.6, up about 0.2, and VIX is still parked near 19.45. So here at the macro desk, nice bounce, but the confetti stays in the drawer until U.S. semis confirm it. Next headline, the U.S. has concluded strikes on Iran-linked targets, while Houthi forces are threatening a blockade of a major shipping route. The facts right now are escalation in the region and fresh attention on shipping lanes. That's the part investors can actually price. Why it matters. Energy supply chains and freight risk. Oil is already firm at 127.56, up about 0.75%. And gold is bid at 406, up 1.13%. That combo is the market quietly checking where the exits are. Not panic, but definitely not background noise. One more big tech cross-current. China is deploying state-linked institutions to support technology ETFs. The desk is seeing insurers and state-backed asset managers directed toward tech funds to help stabilize markets after the sell-off. Why it matters. That can create a policy-backed floor for sentiment in Chinese tech, and it lines up with the Asia chip bounce we just led with. The catch, and there is always a catch because markets are rude, is that liquidity support is not the same thing as organic earnings demand. So the read is supportive for global tech tone, but still needs follow-through. Coming up, we'll broaden this into the full market overview. Thanks, Markets Desk. All right, let's zoom out and see what kind of market this actually is. And the answer is, not a clean risk on tape, not a panic tape. It's more like everyone showed up to the party, but only NASDAQ got invited inside. SPY sitting around 775.19, down 0.15%. QQQ's the green one at 732.62, up 0.21%. Russell still soft. IWM 304.05, down 0.34%. So the message is pretty clear. Money is still willing to pay for big cap growth, but it's not spraying across the whole market. VIX at 19.45 up a little tells you there's still a nervous bid under volatility. Not crisis pricing, but definitely not sleepy summer tape either. Here at the macro desk, that's the tell. If NASDAQ can be green while small caps are red and vol refuses to fully chill out, that's concentration, not broad confidence. Very different animal. Now the cross-asset part is where it gets more interesting. Bonds are not helping much. TLT's down 0.49% and 81.64. IEF's basically flat, but still red at 92.97. So longer duration bonds are taking the bigger hit, which usually means equity leadership has to be very selective. And that's exactly what we're seeing with QQQ holding green while the rest of the tape chops. The dollar's a touch lower at 28.09. Yen's barely weaker at 57.57. So FX isn't screaming stress, but it's not giving a huge green light either. Meanwhile, gold is bid. GLD around 406.11, up 1.15%. And oil's firm too. USO around 127.24, up 0.51%. That's the awkward macro cocktail. Growth stocks are holding, but the market is still paying for hedges and hard asset protection. Basically, the tape is drinking coffee and chamomile tea at the same time. Crypto proxies are also green. BITO up 1.71%, Coin up 1.85%, MSTR up 4.87%. So there is risk appetite, but that corner can move like it's had 3 espressos. So treat it as a sentiment gauge, not a stable compass. So next up on the clock, this is the sneaky part of the afternoon. Empire State hits at 12:30 Eastern, then NAHB at 2 o'clock. I'm not trying to make some giant Fed call off either one, but I do want to see the reaction function. If the data drops and bonds still can't catch a bid, with TLT sitting right around 81.6 and IEF barely moving, then stocks may have to do more of the heavy lifting on their own. And that's exactly the tape we've got right now. QQQ green, but not blasting off. The 1-minute range is pretty tight, roughly 732.5 to 734.6. Early push, volume confirmed it. Then the flag got choppy, and now it's sagging back toward that 733 area. So for my macro watch list into the next hour, VIX is still hanging near 20. Not panic, but not relaxed. QQQ needs to reclaim and hold 733 if tech wants to clean this up. TLT around 81.6 is the bond tell, and then gold up about 1.1%, oil up about 0.5%, both still bid, which keeps this from feeling like a pure growth chase. All right, that's the cross-asset map. Coming up, let's flip into Mega Cap Watch and see which of the big names are actually carrying this tape. All right. Quick macro map. Let's zoom out from the small cap fireworks and look at the tape underneath it. Here at the macro desk, this is not a clean risk-on day. It's a selective risk-on day. SPY is sitting around 775.4, down 1/10. QQQ is green around 732.7, up about 0.25%. And IWM is the laggard at 304.1, down roughly 1/3. So the market's basically saying, mega cap growth, you can stay at the party. Small caps, please wait outside with the clipboard. VIX is still sticky near 19.45, up 0.5%. So there's no full panic here, but the risk thermostat is not exactly set to beach vacation. Breadth is mixed, and that matters. NASDAQ leadership is holding the index tape together, but it's not broad enough to call it a victory lap. The bond side explains a lot of that split. TLT is down about 0.5% at 81.64, while IEF is barely lower at 92.97. So the pressure is heavier out on the long end. When long-duration bonds are soft, the market usually gets pickier. Profitable mega-cap tech can still catch a bid, but smaller, more rate-sensitive stuff has a tougher time. That lines up with QQQ green and Russell red. The dollar proxy is a little softer at 28.09, down about a tenth. And the yen proxy is basically flat at 57.57, so FX is not screaming stress right now. But even if you only trade US stocks, keep one eye on bonds and dollar yen. That's the plumbing. Nobody watches the plumbing until the basement floods. And then suddenly everyone's a macro tourist. Now, the real asset side is where you can feel a little hedge bid under the surface. Gold's around 406.11, up 1.15%. Oil's around 127.24, up about 0.5%. So yeah, geopolitics, inflation sensitivity, growth worries, all of that is still keeping money in the safe haven and hard asset bucket. But it's not derailing equities yet. QQQ is still green by about 0.25%. SPY is only slightly red. VIX is hanging just under 19.5. That's not panic, that's more like a mixtape with hedges on. And then crypto risk appetite is actually fine here. BITO up 1.7%. Coin up 1.85%. MSTR up almost 4.9%. Crypto's always a different animal. Highly volatile, unregulated, can flip fast. But for a risk check, those being green says buyers haven't completely gone defensive. Next macro timestamps. Empire State at 12:30, NAHB at 2 o'clock. So for the desk, the concrete math is pretty simple. QQQ needs to defend that 732.50-ish lower range. And if it can reclaim 734.60, that's the intraday high bulls want back. Below that lower band, the fade matters more. Above the high, tech leadership gets louder again. All right, that's the macro map. Let's hand it back to the tape and see which single names are actually paying us for attention.
Thanks, Macro Desk. Let's pull up AVGO, because this is exactly the kind of mega-cap tech tell I want on screen when QQQ is green and the rest of the tape is messy. QQQ is up about 0.25%. SPY and IWM are slightly red, and AVGO is up about 1.3%. That's real relative strength. But the daily is not a straight rocket. Look at this. It ran from the mid-350s up near 495, then got hit hard, heavy volume reversal, and now it's living in this 370 to 420-ish box. Today we're around 398, high just under 400, low down near 392. So the market's desk read is simple. Strong company, strong long-term trend, but the chart is in repair mode. Here's the daily level map. The 390 area matters. That's the support shelf from the recent range, and it lines up with the 50-day zone in the technicals. If AVGO starts losing 390, that's where this stops looking like healthy consolidation and starts looking like the lower end of the box is cracking. Above it, the first problem is 400. You can see the stock knocking on that door today, but not really blowing through with authority yet. And then the real daily ceiling is 420. That's the top of the post-breakdown range. So I'm not treating this as a clean trend day on the daily until it starts accepting back through that upper range. RSI is neutral, ADX is low. Translation, it's not exhausted, but it's also not screaming momentum right now. All right, let's drop down to the 1 minute, because this is where AVGO gets more interesting. Oof, look at that wick sequence early. It opened around 397.7, slid into the mid-session low near 394.5, and that dip had real volume behind it, roughly 120,000 share burst on one of those bars. But then buyers stepped back in. That's the key. It reclaimed 397, pushed up through 398, and tagged just above 399.3 with elevated volume on the bounce. Now right here, it's not exploding. It's basing, sideways, volume easing. That's fine, but it means the next move needs confirmation. For me, 399.30 is the intraday lid. If it clears that and holds with volume, that's the breakout attempt out of the base. If it loses 394.50, then that nice bottoming structure from earlier gets a lot less pretty. Quick catalyst check on AVGO while we've got it. This is not an earnings today situation. The press release says Broadcom reports fiscal Q3 on September 2nd, after the close. The bigger story in the background is still AI infrastructure. That June release with OpenAI on the LLM optimized processor, plus the standard chartered private cloud deal in July. So yeah, AVGO trades like semis, but also like infrastructure software. That's why it matters when the NASDAQ leadership is narrow. I'll flip it back to the chart here. Scoreboard for AVGO. 390 daily support, 399.30 intraday breakout line, 420 the bigger daily range ceiling. Coming up, we've got the Whisperer update, so we'll see how the paper book is handling this choppy tape.
Thanks, Markets Desk. Quick paper book check here at the Stock Whisperer. This is the show's simulated $100,000 paper portfolio, so we're grading process here, not handing anybody trades to copy. Tape still mixed, QQQ green, breadth not exactly beautiful, so I'm not forcing fresh risk. EYPT first, short 1,000, entry 4.511, last about 4.515, basically flat, down $3.80. Thesis is still that post-flush continuation, but it hasn't paid us yet. Bracket is simple, cover into 3.55 if it flushes, stop is 5.15 if it reclaims and squeezes. Forward is cleaner, long 600 from 1385, now 14.165, up 189. Quiet winner, not a momentum chase. GS is the one I don't love right now. Short 10 from 1038.24, now 1051.94, down about 137. Still inside the risk box, but it's working against us. 1062.50 is the stop, 988 is the cover level. Next 3 positions. PYPL, long 150 from 59.6199, trading 60.40, up 117 bucks, plus 1.3%. That thesis is still fine as long as it doesn't lose 58.85. The upside working order is 64.50. SPGI is the best behaving short on the sheet. Short 20 from 424.155. Now 412.31, up 236.90, almost 2.8%. That one has a clean bracket too. 405 cover below, 418.80 stop above. TSLA is the small paper loser. Short 30 from 338.75, now 340.385, down about $49. I don't see a working TSLA bracket on the order blotter, so I'm treating that as manage only, no add, no fresh hero trade. Net the open book is up about 353 unrealized, cash is around 91.7 thousand, and with 6 positions already on, the discipline is not to chase every headline. Now the orders tab. This is the actual risk map. EYPT has the buy limit at 355 and the stop at 515. SPGI has the buy limit at 405 and the stop at 418.80. GS is wide but defined, cover order at 988, stop at 1062.50. PYPL is the long bracket, sell limit at 64.50, stop at 58.85. That's the whole point here at the Stock Whisperer. Thesis, level, bracket, then grade it honestly. On the watch list, MSFT still needs either a 488 reclaim or a 482 failure after that Azure catalyst. NVDA only gets interesting to me above 228 if QQQ stays firm. With QQQ still mid-range and VIX near 19.5, I'm staying patient. Coming up, small cap momentum can dig into the runner tape. This desk is in review mode for now.
Thanks, Stock Whisperer. All right, SLE momentum check. And oof, this thing is not clean. Up about 23% on the day, yeah, but the market's mixed. IWM's red, and this is a tiny small cap tape. So here at the markets desk, I'm not chasing the percent move. I'm grading the candles. Look at the morning structure. SLE opens around 313, dips toward 308, then bang. Buyers step in and push it up into that 323 area, eventually tagging about 329. That first move had volume behind it, so that part was real momentum. But then the character changed hard. Around the hour mark, it loses the base and flushes from roughly 324 down toward 2.83. And that sell candle came with a monster volume spike, over 170,000 shares in 1 minute in the chart read. That's not some quiet drift. That's supply hitting the tape. So the trap check now is simple. 2.83 is the first line. If SLE loses 2.83 again, That earlier breakout is fully suspect. If it can reclaim and hold 2.90, then maybe it starts repairing. But the real resistance is still that broken 320 to 323 zone. Now, context matters because this is a micro-cap communication services name, about a $4.5 million market cap, roughly 1.6 million shares outstanding, and volume today is over 20 million shares versus average volume around 630,000. That's why it moves like this. Tiny float, huge turnover, wide candles. Closest company headline in the feed is Friday's Q2 results, improving margins and operating performance. So there is a recent catalyst backdrop, but today's candle is way more tape-driven than headline-driven. And I'm going to say it plainly. Low float runners like this can halt, reverse, and trap people fast. This is levels and liquidity, not a victory lap. And here's the risk page. This is why the markets desk is not romantic about SLE. Dilution risk is marked high. Active shelf, active equity line, pending S1. And the system shows about 72 million raised over the last 12 months. That matters on a 1.6 million share float. Supply can show up. So my scoreboard is above 2.90, it's trying to stabilize. Above 3.23, okay, now you've reclaimed the broken base. Below 2.83, danger zone. Below 2.75, that's day low pressure and the tape gets ugly fast. Coming up, quick pro terminal plug, because this dilution screen is exactly the kind of stuff you want open before you fall in love with a small cap candle.
Thanks, Markets Desk. Breaking note here from the macro desk. C1 is exploring a sale after takeover interest. That is the headline crossing the desk right now. What we know, the company is considering a potential sale process after receiving interest. What we do not know yet, who the bidders are, whether there's a formal offer, what the price would be, or if this turns into an actual signed deal. So the market re is pretty simple. This becomes an event-driven tape, and event-driven tapes can get jumpy fast. Takeover interest can create a premium bid, sure. But until there are terms, it's still smoke, not a signed check. And as always, smoke is very tradable, but it also sets off the fire alarm for no reason sometimes. Next big corporate headline. Oracle is cutting roughly 10,000 jobs in India, about 20% of its workforce there, as part of a major restructuring. Why it matters? This is margin story versus growth story, right? Cost cuts can help earnings leverage, but a reduction of that size also tells you management is tightening the belt in a pretty meaningful way. For Oracle holders and enterprise software watchers, the question is whether this is clean efficiency or a signal that parts of the operating base are under pressure. The spreadsheet likes savings. The tape usually asks why you needed them. And then, AMD. The desk is tracking AMD's data center outlook, forecasting a much bigger AI infrastructure market. A $1 trillion total market by 2030, with custom chip revenue expected to become more meaningful starting in 2026. This matters because the semi-trade is still basically the market's growth engine with a fan strapped to it. QQQ is around 732.6 and still green, while SPY and IWM are a touch red. So megacap and AI-linked leadership still has the benefit of the doubt intraday. But with AMD, the headline is long horizon execution. Custom silicon, data center share, and whether those big market forecasts turn into actual revenue. Coming up, we'll hand this back toward the movers board and see what's actually getting paid on the tape.
Thanks, Macro Desk. Quick Stock Whisperer paper book check. This is the simulated broadcast portfolio, not a copy this signal. And we just closed the GS short, 10 shares. The reason is simple. The thesis was no longer clean. GS was moving against us in a mixed tape. QQQ green, SPY and IWM a little red. And that short was tying up a slot I'd rather keep available for a cleaner catalyst setup. So I'm not forcing it. I'm cutting the dead weight, freeing the slot, and keeping the book more intentional. Open book now is 5 positions. EYPT short, entry 451, now about 453, down roughly $19. Still small, but it needs to stay contained. F long, 1385 entry, 1417, now, up about 189. PYPL long, 59.62 versus 60.36, up about 111, and that 58.85 stop is still the hard line. SPGI short is the best worker, 424.16 entry, 412.36 now, up about 236. TSLA short is slightly against us, 338.75 versus 339.77, down about 31. Stops still matter. EYPT 515, SPGI 418.80, PYPL 58.85, TSLA 346.50. F is green, but I don't see an active bracket on this orders list, so I'm reviewing that before doing anything fresh. Coming up, we'll kick it back to the movers board. Thanks, Stock Whisperer. Quick pit stop at the markets desk, because all the stuff we're pulling up live is inside Pro Terminal. This is the dilution center. Not sexy, but huge. When a small cap runner is flying, I don't just want the green candle. I want to know if there's shelf risk, ATM risk, offering history, any little landmine sitting under the move. Data can be incomplete or delayed, yeah, but this is where the risk check starts. Now, flip back to the movers board. This is the heartbeat of the show. Look at this tape. SPY slightly red, IWM red, QQQ barely green, and you've still got WFF up almost 300%, IPST up about 265%, IVF up 118%. That's why relative strength matters. But big but, this board is not a buy button. It's a scanner. It tells you where volume and attention are hitting. Then you go do the work. Let's use IPST as the example. Big mover today. Monster relative volume. So now the workflow is, don't marry the headline, check the filings. Recent registrations, offerings, weird amendments, insider activity. That stuff can completely change how you read a move. Oof. And this is where traders get hurt if they only stare at the chart. Green candle looks great, then a filing drops and the whole tone changes. Pro Terminal keeps those tabs right here, so you're not hunting through 5 different pages mid-move. And then, boom, right back to the 1-minute chart. This is where the markets desk lives. Candle structure, volume bursts, VWAP behavior, wicks, failed breakouts, real momentum versus trap city. The point is not that Pro Terminal tells you what to do. It doesn't. The point is it puts the tape, the mover board, dilution context, filings, insider data, and the chart in one workflow, so you can make a cleaner read. Coming up, we're going right back into the mover scan. If you want the same setup we're using on stream, sign up at proterminal.io.
All right, let's hit the movers board. Markets desk is going straight to what's actually moving. Look at this board. Tape is mixed. SPY a touch red, QQQ barely green, IWM red, and then the small cap board is just chaos. WFF is still the headline, 568, up 294%, 49 million shares, about 446 times normal volume. That's not a move, that's a liquidity event. IPST right under it, 788, up 258%, and the relative volume is bananas, 1,750 times. IVF, 215, up 122, over 100 million shares. WITO, basically a double at 1642. Then you've got AGRZ and OSRH in the sub-dollar lane, both ripping, but a totally different kind of tape. So here at the markets desk, we're not worshipping percent gainers. We're checking volume, float, VWAP, and where the chase starts to fail. Let's pull WFF first, because this has been the main scoreboard name all morning. Oof, this is exactly why you don't just stare at the plus 294 and shut your brain off. WFF is a tiny float, about 1.6 million shares, and it's already traded 49 million. Earlier, we got that 850 push. Then it lost 8. Now the board has it around 568. So the chart question is simple. Is this rebuilding, or is it just bouncing under supply? For me, $6 is the first reclaim. Above 6? Okay, the bid is trying to repair. Under 550, I start treating that as fade pressure again. VWAP is the referee here. And because Pro Terminal has this tagged high dilution risk, keep that in the front of your head with these microcaps. This can rip, it can also rug fast. Now, IPST is the crazy relative volume one. This thing is up 258%, trading around 788. And the volume number is just ridiculous. 88 million shares versus roughly 50,000 average. That's not a little spike. That's the whole crowd showing up. What I'm watching on this one is super simple, $7 to $8. If it keeps accepting back inside that zone and can actually hold near 8, okay, that's still active momentum. But if every push into 8 gets slapped and it starts living back under 7, then that zone turns from launchpad into supply real fast. Also, small cap runner, high dilution risk on the board, so don't treat the percentage move like it's free money. These can reverse brutally. IVF next. And this is a different flavor. Price is around $215, up 121%. But look at the turnover, over 100 million shares. Float on the board is only about 1.8 million. So yeah, this has recycled the float a bunch of times already. For me, the $2 area is the whole read. Above 2 with candles still getting volume on the green pushes, it's at least trying to build a base after the big move. But if 2 starts failing and the bounces get weaker, that's where these healthcare runners can turn into a long bleed instead of a clean continuation. I want volume confirming, not just a random candle popping into thin air. Weto now. And this is the one that's different from the $2 chaos. This is trading around $16.40, up basically 100%, with 17.5 million shares already through it, and that's almost 390 times normal volume. So yeah, real attention here. But at this price point, the wick risk matters way more. If this thing is tagging highs and immediately snapping back, that's not the same as clean momentum. That's supply showing up. For me, 16 is the line on this chart. Above 16, it can still look constructive intraday. Lose 16 and start accepting underneath it, and that turns into a trap line pretty fast. Let's do the sub-dollar pair quick. AGRZ first, 44-cent stock, up 82%, 51 million shares. Relative volume over 200 times normal. That's a monster scan number. What I'm looking for on this one is whether the bid is actually stepping up, or whether it's just one big shove and then chop. Under a buck, you don't need much to get those violent 10-15% candles, so clean holds matter.
Now flip OSRH. This is even more volume, 218 million shares, trading around 55 cents, up 74%. But the difference is OSRH has that higher dilution risk tag on the board, and the tape can get churny when that many shares rotate. So AGRZ is the cleaner bid if it's holding levels. OSRH is the heavier penny stock tape, where I'd be way more suspicious of failed pops. Okay, quick cleanup on the other side of the board because the losers matter too. EYPT first, biotech, down about 69%, trading around 453. And that volume is not small, 33 million shares, 23 times normal. So for me, 450 is the damage control line. If it's living under that, it's not stabilizing, it's still leaking. If it can hold above it and stop making new lows, okay, then maybe the panic starts to calm down. But right now, this is still a broken chart until proven otherwise. Now ZTG, same kind of percentage wipeout, down 69%, but a much thinner tape. About 1.3 million shares, 17 times volume, sitting just over $3. Whole $3 is the obvious spot there. Lose 3 clean, and the downside board stays in control. Then the late board momentum names. Trug versus CDTG. Trug is the one I'd actually keep on the follow-up list. 154, up 59%, 53 million shares, 165, relative volume, tiny float. So yeah, it can move, but it can also rug fast. 150 is the line I care about. CDTG's up 37%, decent relative volume near 70, but it's less explosive than Trug, and it has that high dilution risk tag. So I need to see it reclaim 3 before it gets interesting again. Alright, movers board is mapped. Trug is the cleanup name I'd revisit, EYPT and ZTG are the downside tells, and we'll roll straight into the next tape check.
Thanks, Markets Desk. All right, quick macro check, because this tape is mixed on the surface, but pretty clear underneath. SPY is sitting around 775.20, down 0.15%. QQQ's actually green, around 732.5, up 0.19%. Russell's the soft spot, IWM 304.2, down 0.30%. And VIX is up a touch at 19.46. So the message is not panic, it's selective. Big cap NASDAQ still has a bid. Small caps are paying the toll booth for higher rate anxiety. And vol refusing to go away is the market's little smoke alarm chirping in the hallway. Annoying, not a house fire yet. Here at the macro desk, when QQQ is green and IWM is red, I immediately look at rates. Here's why rates matter right now. That 1230 NY Empire manufacturing number came in 20.6 versus 11 expected. Better growth pulse. Good news for the economy, but the bond market heard it and basically said, cool, no discount for you. TLT is down 0.47% at 81.66. IEF is just a little lower at 92.99, so the long end is taking more of the hit. That's the curve talking. If you only trade U.S. equities, you still care, because that pressure hits Russell first, caps the lower quality stuff, and lets the biggest NASDAQ names become the defensive growth couch everybody piles onto. The dollar isn't really the villain here either. UUP is slightly lower at 28.09. Yen ETF FXY basically flat around 57.58, so this is more rates and growth than FX shock. Okay, quick cross-asset check before we hand it off. Gold's got a bid here, GLD up about 1.1%, and oil's green too, USO up roughly 0.5%. So the inflation-sensitive stuff is not really rolling over. That matters when bonds are already under pressure. You've got better growth data, firm commodities, and the market's still kind of refusing to fully panic. Then look at the crypto-linked names, Bito Green, Coin Green, and MSTR up almost 5%. That's not a defensive look. That's speculative risk appetite still hanging around. But yeah, crypto's the wild, unregulated corner, so I treat that more like a liquidity read than some clean, all-clear signal. Now the actual macro watch list. QQQ is still the tell for me. On the 1 minute, it faded off the 734s, and it's trying to build this little 732.4 to 732.7 shelf. I'm writing down 732.37 as the intraday line. If that cracks, the lower high structure is still in control. If it can reclaim 734.3, then bulls actually have something to work with. VIX is sitting around 19.5, so 20 is the clean risk barometer. Bonds are still soft. TLT down about 0.5%. IEF a little red. And we've got NAHB housing at 2 p.m. Eastern, so rates plus housing is the next macro impulse. All right, coming up, let's kick it back to the movers board and find where the real stock-specific action is.
Thanks, Macro Desk. Quick snapback to SLE on the 1 minute, because our 290 level just got paid. All right, look at this. Current read is around 297, so yeah, it reclaimed 290, but this is not some clean rocket candle. This is a post-flush base. Big difference. Market's mixed, IWM red, so small cap follow-through has to prove itself here. Oof, look at that wick zone from earlier. The stock opened around 318, pushed into 329, then that whole upper area just failed. The real candle on this chart is the breakdown bar, from the low 320s down into the 280s, and the volume spike was the tell. Over 171,000 shares on that drop, into about 2.83. That's not random noise. That's supply showing up and saying, nope, not up here. Now the better part for tape readers. After that flush to 2.75, it didn't instantly fall apart. It bounced, chopped, and started building this 2.95-ish shelf. So here at the markets desk, I'm not treating this as bullish just because it bounced. I'm treating it as a decision box. Above $3 with volume, the base gets interesting. Lose 2.90 again, and that reclaim becomes a head fake. So, the scoreboard is pretty clean now. We flagged 290 earlier, it crossed, good hit. But now, the chart has to hold the receipt. I want to see whether buyers can defend that 290 to 229.5 pocket without needing panic volume. If this starts curling through 300 and the candles expand, okay, that's actual acceptance. If it slips under 290, then eyes go right back toward 275, the day low flush zone. That's the trap risk on these names. They can bounce just enough to pull attention back in, then roll over. Coming up, small cap momentum is on deck, so this is exactly the kind of level-by-level tape we're carrying into that. All right, quick small cap danger tape, CISS on the 1 minute. Coming off that SLE breakdown, same rule here at the markets desk. Levels or leave it alone. And first thing, this is trading around 5.9 cents, literally a 6-cent stock. Anything under 10 cents can get delisted at any time, and this is not something I'd recommend for day trading. We're reading it because the tape is wild, down about 18%, almost 14 million shares traded versus an average under 900,000. Mixed market, Russell soft, and CISS is still getting hit. Oof, look at that wick. This opened near the high, 0.0668, and never really reclaimed control. Early tape was tight around the mid 6-cent area, then it cracked that 0.0651 support zone, and once that broke, the character changed fast. Lower highs, lower lows, volume expanding on the red candles, especially through the 0.062 to 0.060 area. That's not a quiet drift. That's sellers confirming the breakdown. VWAP isn't in this feed, so I'm not going to fake a VWAP number, but structurally this is below the broken base and living near the lows. Current read around 0.0592. Day low down at 0.0573. If this can't reclaim the old support, the bounce is just noise. Now hit the dilution page, because this is the part chat always skips on names like this. CISS is flagged high risk here. Active shelf, active equity line, a long offering history, that matters when the stock is sitting under 10 cents. Low float stuff can bounce violently, sure, but overhead supply can also just bury every pop. And with subdime names, you've got the full risk stack. Halt risk, dilution risk, pump and dump risk, and delisting risk. So if you're watching it, don't treat the percentage move like a green light. Treat it like a warning label with candles attached.
Thanks. Markets Desk. Breaking healthcare tape first. ProTerminal's newsroom is tracking a sharp move in Medicare Advantage insurers. United Health and Humana are getting hit, down more than 14% after CMS proposed next year's rate increases near zero. Here's what we know. This is a proposed reimbursement backdrop, and investors are reading it as revenue pressure and margin pressure in one of the biggest growth lanes for the insurers. What we don't know yet, the final CMS rate, how the companies respond, and whether there are offsets in benefits, pricing, or cost controls. Market read is pretty clear, though. This is policy risk landing right on the P&L. SPY is only off about 17 basis points. VIX is still under 20 at 19.6. So this isn't broad panic. This is a sector-specific trapdoor. Very macro, very boring, very expensive. The government reimbursement machine rarely rings a bell before it changes speed. Next headline, Tesla. Regulators have escalated the probe into full self-driving after crash failures tied to visibility conditions. The fact pattern matters because Tesla's autonomy story is not just a product line. It's a major part of the valuation debate. We don't have a penalty number, recall scope, or timing here, so we're not filling in blanks. But the market implication is straightforward. More regulatory scrutiny can mean higher compliance costs, slower rollout, and more volatility around every FSD update. And with QQQ only up about 16 basis points at 732-ish, the growth tape is not exactly handing out free umbrellas today. And the macro desk has to hit the metals story. Gold down nearly 6%, silver down 8% in a single-day washout. That's a big move for assets people like to pretend are boring. Why it matters? Metals are the pressure gauge for real rates, inflation hedging, dollar sensitivity, and risk appetite. When gold and silver both take that kind of hit, the market is telling you something changed in the macro discount rate. Or at least traders are repositioning like it did. On our live cross-asset board, the gold proxy is sitting around 405.9, and oil is still firm near 127.25. So this isn't a neat little textbook chapter. It's a messy rotation. which frankly is the only kind markets publish. Coming up, we'll flip back into the Pro Terminal workflow and then the movers board. All right, quick vol check. This is where the market tells us if it's nervous or just pretending to be busy. VIX is sitting around 19.56, up just over 1%, and that matters because the tape underneath is mixed. SPY slightly red, QQQ barely green, IWM weaker. So this isn't panic. This is more like the market putting a rain jacket on and checking if it remembered the umbrella. Here at the macro desk, the clean line is still 20 on VIX. Below it, chop is annoying but contained. Above it, the cost of being wrong starts going up, especially when breadth is already messy. And no, we're not doing options chain gymnastics without chain data. That's how people turn a dashboard into astrology. Now let's put a real stock under that vol lens. UNH. Big healthcare heavyweight, down about 2.5%. And this one's tied into that Medicare Advantage rate shock the news desk just hit. Near zero rate hike, insurers do not love that sentence. On the 1-minute chart, look at the shape. Early push-up toward 395.68. Volume spike around 47,000 shares. Then it fades all the way down near 391.55. Since then, it's basically been trying to build a little base in the 393.5 to 394.5 zone. That's the key for single-name volatility. The range expanded first, then volume cooled. So I'm watching 395.68 above as the spot where buyers would have to prove this isn't just a dead cat conference call. And 391.55 below as the floor where the headline pressure gets teeth again.
Thanks. Macro desk. Quick tool check while the tape's mixed. This is Pro Terminal. The first stop for me, especially with these little midday rockets, is the dilution center. Not sexy, super important. Shelves, ATMs, offerings. That stuff can change the whole risk profile fast. We're not using it as a crystal ball. We're using it to avoid getting blindsided. Now flip to the movers board. This is the heartbeat of the show. Look at this board. IPST still up over 250%. WFF still huge. EYPT smashed on the downside. Oof! That spread between winners and losers is exactly why the board matters. But key point, green row does not mean buy signal. Red row does not mean short signal. It's triage, price move, relative volume, market cap, float when it's there. Then we go verify the story. Here's the second click in the workflow. Pull up a name. I'll use TRUG because that one gave us the clean 1.50 follow-through earlier. And I'm going straight to filings. If a stock is moving, I want the paper trail, recent filings, offering language, insider activity, anything that tells me whether the move has a real catalyst or just air underneath it. And yeah, data can be delayed or incomplete, so you still read the actual filing. Pro Terminal just gets you there fast. Then the chart decides if the story matters right now. One click, 1-minute terminal chart. Candles, volume, levels, VWAP behavior. That's where the market's desk lives. If you like how we're flipping from movers to dilution to filings to the actual tape, that's the whole point. It's research first, execution second. And this stream is educational, not me telling anybody what to do. You can get the same platform at proterminal.io. Coming up, we'll hit the mover scan again and see what's actually still alive.
All right, let's hit the movers board. Fresh scan, high tempo, no wasted rows. Mixed tape out there. SPY a little red, QQQ barely green, IWM red, VIX still hanging near 19.6. So if something's up 200% in this tape, yeah, it earns a chart. Top of the board is IPST, up about 267%, almost 90 million shares. And that relative volume is ridiculous, over 1,700 times normal. Then WFF, WETO, IVF, OSRH, same theme. Tiny floats, monster volume, headline-style liquidity. Fun charts, but crowded charts. Here at the markets desk, I care less about the headline percent and more about one thing. Are they holding above the obvious reclaim levels, or are late buyers getting stuffed? Let's start with IPST, because this is the board leader and it's not even close. Heritage Distilling, craft spirits name, trading around 8.08, up 267%, with 89.8 million shares already through the tape, versus an average around 50,000. That's not normal interest. That's a full-blown liquidity event. Float is about 10.2 million, market cap only about 5.5 million, and ProTerminal has dilution risk marked high. So you've got the classic small cap runner mix, explosive volume, tiny structure, and real overnight filing risk in the background. On the chart, the cleanest line for me is $8. Above 8, buyers are still proving they can absorb supply. Below 8, oof. Then I start watching for that air pocket where the move becomes chase heavy instead of controlled. I'm not calling a trade here, just scoreboard. If IPST can keep accepting over 8 with volume, it stays the leader. If it loses 8 and can't reclaim it, this board can rotate fast. Now, WFF. This one's still a monster on the board, but you can see the character is different from IPST. It's around 431, up basically 200%. 55 million shares traded, and the float is tiny, about 1.6 million. So yeah, it can move, but this is also where it gets jumpy. The big thing for me is $4. If buyers keep defending that $4 area, fine, you still got dip buyers showing up. But if it starts living under 4, that tells you the earlier momentum is getting heavy, and the squeeze crowd is backing off. Huge relative volume, high dilution risk name, so don't treat this like some clean large cap trend. This is a low float runner that can flip fast. Wedo next, and this is the follow-up, because that 16 level we flagged earlier got hit, and it didn't just tag it, it pushed through. Now it's trading around 1745, up 112%, with about 18.4 million shares through the tape. So the question changes. This is no longer can it break 16, it already did that. Now is 17 plus real continuation, or is this the late push where volume starts getting tired? I'd keep the eye right on 17. If 17 keeps catching bids, the tape is still acting strong. If it loses 17 and can't reclaim it, that's where I start thinking exhaustion instead of continuation. IVF now. This is the healthcare runner. And look, this is the kind of tape where the round number matters more than almost anything else. Stock's around $2, up a little over 100%. And the wild part is the turnover. Over 100 million shares traded against a float that's listed under 2 million. So yeah, this is not sleepy volume. This is full-on churn. The clean line here is $2. Above 2, the chart still has that momentum look. Buyers keep defending the psychological level. Dips get absorbed, and you can see why scanners keep picking it up. If it starts living under 2, that changes the feel fast, because then the move becomes more of a failed reclaim than a clean hold. Also, high dilution risk on the board, so on these tiny healthcare names, you've got to respect that risk even when the candles look good. OSRH next, and this is the sub-dollar momentum lane, totally different personality. We're around 58 cents, up more than 80%. But the volume is the headline, 230 plus million shares, about 48 times average volume. That tells you there's real participation, but with sub-dollar names, the question is always quality of bid, not just the headline volume. I'm watching that 60-cent area as the near-term line, where it either keeps accepting higher prices or starts rejecting. If the bid thins under the mid-50s, that's where these can get slippery. Quick compare to AGRZ, same sub-dollar momentum bucket, around 37 cents, up about 50%, and the relative volume there is even crazier at more than 350 times average. AGRZ has the cleaner board stat on relative volume, OSRH has the bigger raw share turnover. Both are fast, both can air pocket. So this is one of those spots where the tape matters candle by candle. Quick downside refresh before we wrap the board. ZTG first, and I'm not going to rehash the whole rug pull story here, just the level. This thing's around 296, down basically 70%, so $3 is the whole fight. If it can't reclaim 3 and actually hold above it, the bounce attempts are just noise to me. Volume's there, almost 20 times normal, but on a loser, that can just mean liquidity for sellers, not demand. Now flip EYPT, same idea. Bigger, cleaner biotech name, way more volume, down about 69%, and 450 is the line. It's sitting right on top of it, around 452. So if that starts leaking under 450 with speed, that's where the chart can get ugly again. And then AIFU, weird one, down 42%, but only about 115,000 shares traded. So yeah, it's on the loser board, but that's not the same kind of liquid flush as EYPT. Wide name risk, thin tape risk, don't overread every tick there. All right, that's the movers board. Runners are still IPST, WFF, WEDO, IVF, OSRH. Downside watch is ZTG3 and EYPT 450. Coming up, we're staying on candles and pulling up IMCC for a proper chart read. All right, let's pull up IMCC real quick. This is a pure candle read, tiny price, big tape sensitivity. Look at the first push here. Opened around 9.3 cents, tagged just over a dime, and the volume actually confirmed that first move. That's the key. It wasn't just a random wick. The push from about 0.0945 to 0.0971 came with the heaviest volume on the tape. But since then, chop, base, a lot of back and forth. Not a clean trend yet. Oof, look at that range though. Day low 0.0926, day high 0.1011, and right now it's sitting up near the top of the box, around 0.1008. So here at the markets desk, I'm not overcomplicating this one. The base was roughly 0.095 support to 0.098 resistance. And now price is trying to live above that upper band. That's constructive if it holds, but it's still a dime stock basically. These can snap back fast. If 0.1011 gets taken with real volume, that's the first upside confirmation level. Not a magic level, just the day high line where the chart either accepts higher or gives you one of those nasty fake breakout candles. Underneath, 0.095 matters. Lose that and this starts looking like the whole mid-morning base failed. So the read is simple. Early buyers showed up, volume faded, and now it's pausing right near the high instead of rolling all the way back down. That's decent relative behavior for a tiny name while the broader tape is mixed. SPY a little red, QQQ barely green, VIX still pressing near that 20 line the macro desk flagged. For IMCC, I'd keep the scoreboard clean. Above 0.1011 with volume, buyers are proving it. Below 0.095, the base is cracking. And if it just sits between 0.098 and a dime, that's noise. Coming up, we'll widen back out with the market overview.
Thanks, Markets Desk. Quick market minute for anyone just jumping in at 1:06 Eastern. The tape is doing that very Monday at lunch thing where it looks calm until you check under the hood. SPY 774.55, down 0.23%. QQQ 731.70, still green by 0.09%. IWM 304.24, down 0.28%. VIX 19.64, up 1.47%, but still under the big 20 line. So the story is not panic, it's selectivity. Also, that QQQ 732.37 level the macro desk flagged earlier did get tagged. So the Nasdaq bid is outperforming, yeah, but it's not exactly wearing a cape here. Breadth is mixed, which is macro speak for everyone nodding in the meeting while quietly disagreeing. The Y is pretty clean. The 1230 Empire State number came in hot, 20.6 versus 11 expected, and bond proxies didn't love it. TLT is 81.61, down 0.53%. IEF is 92.95, down 0.10%. That's firmer rate pressure, and it tends to hit the Russell-style stuff first, which fits IWN red at 304.24, while QQQ is just barely green. Meanwhile, the dollar proxy is a touch softer at 28.09, down 0.09%. The yen proxy is basically flat at 57.58. And that gives room for the commodity and crypto side. Gold at 405.95, up 1.11%. Oil at 127.55, up 0.75%. BITO up 1.77%. Coin up 1.41%. NSTR up 4.4%. So cross-asset read, no crash siren. More like the risk thermostat is stuck at mildly uncomfortable. Here at the macro desk, I'm watching VIX 20 QQQ 733.30 as the first clean reclaim, oil around 127, and that 2 p.m. NAHB housing print. Coming up after this reset, we've got the IMCC deep dive, then the simulated whisperer book check. All right, quick macro desk reset. Zoom out for a second, because the tape's doing that very annoying midday thing where every asset class is telling a slightly different joke. SPY is down about 23 basis points at 774.56. IWM is off 28 basis points at 304.24, but QQQ is still barely green, around 731.69. So that's the shape. Mega cap growth is the shock absorber, small caps are not getting invited to lunch, and underneath it, bonds are still soft. TLT down 0.53% at 81.605, IEF down a tenth at 92.95, which basically says rates are leaning higher enough to keep the broad market a little uncomfortable. We also did hit that QQQ downside line from earlier at 732.37, so the Nasdaq isn't exactly sprinting. It's more like walking quickly while pretending it meant to. Now the interesting part is the cross-asset chain. The dollar proxy is actually a touch lower, UUP around 28.085, down 9 basis points, and the yen proxy is basically flat at 57.575. So this isn't a big dollar wrecking ball move. Instead, commodities are carrying the message. Gold's up 1.11% to 405.95. Oil's up 0.75% to 127.55. That combo says the market is still paying for insurance and inflation sensitivity at the same time, which is awkward. Kind of like bringing both sunscreen and an umbrella and somehow needing both by noon. Even if you only trade US stocks, oil matters here because higher energy can feed the rate narrative, and rates matter because they hit long-duration growth and small-cap funding first. Crypto's got a little risk bid too. BITO up 1.77%, Coin up 1.41%, MSTR up 4.4%. But that's a pocket of appetite, not a full market all clear. Crypto is its own highly volatile beast, as always. All right. Breaking news first. ProTerminal's newsroom is tracking oil pulling back on hopes the Strait of Hormuz is reopening. Here's what we know. Oil prices fell 5.3% after reports that non-Iranian tankers moved through the strait, and that takes some heat out of the supply disruption trade. What we do not know yet, and this matters, is whether that traffic keeps flowing, whether insurance and shipping risk actually normalize, or whether this is just the market exhaling for 5 minutes and then checking its phone again. The market read is pretty clean. Lower oil stress is equity-friendly at the margin because it eases the inflation impulse. But on our screen, the oil proxy is still around 127.55, so this is relief, not some all-clear parade. SPY is still sitting near 774.47, down about 0.25%. QQQ barely green, around 731.42. So yeah, pressure valve opened, but nobody is putting the helmet away yet. Next headline, Fed minutes indicate a delay in rate cuts. The minutes from the March meeting showed progress on inflation had stalled, with tariffs and oil prices called out as risks. That's why the oil story matters so much. Energy is one of those inputs that walks straight into the inflation conversation wearing muddy boots. But the Fed takeaway here is not cuts are back tomorrow. It's more like the bar is higher and please stop asking every 10 minutes. For markets, higher for longer pressure tends to hit the duration-sensitive stuff first. Growth multiples, real estate, and bond proxies. We're seeing that flavor today with TLT around 81.61, down 0.53%, and IEF at 92.95, slightly red. Not panic, but the bond market is not exactly sending a love letter. Third one for the macro desk. Private credit exposure is under scrutiny. The warning here is about low recovery prospects in parts of private credit, especially where software company valuations were priced for perfection and the economy maybe isn't handing out participation trophies anymore. Why it matters. Private credit has been a massive alternative finance engine, and when recoveries look thin, that can bleed into risk appetite even if it doesn't hit the tape all at once. This also ties back to rates. Expensive money makes weak balance sheets louder. So the stack today is simple. Oil relief helps, Fed minutes lean restrictive, and credit is the quiet corner of the room making everyone check their wallet. Coming up, the Whisperer update gets into the paper portfolio and what's actually moving on the screen.
Thanks, Macro Desk. Let's snap right back to IMCC because oof, the level got paid. Here at the markets desk, we flagged that 10.11 cent area earlier, and the tape punched through it. New high on the candle read is about 10.45 cents, and now the whole question is simple. Was that a clean breakout or just a quick liquidity pop? Look at the shape here. Base was built lower, volume came in on the push through the dime, and now it's not collapsing right back under the breakout zone. That matters, but it is still IMCC, microcap healthcare cannabis name, tiny market cap, big percentage swings, and every tenth of a cent looks massive on the chart. Now watch the pullback. This is the part I care about more than the headline number. The high is 0.1045, latest structure is cooling off around 0.1015 to 0.102, and volume is tapering. That's not automatically bearish. That can just be digestion after the chase candles. But if 0.1015 cracks clean, then this starts looking like failed follow-through instead of a controlled pause. Flip side, if buyers reclaim 0.1045 with volume again, that's your next confirmation that the breakout is still alive. No need to overcomplicate it. Above 0.1045, buyers are pressing. Below 0.1015, momentum gets sketchy. Okay, catalyst check. Fresh press release this morning. IM Cannabis says it entered an agreement to sell IMC Holdings and European-focused assets. That's the kind of headline that can wake up a name like this, because traders immediately start asking, all right, is this balance sheet cleanup? Is this survival capital? Is this a strategic pivot? We're not pretending the release magically fixes the whole business, but it does explain why volume found the stock today. You've got roughly 38.6 million shares traded, against average volume around 559,000, so the tape is not normal. That's the story. Corporate action headline, huge relative attention, and a chart trying to hold above the breakout instead of instantly fading. And here's the risk box, because with these tiny names you've got to check it before getting excited. Dilution page shows active shelves, an active equity line, medium overall dilution risk, and about 2.17 million raised over the last 12 months. That doesn't mean a deal hits right now. It means overhead supply is part of the trade map. So for IMCC, the markets desk scorecard is earlier breakout level hit, good. Volume confirmed the push, good. Now it has to hold the new floor and not turn into a wick trap. My two levels from here, 0.1045 above for continuation confirmation, 0.1015 below for momentum failure. Coming up, we've got the Whisperer update. So we'll see how Paperbook is handling this mixtape.
Thanks, Markets Desk. Let's do a calm paper portfolio check here at the Stock Whisperer. This is the simulated broadcast account, not something to copy. And right now we've got 6 open positions with about 91,000 in cash and roughly 315 in open unrealized P&L. Not perfect, but controlled. EYPT is the problem child. Short 1,000 from 451, now around 468, down about 169 bucks. That thesis is not working cleanly right now, so the risk has to stay defined. Ford is doing its job on the other side. Long 600 from 1385, trading 1417, up about 192. PYPL is also green. Long 150 from just under 5962, now 60.38, up about 113. The cleanest open trade on the blotter is still SPGI. Short 20 shares from 424.155. Trading around 411.86, so that's plus about 246, almost 3%. That one is thesis doing what it's supposed to do. Lower highs, risk defined, and no need to overmanage a winner just because it's green. TSLA is basically flat against us. Short 30 from 338.75, now 339.50, down 22 bucks. For that one, the trigger I'm watching is 336 below. If sellers can't press it under there, it's just noise, not confirmation. UNH is small red too. Short 25 from 394.59, now 396.39, down 45. That's the CMS rate pressure thesis, but I'm not going to pretend it's working until price actually rolls back over. The key with this whole page, winners get room, losers get boundaries. That's the point of the paper desk. Now, the working orders. This is where I want the discipline to show up on screen. EYPT has the buy limit sitting at 3.75 for the cover, and the stop up at 4.888. I'm also watching 4.80 above as the squeeze warning zone. UNH has the cover target at 370 and the stop at 407.50. SPGI's cover target is 405 with the stop at 418.80. PYPL has the sell target at 64.50 and the stop at 58.85. Ford and TSLA don't show resting brackets on this orders tab right now, so they're active management items, not set and forget. Also worth saying, the AMD long idea earlier did not execute because the max position rail blocked it. That's good. The rail did its job. No chase, no forcing a 7th position. Coming up, we'll kick it back into the Pro Terminal workflow after this paper book reset. Thanks, Stock Whisperer. All right, quick tool check while the tape is still mixed. Everything we're using here at the markets desk starts with the Pro Terminal Movers Board. Look at this. IPST up about 260%. Weto up over 100%. WFF still nearly doubled. And then you've got the red names on the other side getting torched. That's the whole point. This isn't a buy list. It's a fast research board. Who's moving? How big is the move? What's the relative volume? And is it actually worth opening the chart? Now we hit the chart. IPST on the 1 minute. This is where the board turns into a tradable tape read. Oof, look at that range. Massive gap, huge volume. And now the question isn't, is it green? Everyone concedes green. The question is, where did volume actually confirm? Where are the wicks? Where's VWAP? And is the move holding structure or just whipping late chasers around? Pro Terminal keeps the chart right next to the data, so you're not guessing off a headline and a percentage number. And this is the part small cap traders skip way too often. Dilution. Pull up the dilution center. Shelf registrations, ATMs, offerings, those matter. Especially when a name is ripping on monster relative volume. A chart can look clean for 5 minutes, but if the company has active financing risk sitting in the background, you want to know that before you start treating the move like it's all clean momentum. Data can be incomplete or delayed sometimes, sure, but having the filing trail in one spot is a huge edge for research discipline. Then you go straight into the stock profile. Filings, news, insider activity, the whole trail. Again, not magic, not signals, just fewer blind spots. If a stock is up 200% and there's a fresh filing, I want that in front of me right now, not 10 tabs later. That's what you're seeing on the stream. Movers, charts, dilution, filings, insider trades, all inside Pro Terminal. If you want the same setup, go to proterminal.io. Coming up, we'll get right back to the live market mover scan.
All right, Markets Desk is back on the movers board. Let's see what's actually paying traders right now. And yeah, this board is spicy. The tape itself is not giving you some big free beta push. SPY red 3/10, QQQ basically flat red, IWM red, VIX up near 19.65. So when IPST is up almost 260% on 92 million shares, that's not the market dragging it higher. That's its own animal. WETO up 118%, WFF up 110%, OSRH and IVF stacked behind it. Then flip the board. ZTG down 71%, EYPT down 68%. Oof, that's why here at the markets desk we don't just chase the green, we track where the liquidity is breaking too. We're going board to chart now. IPST first, then WETO, then WFF. Pulling up IPST now. This is the top dislocation on the board, about 792, up 260%. 92 million shares traded versus an average around 50,000. Relative volume, 1,800 times. That is absurd. Float is about 10.2 million, market cap only around 6 million, and the dilution flag is high. So this is exactly the kind of small cap tape where the candles can look amazing right until liquidity disappears. On the 1 minute, the first line is super obvious. $8. Clean round number check. If IPST can actually stay above 8 with volume still hitting, that tells me the bid is still alive. If it keeps tagging 8 and stuffing back under, that's where you start thinking exhaustion, not continuation. Downside line for me is 750. Lose 750 after this kind of move, and the momentum profile gets messy fast. Not a hero name, just levels, volume, and whether the tape confirms it. Now Wedo, this one's nasty in a different way. Webus, tech name, about 1796, up 118%, and look at the share count setup here, 5.7 million float, 19 million shares already traded. So that's the whole point. The float has basically turned over multiple times, which is why the candles can move like this. The line for me is super obvious, $18. We're sitting right on it. If this keeps poking over 18 and instantly getting sold back under, that's rejection. That's supply showing up. If it can actually base over 18 for a few candles, then the tape is telling you buyers are still absorbing. And just a quick flag, the board has recent filings marked on Wedo, so with these newish China mobility/tech runners, don't just stare at the green number. The filing headline matters, the float matters, and the liquidity can disappear fast. Flip WFF next. This is the industrial low float mover. $3 and change, up about 110%. 61 million shares traded, and the float is tiny, 1.6 million. So yeah, this thing is trading way bigger than its float, and that's why you get those air pocket flushes. The whole chart is about the $3 area now. 3 is the liquidity magnet, right? Above 3, buyers can pretend they're in control. Under 3, especially if it loses it on a fast candle, you can get that trap feel where the prior squeeze turns into a liquidity wash. And remember, WFF has high dilution risk on the board, so this is not some clean large cap technical setup. It's a momentum tape. I'm watching whether the flush low starts stabilizing. Higher lows into 3 is constructive. Heavy red candles through 3, totally different story.
OSRH next, and there's that 60-cent area again.
We already saw the hit, so I'm not going to over-celebrate the first tag. The question now is, does 60 become a shelf, or does it turn into rejection? This is a healthcare/blank check style tape, 60-cent stock, up basically 90%. But the crazy part is the liquidity, 258 million shares traded. That's not a quiet move. So if the candles keep accepting above 0.60, okay, strength is still there. If it keeps poking over 60 and instantly slamming back under, that's the trap look. And with high dilution risk on the profile, I'm not treating this like some clean blue chip breakout. This is a fast tape, respect the flushes. Now, IVF. Same healthcare momentum bucket, but different structure. 176, up about 81%. And this one's already done 104 million shares on a float listed around 1.78 million. That's the recipe for violent candles both ways. I'm watching 175 as the immediate liquidity check. If it can't hold around there, the move can thin out fast. If it stabilizes, then $2 is the big psychological area above. And you know everybody on a low float runner sees that round number. But again, high dilution risk here. Tiny market cap. Very trady name. I want to see volume actually support the push, not just one green candle into a rug pull. All right. CTXR on the 1 minute. Quick candle lab. No wasted motion. Here at the markets desk, this is not a clean trend day. This is a tight range with one real expansion attempt. We've got roughly 55.8 cents on the bottom, 58.4 cents on the top, and right now it's sitting near 56 cents. Market's mixed, and small caps are a little heavy, so that lower end stall matters. Now, look left on the chart. CTXR opened around 56.6 cents, dipped into that 55.8 area, and that first flush had volume behind it. Not gigantic, but enough to tell you sellers were active there. Then it does the thing you want to see if you're just reading candles. Higher lows, higher highs. grinding back through 57, then into 58. The real candle was the push toward 58 to 58.4 cents. That volume spike over 100,000 shares. That's the breakout candle. That's the one the chart remembers. But oof, look at the reaction after. It could not hold the high. The pullback came back into the middle, then lower end of the range, and volume faded on the way down. So the breakout was real on volume, but the follow-through, not there yet. So the scorecard is simple. Below 55.8 cents, that's the danger line. That's where the range floor starts to fail. Above 57 cents, first reclaim. And then above 58.4 cents is the only level that says buyers actually took back the breakout zone. Right now it's basing near 56 cents with moderate volume, so I'm not calling this a ripper. I'm calling it a failed breakout trying not to become a breakdown. Respect the chop. Coming up, we'll flip into Mega Cap Watch and see if the big names are doing anything cleaner than this. All right, let's flip from the microcap chaos to Apple. Mega cap tape check. Here at the markets desk, this is the cleanup read. QQQ's only down a little. SPY's red, breadth is mixed, and Apple's lagging a touch, down about 0.8. So yeah, not disaster tape, but not leadership either. Okay, daily chart first. Look at the journey here. Apple ran from the high 250s, basically 259-ish, all the way into that monster high near 344.57. Then, oof, that sell candle sequence down toward 275 was real. Volume confirmed the damage there. Since then, this thing's bounced, but it's not back in clean trend mode. It's boxed, low 300s, choppy. The level that matters on the bigger picture is 310. That's the near-term resistance zone, and it lines up with the 50-day area around 309. If Apple can't reclaim that zone, it's still below the short and medium moving averages. 20-day around 317, 50-day around 309, so the daily read stays heavy. I'm not calling it broken long-term, because the 200-day is way lower around 280.65. But this recent structure, that's range trade, not leadership.
All right, breaking news first. ProTerminal's newsroom is tracking oil slipping as optimism builds around Iran nuclear talks. Here's what we know. Crude is backing off as the market prices in a little less supply disruption fear, basically taking some of that geopolitical premium out of the barrel. What we don't know yet is the big part, whether this is durable progress, whether anything actually changes on supply, or whether this is just another headline that lasts until the next headline. Market read from the macro desk, cheaper crude, if it sticks, is a small pressure release for inflation-sensitive areas, transports, consumers, anything with fuel in the cost stack. But don't confuse relief with an all clear. The oil proxy on our screen is still around 128.34, and green by about 1.37%. So the market is not exactly throwing a peace parade here. Next big one. NVIDIA secures record AI financing, up to $500 billion tied to chip purchases through 6 major financial firms. That's not pocket change. That's not even sofa cushion money unless your sofa is a hyperscale data center. Why it matters? This is the AI capex cycle trying to fund itself at monster scale. For NVDA, the question investors are going to track is whether this turns into actual ship demand and clean revenue pull-through, not just a headline with a really large number stapled to it. And in a tape where QQQ is only off about 0.14% around 7:30, Mega Cap AI still has the market's attention, even when the broader board is mixed. And third headline, Merck is buying Terns Pharmaceuticals for $5.7 billion in cash, aimed at strengthening the oncology pipeline as Keytruda patent pressure sits out there in the future. Why investors care? Big Pharma is still hunting for pipeline depth, and cash deals tell you management teams would rather pay now than wait and hope the internal pipeline solves everything. MRK is the affected public name here, and the market lens is pretty simple. Does this help offset the patent cliff narrative? And how does the leukemia candidate progress clinically? Coming up after this, we'll kick it back to the charts with Wedo candle action, because apparently the small cap tape did not get the memo about being quiet at lunchtime.
Thanks, Macro Desk. Markets Desk grabbing Wedo here because, this candle set is alive. We flagged that 18 level earlier, and yeah, that one hit. Now the board had this thing up around 130%, while SPY and IWM are red, so relative strength is not subtle. On the 1 minute, the move started pretty controlled. 1620, 1660. Little sideways chop, then boom. First real expansion candle through 17 on volume. That's where the character changed.
Look at the stair step here. Higher high, higher low. Higher high, higher low. Clean until it gets vertical. The key part for me is the push from about 1760 into the 19 handle. That wasn't a quiet drift. Volume came in hard. Multiple spikes, one of them over 170,000 shares. And that's what you want to see if a breakout is going to have teeth. But here's the flip side. Parabolic candles are great until they're not. The high is 1930, current read is around 19.08. So it's still basically sitting right under the highs, but the latest candles are starting to stall a little. I'd keep 1930 as the upside trigger line on this tape. If it can reclaim and hold above that, the squeeze is still trying. If it keeps wicking into that zone and volume fades, that's where late buyers can get trapped fast. Downside line is simple. 1750. That's the first real support zone from the structure after the breakout. Not saying it has to go there, just saying that's the level that would tell us whether this is healthy digestion or a full momentum unwind. Above 1930, bulls are still pressing. Below 1750, the parabolic look starts to cool off in a hurry. And with the broader tape mixed, QQQ barely red, IWM weaker, VIX green, I'm respecting the move, but I'm not chasing emotion on a candle that already went vertical. Coming up, we've got another news intermission in the queue, so we'll keep one eye on this Wedo high while the headlines roll.
Thanks, Markets Desk. Macro Desk has the wires now, and the big headline is oil, because apparently crude refuses to have a quiet Monday. ProTerminal is tracking Brent crude approaching $90 as tension around the Strait of Hormuz brings supply risk back onto the board. What happened is pretty straightforward. When that choke point gets tense, traders start pricing the possibility that barrels become harder or more expensive to move. Why it matters? Oil is the tax nobody voted on. If it stays elevated, it feeds transport costs, inflation expectations, and keeps pressure on rate-sensitive parts of the tape. SPY is around 773. VIX is sitting near 19.7. Not panic, but definitely not nap time. Next headline. The Reserve Bank of Australia holds rates at 4.35%. That's the desk seeing another central bank choosing patience over victory laps. The fact pattern here is a hold, but with inflation risks still in the room. Why investors care? Global rates don't move in perfect lockstep, but they do rhyme. If central banks stay cautious, bonds don't get a clean green light. You can see that vibe today with TLT down about 0.7%, while gold is up around 0.9%. That's the market saying, cool, but I'm keeping one hand on the umbrella. Now to crypto equities. Riot Platforms posts a huge adjusted EBITDA loss, $223.5 million with minimal revenue. That's the headline. And it matters because miners are not just a Bitcoin chart with a logo slapped on top. They've got power costs, capex, debt, equipment cycles, and all the boring stuff that ruins a good party. Crypto proxies are actually green today. BITO up about 1.9%, Coin up 1.6%, MSTR up more than 4%. But Riot's story is about company-level financial stress. So the macro read is, crypto beta can lift the group, but balance sheets still decide who survives the winter. AI headline 1. OpenAI is refocusing strategy toward coding and enterprise users, moving away from the big do-everything approach. OpenAI is private, so there's no public ticker to chart here, but the investor angle is very public. Enterprise AI is where recurring revenue, workflow lock-in, and margin discipline are supposed to show up. If the AI trade is going to graduate from story stock to earnings machine, business users matter. And sticking with AI infrastructure, KKR scores roughly a 15 times equity return on the Coolit sale to Ecolab. That's the picks and shovels side of the AI boom. Not just chips, not just models, but cooling, power, data centers, the plumbing. Dry joke, but honestly in this market, the plumbing has better pricing power than half the software screen. Why it matters? Private market exits like this tell you capital is still chasing the physical infrastructure behind AI. 2 mega-cap AI notes to close the brief. First, Apple. An analyst says the stock could rise sharply if Apple strikes an NVIDIA deal tied to AI and open source model deployment. Important wording there. That's an analyst scenario, not a done deal. The market angle is that Apple has been treated like an AI laggard, so any credible partnership with NVIDIA would be about closing the perception gap as much as the product gap. Then Microsoft. ProTerminal is tracking the valuation story there. Shares trading below their 5-year average earnings multiple, even with AI growth and 30 million paid Microsoft 365 Copilot subscriptions in the mix. Why it matters? MSFT is the cleanest test of whether investors will pay for AI that already has distribution. If Copilot growth keeps converting into real revenue, the multiple debate gets interesting. If not, well, Wall Street has a short attention span and a long memory for missed monetization. Coming up, we'll kick it back into the platform view with a quick ProTerminal hit.
Thanks, MacroDesk. Quick stock whisper check-in on the simulated paperbook. I just closed the TSLA short, 30 shares, and the reason is pretty simple. The short thesis was losing urgency. TSLA wasn't breaking lower. QQQ is only down a touch. And with fresh mega-cap catalysts floating around the tape, I don't want to sit in a weak short and just wait for it to test the stop. So that one gets cut before the risk expands. Clean process. Thesis weakens, level doesn't confirm, I take the paper trade off. That's the whole point of running this on air. It's simulated, it's controlled, and it is definitely not a copy this trade. Now the active book is back to 5 positions. EYPT short is slightly against us, down about $74, so I'm respecting squeeze risk there. F is working nicely, long 600 shares, up about 192. PYPL is green by about 113. SPGI is the best open short right now, up about 246. UNH is a small paper loser, down around 45, and that one still needs discipline because healthcare headlines can whip around fast. Working brackets are still on for EYPT, UNH, SPGI, and PYPL. No new trade from me in this check. I've got cash around 80.8 thousand, and I'm watching NVDA and MSFT only if the mega cap bid actually firms. Coming up, we'll kick it back to the movers board.
Thanks, Stock Whisperer. Quick ProTerminal lap while the tape's still mixed. First stop, Dilution Center. This is where I want the ugly stuff up front. Shelves, ATMs, offerings, All the supply risk that can smack a small cap chart right when it looks clean. Oof, this is the page that keeps you honest. A runner is not just a candle. You've got to know what paper could be sitting above it. Now flip to the movers board. This is the market's desk home base. SPY's red, QQQ's basically flat, breadth is mixed. So when a name is up 200%, that relative strength jumps off the screen. But watch the key distinction. Movers are research leads, not buy signals. IPST is sitting at the top here, up about 239% with monster relative volume. That's why it earns a chart check. Not because we chase it, because the data says, hey, this thing is active right now. Then, before I get married to the move, I hit the company profile. Filings first, always. If there's a fresh offering, a shelf, a weird registration, that changes how I read the tape. Same workflow for insider trades. Not magic, not a signal by itself, just context. Who's been filing? What changed? What's recent? And yeah, data can be delayed or incomplete sometimes, so you still verify the source document. That's the point. Fast workflow, but not blind workflow. Last stop, the 1-minute terminal chart. This is where we line up the actual tape. Volume burst, VWAP behavior, wicks, failed pushes, reclaim levels. Look, ProTerminal won't trade for you. And this stream is educational, not personal advice. But it puts the board, the risk pages, the filings, insiders, and the chart in one place, so you're not flying around 5 tabs while a candle is ripping. If you want the same setup we're using on screen, sign up at proterminal.io. Coming up, we're going right back into the mover scan.
All right, Market's desk is back on the movers board. And yeah, this board is spicy, while the index tape is pretty meh. SPY down a third, QQQ basically flat, IWM red, VIX green near 19.5. So when you've got IPST up 240% with 1,800 times relative volume, that is not normal tape. WETO still sitting second, up 120. That name already paid us on the earlier $18 flag, so we'll grade it, not chase the headline. Then OSRH, WFS, IVF, all big percentage movers, all smaller cap style risk. Oof, look at the relative volume stack here. IPST 1851, WFF 605, WETO 455. That's where the action is. But huge rel vol cuts both ways. It can squeeze, and it can rug pull fast. Now pull up IPST, top of the board. This is Heritage Distilling, craft spirit's name. But honestly, today, this is less about the business and more about the tape. Price is $7.49, up 240%. Volume, 93 million shares versus about 50,000 average. That is absurd. Float on the feed is about 10.2 million. So this thing has traded through that float multiple times already. That's why the candles matter more than the story. Around here, 750 is the immediate line I'm watching. If it's accepting above 750 with real 1-minute volume, momentum still has the ball. If it loses 7, that's where I start calling it late long trap risk instead of clean continuation. Also, platform has dilution risk marked high here. So yeah, respect the move, but don't fall in love with it. These tiny names can change personality in one candle. WETO is the follow-up now, and this is where I grade the move a little differently. Earlier, this thing gave you the hit. Fine, nice, it did the momentum thing. Now the question is, does it actually hold momentum, or does it start turning into that classic small float unwind? It's still up about 121%, 20 million shares traded, relative volume north of 450, so the crowd is absolutely still here. But at $18.20-ish, I'm watching the tape around 18. If it keeps reclaiming and holding above 18, okay, buyers are still defending the move. If it loses 18 and can't pop back through it, that's when I'd stop calling it clean momentum and start calling it distribution. Now, OSRH. This one's wild because the volume is just massive. We're talking 273 million shares, price around 59 cents, up 86%. Healthcare/blank check style structure, and dilution risk is high on the board. So yeah, there's activity, but don't treat this like a clean institutional breakout. The area is super obvious. 60 cents. If OSRH can reclaim 60 and stay there, that's the momentum tell. If it keeps wicking into 60 and failing, that's your fade risk signal. Because sub-dollar names can look strong for 5 minutes and then just rug the whole bid. I'd also want to see whether pullbacks hold in the high 50s instead of instantly breaking down. That's the difference between active accumulation and just liquidity getting passed around. WFF next. This is WF Holding, and this is the ultra-thin industrial name on the board. Price is around 260, up about 82%. But the real eye-popper is the structure. Roughly 1.6 million float, 66 million shares traded, and relative volume over 600 times normal. That's the kind of tape where the candles can look amazing for 5 minutes, and then just completely rug if the bid disappears. So the level I care about is pretty simple, $3. If WFF can reclaim 3 and actually hold above it, then you've got buyers proving they're still there. If it stays heavy below 3, especially with that high dilution risk tag sitting on it, I'm grading it more like a squeeze that's losing altitude than a clean breakout. Now, IVF, Invo Fertility, another healthcare runner, and this one's got big share turnover too. About $1.71 on the print, up 76%. 106 million shares traded against a float under 1.8 million. So yeah, it's liquid today, but it's also one of those names where dilution risk is front and center, and you don't want to confuse volume with safety. The clean line here is 175. If IVF reclaims 175 and keeps accepting above it, that's the tape saying buyers are still defending the move. If it rejects there, then I'm watching 150 underneath, because if 150 starts failing, that's where these low-float healthcare runners can go from controlled pullback to everybody hitting the same exit at once. Last pass here. Flip the board to the red side for a second because ZTG and EYPT are the two big flushes. ZTG first, $3 stock now, down about 69%, and it's only done 1.6 million shares, so the bounce quality matters a lot. If the pop is just one green candle into sellers, that's not strength, that's dead cat liquidity. EYPT is different. Bigger biotech, way more real volume, 38 million shares, also down basically 69% around 460. So same percent damage, totally different tape. ZTG is thinner and can whip around. EYPT has enough liquidity where you can actually see whether buyers are absorbing or if every bounce is getting sold. Now, quick sweep through the rest. TRUG is still the most active of the leftovers, $1.50 area up 58%, 56 million shares. Tiny float, so that one still has live momentum, but it can rug fast. AIFU down 41% at $21, but only 133,000 shares. That feels more like a thin, gappy board print than a clean day trading vehicle. CDTG up 39%, 5.4 million shares, 77 times relative volume, active, but not the same heat as IPST, WEDO, OSRH, WFF, IVF. So that's the board. Market's kind of mixed. Small caps are doing absolute circus stuff, and the clean read is volume first, VWAP second, risk always. Coming up, let's get off the pure movers board and hit the next live story on the tape.
Thanks, Markets Desk. Breaking right now, ProTerminal's newsroom is tracking Visa planning to cut 7% of its workforce. What we know? That's about 2,600 roles globally, mainly in technology and product teams, tied to a restructuring push around efficiency and redirecting capital toward growth areas. What we don't know yet, exact timing, region by region impact, one-time charges, or whether this changes near-term guidance. Market read is pretty straightforward. In a mixed tape, SPY down 0.37%, VIX at 19.53. Cost cuts can help margins, but for a payments giant, the question is whether trimming tech and product slows the innovation engine. That's the macro desk's red pen moment. Lower costs are nice, unless you start cutting muscle with the fat. Okay, next big one. NASDAQ 100 nearing correction territory as semiconductor stocks slump. The headline isn't just, hey, chips are weak. It's that QQQ is sitting around 730.35, only down 0.10% live. But the market is treating semis like the steering wheel for the whole AI trade. NVDA, AMD, and INTC are tied to this pressure. And when that group loses bid, multiples across megacap growth get audited in real time. Why it matters? Semis are the capital spending barometer for AI, cloud, data centers, the plumbing. If the plumbing stocks wobble, the whole house starts checking for leaks. Last one for this quick brief. Gold is catching a bid, up more than 1% in the headline, and our live gold proxy is at 404.92, up 0.86%. The story is a pause in U.S.-Iran hostilities, taking some pressure out of the oil risk narrative. But here's the wrinkle. Our live oil proxy is still 129.30, up 2.13%. So commodities are not exactly singing kumbaya. Why it matters? Gold holding firm, while equities are mixed and VIX is near 19.5, says investors still want a hedge on the table. Macro desk translation. People may be taking off the helmet, but they're not throwing it in the closet. Coming up, Mega Cap Watch should be a good one if semis keep setting the temperature.
Thanks, Macro Desk. Let's yank up CBRG for a quick small cap momentum check. This is the markets desk, so we're not doing a spreadsheet debate here. We're doing tape. CBRG is a NASDAQ shell company name, roughly 77 million market cap on the company card. And the 1 minute is the whole story. Low was around 592, high was 627 and change. Current read is near 606. And with SPY red, IWM red, VIX green, small caps need real volume to matter today. Okay, look at the structure. The first legit push was over 610. That move had volume behind it. Big burst near 200,000 shares around 613. Then it stretches 620, 625, tags about 627.5. That's the clean part. After that, oof, look at the energy fade. It flags between roughly 617 and 622. Volume dries up, and now it's sliding back toward that $6 shelf. So for me, 622 is the reclaim line. Above 622 with volume, momentum gets interesting again. Below 6, the whole breakout starts getting wobbly. And if 595 cracks, that earlier volume push looks more like a trap than a continuation. Quick risk pass, because this is where small cap traders can get smoked. Chainbridge is basically a shell/acquisition vehicle. On the dilution page, I'm seeing no active shelf, no pending S1 in this read. But there is an active equity line flagged, and the modeled runway is under 2 months. That doesn't mean anything has to hit the tape today. Don't hear that wrong. But it does mean supply risk is part of the background. So if the chart is clean, cool, you respect the levels. If the chart gets sloppy, you don't pretend this is some clean mega cap trend. Back to the candles. Right now, CBRG is not in breakout mode. It's in prove-it mode. $6 is the shelf. 622 is the reclaim. 627.5 is the high it has to deal with if volume actually comes back. I'm not seeing a fresh press release catalyst in the packet, so this is tape first, flow first, levels first. Clean reclaim, we track it. Lose 6 and stay heavy, momentum desks usually move on fast. Coming up, we'll flip from this little name tape to Mega Cap Watch and see if the big stocks are giving us anything cleaner. All right. Rotate out of the small cap fireworks. Let's hit AMZN, because this thing is quietly lagging the tape. Daily chart first. AMZN's around 259, down about 1.3%, and that matters because QQQ is only off a hair, down roughly a tenth. So relative weakness here. Bigger picture, it's not some destroyed chart. Still a monster, almost a $2.8 trillion market cap, but the daily structure is stuck in range mode. You've got that 258 to 260 area trying to act like support, and the big ceiling is still that 275 to 278 zone where buyers have failed a few times. The markets desk read, this is a pullback inside a bigger range, not a fresh leadership breakout. If 258 starts getting chewed through on the daily, that's when the tone gets heavier. Now let's drop down to the 1 minute. Oof, look at the stair step lower. This is clean intraday pressure. Started around 260.5. Failed to hold it, then the real tell was the break under 260. That wasn't just drifting. Volume hit hard on that drop, about 355,000 shares on the big minute, so sellers actually confirmed it. Since then, lower highs, lower lows, no real higher low reversal yet. Current action is trying to base around 258.45, 258.50, but that's a pause, not a victory lap for bulls. The two levels here are simple. 260 above is the reclaim line. If AMZN can't get back above 260 and hold there, it's still trading heavy intraday. Under 258.43, that's day low failure, and then the base everyone's watching starts to look more like a trap. Quick catalyst check, because with mega cap names, I don't want to blame every red candle on magic. I'm not seeing a fresh AMZN specific monster headline today in the release feed. The recent stuff is more background than tape breaking. Amazon ads tooling around title limits, Whole Foods fun news, and the AWS angle with Superblocks and Bedrock from earlier this month. That AWS AI headline fits the broader megacap AI theme, sure. But today's chart is not acting like an AWS-driven squeeze. It's acting like a big liquid name getting sold inside a weak consumer cyclical tape while indexes are mixed. Back to the tape, because this is where the score gets kept. AMZN is not leading today. It's below the intraday open, it broke 260 on volume, and it's sitting near the low-end base. So for the next lap, I'm marking AMZN above 260 as the reclaim and hold test, and AMZN below 258.43 as the level where this little base fails. Clean. No need to overcomplicate it. If buyers show up, they need to prove it with a higher low and volume back through 260. If they don't, this remains a laggard versus QQQ. Coming up, we'll swing back into small cap momentum and see if those runners are still paying the bills or starting to trap late longs. All right, flipping from mega cap tape to the small cap penalty box. Pull up ZTG. Oof, this is not a clean green runner. This is downside momentum. Board has ZTG crushed, roughly 70% off, and the tape's already soft. SPY red, IWM red, VIX green. So small cap weakness has zero mercy today. On the 1 minute, it opened around 316, popped toward 360, and then sellers just slammed it. That wick up top, that's late buyer pain. Here's the read from the markets desk. Lower highs, lower lows, sell volume confirmation. That matters. This wasn't just drifting lower on dead volume. The heavy volume showed up around 290 and under, right where the breakdown started to get real. It's trying to base now around 310, but the bounce volume is lighter, so I'm not calling that strength yet. The first real test is 320. If it reclaims 320 and actually holds above it with volume, then you can at least talk about a squeeze attempt. If it keeps rejecting under 320, it's still trapped below resistance. Now, the risk profile here is classic small cap tape. Market cap around 16 million, float around 3 million shares, and volume today is already over 1.5 million versus about 74,000 average. That's more than 20 times normal activity. So yeah, it moves. But that also means spreads, wicks, halt risk, and ugly reversals can show up fast. I don't see a fresh press release in the data driving this, and the dilution page is actually lower risk than a lot of the tiny runners we've been tracking. No active shelf, no active equity line, no pending S1 shown, but it has raised 19.5 million over the last 12 months. So I'm still treating this like a volatile small cap, not a clean institutional story. Back to the chart, because this is where the score is kept. For me, 320 is the upside reclaim line. Underneath, 2.80 is the shelf. Lose 2.80 and the chart goes right back into breakdown mode, and then 2.69, day low, becomes the flush check. So simple framework. Above 320 with volume, maybe stabilization. Below 2.80, sellers still own it. Coming up, we've got a news intermission, so we'll see if there's any fresh catalyst hitting these small cap names.
Thanks, Markets Desk. Quick macro check, because the 2 o'clock data just gave us a cleaner read on this tape. NAHB housing comes in at 35 versus 33 expected, so better than forecast. And that stacks on top of the Empire manufacturing number earlier. 20.6 versus 11 expected. So, okay, the economy is not exactly falling down the stairs here. But look at the reaction. SPY's around 773.38, down about 0.4. QQQ's only off 0.14%. Russell's weaker, down 0.55%. and VIX is up near 19.53. That's the little macro joke today. Good data is good, until the market remembers good data can keep pressure on rates. Inflation's the guest who says he's leaving, then sits back down on the couch. Here at the macro desk, the chain is pretty straightforward. Better growth data, bonds don't love it. TLT is down 0.77% at 81.405. IEFs down 0.16% at 92.895. So the long end is taking more of the punch. That matters even if you only trade stocks, because long-duration tech and smaller caps do not enjoy a rates headwind showing up in the middle of the afternoon like an uninvited auditor. Now, commodities are not exactly calming the room either. Oil's up 2.47%, around 129.73. Gold's up 0.96%, around 405.33. So this isn't a clean risk on tape. It's more like growth data decent, rate pressure sticky, commodity inflation still on the screen, and equities trying to decide whether that's a snack or a stomachache. All right, top of the hour reset from the macro desk. If you're just joining us, it's 2:04 Eastern, and the market's doing that very Wall Street thing where everything looks calm until you open the hood. SPY's at 773.49, down 0.37%. QQQ's 730.15, down 0.13%. IWM's weaker at 303.30, down 0.59%. And VIX is not screaming, but it is green at 1951. So the message is pretty clean. Megacap tech is bending, small caps are taking more of the punch, and volatility is sitting near the door with its jacket on. Breadth is mixed. Fancy way of saying the tape isn't a disaster, but it's also not throwing a parade. The cross-asset tell is the real story. Long bonds are heavy. TLT 81.38, down 0.81%. IEF down 0.19%. So rates are leaning on duration, and that's why NASDAQ can't quite get comfortable. At the same time, oil's up 2.81% at 130.16, gold's up 84% at 404.86, and crypto's oddly wearing the party hat. BITO up 2.12%, coin up 1.19%, MSTR up 4.09%, dollar proxies flat at 28.11, yen proxy a little softer at 57.52, so the chain is simple. Firmer energy plus weaker bonds keeps the inflation and rates conversation alive, even after better data. Empire beat earlier, NAHB just printed 35 versus 33, and equities are saying, cool, but show me lower yields. Coming up, news intermission has the bigger headlines. Then we'll swing back into tools and movers. Here at the macro desk, my radar is QQQ around 730, VIX near 20, oil holding the 130 zone, and tick flows at 8 Eastern. All right, quick pro-terminal news brief from the macro desk. Microsoft is the headline, and this one is a valuation story, not an apocalypse story. ProTerminal's newsroom is tracking MSFT, trading well below the earnings multiple it has averaged over the past 5 years. The twist is, the AI story has not gone away. The card has 30 million Microsoft 365 Copilot subscriptions on it. So the headline is not, AI is dead. It's investors are no longer paying any price for AI. Very different animal. Why it matters. Microsoft is one of the cleanest ways the market expresses the enterprise AI and cloud software theme. If the stock is getting a lower multiple while Copilot adoption is still growing, that tells you the market is shifting from story mode to proof mode. AI has gone from magic word to show me line item. Wall Street has apparently rediscovered calculators, which is rude but probably healthy. Now, the macro read-through. This is landing with QQQ around 729.8, down about 0.17%. SPY around 773.4, down 0.38%. And VIX at 19.52. Still under that 20 line we flagged, but not exactly asleep. Bonds are not helping either, with TLT around 81.38, off 0.81%. So for big software, the issue is pretty simple. If rates stay sticky, those long-duration AI cash flow dreams get discounted harder. Microsoft has real cash flows today, sure, but the market still prices a lot of tomorrow into that hoodie. Who's affected? The obvious bucket is megacap software and cloud, the MSFT, enterprise AI, data center demand lane. But this also speaks to the broader NASDAQ tape. If Microsoft can hold up while the market is mixed, investors may still be differentiating quality from hype. If it can't, then the multiple compression story can bleed across the AI complex pretty quickly. No trade call from the macro desk there, just the scoreboard. Coming up, we'll swing through a quick Pro Terminal tour, then back to the movers board.
Thanks, Macro Desk. Quick tool check before we hit the movers again. This board right here is Pro Terminal's Market Movers, and this is literally where the market's desk starts when the tape gets weird. IPST up over 200%. WETO still huge. IVF, OSRH, then the red side with EYPT and ZTG. Not buy signals. Big difference. It's a live research board. Price, percent move, relative volume, what's actually lighting up while SPY and QQQ are still a little red. Now this is the part I care about. One click, boom, 1 minute chart. IPST on screen. You can see the move, the volume bursts, the wicks, the chase zones, the pullbacks. Oof, look at that kind of action. That's why I don't want just a headline. I want the tape. I want to know where volume actually showed up, where a move stalled, and whether the stock is holding a level or just doing one of those small cap trapdoors. Pro Terminal keeps the board and the chart tied together, which saves a ton of time when names are rotating fast. And then the unsexy stuff. But honestly, this is the stuff that can save you from getting smoked. Dilution center, shelves, ATMs, offerings, equity lines, all the capital raise risk that a lot of traders forget to check when something's ripping. Then we jump into a company profile and hit filings. Same idea. What did the company actually file? Not what somebody yelled on social. And insiders too. Who's buying, who's selling, what's been reported. Data can be incomplete or delayed. Filings can update, so you still have to use judgment. But having movers, chart, filings, insider trades, and dilution in one workflow? Yeah, that's the edge for research speed.
Thanks, Markets Desk. Breaking news. SPGI is the lead right now. S&P Global shares are dropping after the company missed profit expectations. That's the headline. That's what we know. Profit came in short of what the street was looking for, and the market is immediately reading that as a demand softness concern for a major data, ratings, and analytics business. What we do not know yet from this brief is the clean split, whether this is margins, timing, mix, softer customer demand, or guidance risk. And that matters, because SPGI is not some random corner of the tape. It sits right in the plumbing of credit, benchmarks, and financial data. So here at the macro desk, the read is pretty simple. When the companies that help price the economy start missing profit expectations, the market pays attention. Dryly, of course. The economy always sends the bill, just usually in a PDF nobody wants to open. Next wire. The NASDAQ 100 is nearing correction territory as the semiconductor sell-off intensifies. The names tied to this one are the usual temperature gauges: NVDA, AMD, INTC. And the reason it matters is leadership. Semis have been the engine room for the growth trade, especially the AI side of it. So when that group starts losing altitude, it's not just a chip story. It becomes a market structure story. QQQ is sitting around 729.8, basically right on that 730 area we've been tracking, while VIX is still under 20 but awake. Not panic, not calm either. More like the market had too much coffee and is pretending it's fine. Add in weaker long bonds and oil around 130, and the multiple math for high-duration tech gets a little less friendly. And then a cleaner positive on the single-name side. PayPal beats earnings estimates as the turnaround effort advances. The market angle here is execution. Payments has been a tough neighborhood. Competition, consumer spending questions, margin pressure. So a beat gives investors at least one hard data point that the reset is getting some traction. It doesn't solve the whole story in one print, but in this tape, where AI hype is being questioned and profit misses are getting punished, actual earnings delivery matters. That's the contrast today. SPGI gets hit for missing, PayPal gets credit for beating, and the index tape is still sorting out which version of the market it wants to be. Coming up, we've got that CBRG deep dive on deck.
All right, let's run the board. Here's what's actually moving. Heritage Distilling Holding Company, Inc. IPST is up about plus 216.2% on roughly 1,879.7 times its usual volume. Webis International Limited Ordinary Shares, WETO, is up about plus 202.9% on roughly 498.6 times its usual volume. Invo Fertility Inc., IVF, is up about plus 90.4% on roughly 22.3 times its usual volume. Let's take the top names one at a time on the 1 minute. IPST first. Heritage Distilling Holding Company, Inc., IPST, is up about plus 216.2% on roughly 1879.7 times its usual volume. On the 1 minute, watch VWAP, the volume on the push, and whether it's holding the level or fading. WETO first. Webis International Limited Ordinary Shares, WETO, is up about 202.9% on roughly 498.6 times its usual volume. On the 1 minute, watch VWAP, the volume on the push, and whether it's holding the level or fading. IVF first. Invo Fertility Inc., IVF, is up about plus 90.4% on roughly 22.3 times its usual volume. On the 1 minute, watch VWAP, the volume on the push, and whether it's holding the level or fading. All right, let's pull up CBRG and see if there's an actual setup behind this little SPAC move. Here at the markets desk, I'm keying off the 1 minute candle set first. CBRG is printing around 611 on this chart, and the broader tape is a little soggy. SPY and QQQ red, IWM worse, so this is its own lane, not just index beta. Okay, chart tells the story. Opened around 593, quick push, higher highs, higher lows, then that thrust into the 627 area. Real volume came in as it lifted through 610, 615, 620. That's the part I care about. Then the fun stopped. Oof, look at the stall. Lower volume, candles tightening around 611, 612, and it's basically building a base above 605. So the clean levels are simple. 622 is the range top. First spot where buyers prove their back. 605 is the shelf. Lose 605, and the next reference is that 593 open/day low zone. Not a prediction, that's just the map. Quick catalyst check. Because with CBRG, you really need to know what this thing is. Chainbridge 1 is a shell company, SPAC style. Market cap about 77 million. Looking for a business combination, specifically around tech tied to US national security and intelligence interests. I'm not seeing fresh press releases in the platform feed right now, so I don't want to pretend there's a confirmed headline driving every candle. If this is moving, the tape is ahead of the public PR feed, or it's just SPAC/shell mechanics. Now the risk page matters. Dilution Center shows no active shelf and no pending S1. But it does show an active equity line, 7 total offerings historically, and runway around 1.7 months. Overall risk is marked unknown, so don't turn that into a clean green light. For these small shell names, supply headlines can change the tape fast. Back on the chart, I'm keeping score this way. Above 6.22, we see if momentum can retest that 6.27 high. Below 6.05, the base failed. Coming up, we'll flip into Mega Cap Watch and see how the big leaders are trading against this reddish index tape. All right, Markets Desk is going to park it right there. Movers stayed wild. CBRG's 622 and 6.05 levels are still the scorecard.